benefiting more from AI, use of AI. But AI and data centers need energy. So the energy policy and the data center policy are to be looked at one comprehensive thrust forward. Finally, I think this is something which industry also needs to do a lot. I think we, together with the government, with the industry, with the infrastructure which government has already set up, our focus on research and development, our focus on innovation must be relentless, because the winners of tomorrow will be those who engage with technologies of tomorrow, those who engage with products of tomorrow.
Again, many cues you've given us. Let's first talk about one of the aspects that you referred to, which is energy. We're, of course, in the midst of the West Asia crisis that has brought the conversation home in terms of ensuring energy security. Is this the best way forward in terms of having multiple options, a bouquet of options available for securing our energy, whether that's renewable, nuclear, conventional? Do we need all of them, or do we need to focus on a few?
No, we need all of them, because in my view, for example, nuclear is something which government has unlocked through the regulatory reform which they've done in terms of making sure private sector engagement can come in, more capital can come into that process. In addition to that, what you did not highlight was India is also a very, very large pool of bioresources. We can't forget that. We also have a marine ecosystem which also can be used for energy through the marine bioresources. So we need to continue to engage with on all fronts. The recent discovery of gas in Andaman again says that we have only scratched the surface in terms of making sure that we go offshore, utilizing offshore for also wind. I think, again, a great opportunity. So we have multiple opportunities on the front. I also would say one area which I missed out highlighting, I think this is also an area where biotechnology and space technology are going to play a big role. And we need to engage on that too. And what we are also seeing increasingly is putting solar panels up in the space, not just on the ground, and then using that to power many of the requirements, maybe the way we need to go. So these are all technologies of future, which I think India is well prepared as of now, or at least beginning to engage with. And we need to, as you explained, a bouquet of solution, not just one part of the one aspect of the solution.
There's been a massive push that the government has given in terms of spending. The latest budget, the numbers, 12.2 lakh crore rupees, again, massive figures those. The grounds that the government has often expressed is that the private sector is not doing its bit. They point towards how private sector capex is, again, stagnant at about 12% of the GDP. The question I want to ask end with is that, is there one critical piece of reform that is required from the government to unleash the so-called animal spirits?
I think it's already unleashed. I think this fact about private sector investment is stagnant. I think we have data to prove that the mega projects have been launched in the last few years. Take one sector like steel. I think we are about 220 million tons. We are talking about 300 million tons by the time we end with 2030. I think those are the numbers I remember offhand. So it's going to be massive creation of 70 million tons of capacity in such a short time. So we are building huge capacities here, and I think we need to continue to engage right across all sectors, that they all support the growth of India, the demand of India. If you don't invest, what will become? We'll become net importers in many ways. So I think this focus on making sure that public investments and private investments work together is the right approach. And private sector has started to put in capital. At least our study of all the projects from our economic team highlights that in the last 2 years, the momentum has picked up. And I'm very hopeful as we come out of the West Asia crisis, the momentum will gather a pace, and we will all invest more in both the public capacity and in the private capacity.
Right, Mr. Mukundan, thank you so much for joining us, for sharing that insight on not just the last 12 years, but of course, what the journey ahead may look like and what the challenges and the steps that the country needs to take in preparing for those challenges. Mr. Mukundan, thank you once again for sharing your insights with us, with our viewers. Well, Mr. Mukundan there giving us his roadmap of what's it's going to take for the next 12 years after having seen big milestones in the current 12-year term. But with that, it's time now for slipping into a very short break. But don't go anywhere. FICCI President Anant Goenka will be joining us on the other side. Welcome back. We are discussing the reforms under Prime Minister Modi government as he completes 12 years in office. Joining us now is with us Anant Goenka, President of FICCI. Mr. Goenka, thank you so much for joining us. The first question I want to begin with is that we've seen 12 years of political stability. What does that mean for the private sector, for growth, for consumption?
I'd say that absolutely, as you shared, it is stability that has stood out. We have grown and been the fastest growing large world economy for most of those 12 years during that period. So in addition to growth, there's been stability and great risk management, especially if you look at the last, say, 4 or 5 years post-COVID, the way we've been particular about our fiscal discipline. You look at our NPAs in banks having been under good control, corporate balance sheets in control. So the risk levels of India have continuously improved. And that's also reflected in the sovereign ratings that have seen continuous upgrades on a regular basis. But I'd say the area that has had maximum impact are the large structural changes that have happened during this 12-year period. Whether you look at GST 1.0, GST 2.0, which has increased interstate movement of goods, reduced the friction.
Hello, good morning. You've tuned into Power Breakfast on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague today, Rachna Dhanrajani as well. And Welcome, Rachna, as my beautiful co-anchor on the show of Power Breakfast. What a day, Rachna, to come in and start your first show as well for Power
Thank
Breakfast.
you so much, Winnie. Could not have asked for a better co-anchor than you for this.
But a great time to have you and a great day. And a great Monday is what we're expecting today on the D Street as well. And why? Because finally we are seeing at least some sort of a deal. United States as well as Iran have agreed to that deal. Hopefully we'll see that signing happening on Friday as well. And after that war of 3-4 months, we are finally seeing that move on. Hoping the Strait of Hormuz opens up soon as well. 19th of June is what they've said is going to be the date of signing. Obviously, we will watch out for what's happening on the Asia market front as well. So first, let's talk about that. And headlines, United States of Iran have agreed to sign a deal after their 4-month to end the war, with both sides declaring immediate and permanent termination of military operations on all fronts, including Lebanon. President Trump authorizes the toll-free opening of Strait of Hormuz on Friday, June 19th, and that's when the deal will officially be signed. Switzerland, Iran release the memorandum with details of the deal, which include a release of $24 billion in frozen Iranian assets and a requirement of the United States and its allies to present reconstruction plan worth at least $300 billion for Iran.
Brent crude prices plunged below 85 to a 2-month low after the US and Iran agree on a peace deal aimed at ending the West Asia conflict and reopening the Strait of Hormuz by the end of the week. Gold climbs to $4,300 an ounce, advancing for a third consecutive session on the news.
And Wall Street futures jump after the United States and Iran reach a deal to end the war. The three major indices posted a winning week, with sentiment bolstered by Friday by SpaceX record-setting initial public offer. The stock closed with the market cap of $2 trillion after climb of more than 19%. Markets in West Asia also trade higher. The GIFT Nifty is indicating a gap-up start for the markets.
India's inflation accelerates by 3.93% in the month of May as energy costs rise. This is largely in line with the CNBC TV18 poll, which expected inflation to be just above the 4% mark. But the pace of growth is still below estimates. Food inflation quickens by 4.8%.
Vedanta's demerged entities to list on the exchanges today under Vedanta Aluminium Metal, Vedanta Iron and Steel, Vedanta Oil and Gas and Vedanta Power. The listing will take place at 10 a.m. post the price discovery. Okay, those were the top headlines, but let's look at what's happening in the Asian markets, right? The 3-month war nears the end as US and Iran are signing that peace deal. Crude prices are down. We're seeing Asian markets have opened up with that sharp cheer as well. Taiwan index is holding on to gains of 2.7%. We have Hang Seng that's holding on to gains of 1.3% as well. We have the Nikkei, that's up more than 5%. Kospi is up more than 4% as well. We're seeing ASX 200, that's the Australian index, that's also up 1.3%. Like you can see on your screens, all of them trading with sharp gains in the trading session. That positive cheer comes in. And let's look at the Nifty implied open. We had already seen that coming in for the Nifty. Friday, second half of the trading session, we saw a very sharp spike up. Nifty managed to close above the 23,600 mark on Friday. And obviously, today we are indicating a 300-point uptick as of now. Just a few moments ago, it was 285. So we are seeing that cheer on the D Street as well, Rachna.
Well, on to updates from West Asia. Then the United States and Iran have reached a deal to end their war. US President Donald Trump said on social media as he ordered the reopening of the Strait of Hormuz, ending the US naval blockade. In his Truth Social post, Trump said the strait would be open toll-free and that the US naval blockade would also end. In a second Truth post, he added that the opening of the strait and signing of the peace deal on Friday could bring back oil flow to both ends of the region. Now, the agreement was reached despite an Israeli strike on Lebanon on Sunday that drew criticism from both Iran and Trump.
And Pakistan's Prime Minister Shehbaz Sharif said that on a social media post that there will be an official signing ceremony on Friday in Switzerland. The Prime Minister also said that the deal meant immediate cessation of hostilities in Lebanon and lauded Qatar's as well as Saudi Arabia and Turkey's efforts in reaching the agreement. There will be a series of meetings this week to lay the foundation of this deal. Now, the state media channels in Iran also confirmed the deal, saying that the US was forced to sign a memorandum to end the war. And the Deputy Foreign Minister of Iran told the media that two immediate decisions to be taken were on immediate and permanent end of war and military operations on various fronts, including Lebanon. And the second one was lifting the US naval blockade in the Strait of Hormuz. Now, Iran also released a memorandum stating that sanctions against the country be lifted, a portion of Iran's frozen assets be released, and Iran's enriched uranium continues to remain within Iran. Iran also claims that the agreement includes a $300 billion compensation fund for reconstruction purposes.
Well, this US-Iran deal has definitely brought some news from the commodities market. To get us all the updates from the commodity space, we have now Manisha Gupta.
Hi. Thank you for that. Well, yes, absolutely. As you mentioned, a lot has happened between US and Iran, and that absolutely seems to be easing the crude oil prices. Last week was a decline as well, but we are trading 4.5% down in the Asian markets right now. That's a 3-month low. The last time we saw $83 and $84 a barrel for Brent was on 10th of March. So the US and Iran reaching a peace agreement aimed at ending conflict. Strait of Hormuz could reopen by the end of this week when we see that signing ceremony in Switzerland on 19th of June. What the agreement includes is provisions for dismantling Iran's nuclear program and economic incentives if Iran meets its commitments. So that's a lot that the markets are looking at right now, and that has eased the prices. Remember, it was in the month of April that we saw crude oil prices going to $120 a barrel as well. So from 120 to 84 is quite a decline that we are working with in sense of crude. And in the meanwhile, you have seen the metal prices gain. So gold is up 3%, silver trading 3.5% on the higher side. Copper prices now are up 1.5%. US and Iran reaching a peace agreement has been quite positive for the metals there. Markets will also watch out for the Kevin Watch holding its first Fed meeting in this week itself. And apart from that, you have monetary policy meetings from Australia, Japan. So promises to be a very, very loaded week.
Absolutely promises to be a very, very loaded week. But as of now, today, at least some news in terms of Brent crude oil prices falling. Positive for a lot of players on the domestic front. But Manisha, thank you so much as always for joining us in the morning. On that note, time to slip into a very short break. After the break, we'll come back and tell you how these overnight cues are going to impact our Indian markets. Stay tuned in for that.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now, how will overnight Qs impact the Indian market? We have our research team joining in with how the trade setup looks like today and the stocks that are likely to be in news. First up is Hormaz. Hormaz, take us through all the market cues we need to watch for today.
Good morning, Rachna, and what a day for you to debut on air and also for the markets as well. Continuing from where we left off on Friday, the GIFT Nifty is up well over 250 points. Well, most likely we open close to that 24,000 mark on the index, and that is now going to be the big point, the big talking point that we need to watch out for. An important trigger today, the fall in crude oil prices, of course, the result of which is the Brent down around 4%, NYMEX down 5%. So all of the oil sensitives come into play today as well, and that is courtesy of the US-Iran deal announcement and the deal which will now be officially signed on the 19th of June. What do you watch out for now? As a result of this fall in oil prices, the oil marketing companies, Indigo, the West Asia exposed stocks like L&T, all of which went up on Friday as well. You watch out for the impact of the falling oil on the appreciating currency, on bond yields as well, and therefore on the PSU banks. And in fact that the dollar index is declining. The metals as a sector which was underperforming on all through last week, that comes into the spotlight today as well. On Friday, the index broke past 23,500, which was a big positive. We closed above 23,600, and now the first June high of 23,733. Of course, we open well above that. We need to close above that too. That is going to accelerate the pace of the recovery because 23,800 is now the big important level to watch on the upside. The bulls will now hope that that 23,500 level on the downside is not broken. That becomes a firm base for the index to watch out for. The big outperformer of last week was the Nifty Bank. The bulls will hope that continues as well. The index was up around 4% last week. 57,000 to 57,500 now becomes the range for the Nifty Bank to watch in today's session. But the bulls will hope that the one index that needs to put its hand up this time is IT. IT, even after the entire market went up on Friday, it went nowhere. It's down for 8 days running, and if IT puts its hands up along with banks and Reliance Industries as well, that will accelerate this market recovery as well. Of course, for Reliance, it is a big week as well, considering the AGM on Friday, and of course of the other important events to watch out for, like the Fed meet on Wednesday and a lot of others as well. But for now, it's a good news that's come in for the markets. The GIFT Nifty is cheering that as well. The important level to watch on the upside, 23,800 and 24,000.
Okay, Hormaz, thank you so much for that. But let's also talk about which are the important stocks to keep on your radar this morning. We have Ria to take us through that. Good morning, Ria.
Well, good morning. Starting off with three pharma names that will be in focus today. There's Dr. Reddy's, which has become the first to launch a generic version of the oncology drug Bosulif in the US with a market size of $254 million. Aurobindo Pharma will also be in focus as they have received an OAI from the US FDA for their arm Eugia Pharma after receiving 11 observations earlier. Kim's will be in focus as they have approved a preferential issue of warrants to promoters at rupees 777 per share for a fundraise of 600 crore rupees. And moving away from the pharma names, Nestle India will be in focus today as the company has rejected allegations regarding the presence of infestation in Maggi noodles, and the company has also said that they are yet to receive the complaint sample as the complainant is unreachable at this point in time. Misho to remain in focus as they will be buying a Kirana Club for 202 crore rupees. Ather Energy has given its board's approval for a 2,500 crore rupee fundraise, out of which 1,500 crores will be through a QIP, and the remaining 1,000 crore rupees will be through foreign currency convertible bonds. Apart from this, JSW Energy will also be in focus as the company will be buying a 300 megawatt thermal unit for 1,410 crore rupees, and this is to be the deal is closed, expected to be closed by the end of July this year. NLC India will be in focus as they have emerged the preferred bidder for critical mineral blocks in Telangana, and further their JV company in Uttar Pradesh has also started operations of the last 660 megawatt of their facility, and Vedanta will also be something that will be in focus today as 4 demerged entities will be listing today. And apart from this, the entire market will of course be reacting to the announcement of the US-Iran peace deal.
Okay, thank you so much for that, Ria. But on that note, let's also go across to Sudarshan, who's here to tell us the important cues in the world of F&O. Good morning, Sudarshan.
Good morning, Vinny. So it's no more Monday blues. Across the board, we are seeing green and at one place we are seeing red, and that's the positive, the biggest positive for us, or say for markets like India. And the decline that we are seeing in crude prices now, it's at the lowest levels that we have seen in the last 3 months. Brent is now back below $84 per barrel. Now, another positive part is that on Friday we have seen huge short covering across the board, from the levels of 23,300 to as high as 23,600 across the board. We were seeing big call writing and major short covering that will continue even today. Horbaz was talking about 23,800, very important level. Yes, it is. And in all probability, Nifty is likely to open above that level and may hold to the levels above 23,800. Now, not only 23,800, the important level will become 24,300. Now, some of the important indicators. I told you crude, it's a 3-month low. Brent is back below $84 per barrel. On Friday, we saw sharp appreciation in rupee, around 65 to 67 paise against US dollar. That is also taken positively. And now the biggest positive is India Volatility Index. It's back below 15. Do you know, this level was ahead of the war on 27th of February, and that's one of the major positives. Now coming to the FI flows. After continuously, we used to see that FIs have been selling. But on Friday, in the index futures, they have bought, even the stock futures, the wrong figure, it should be buying. They have bought almost 900 crore. Long side, they have added more than 3,600 contracts. Look at the short side. Reduction is almost 18,000. They remain heavily shorted, but nevertheless, on the long side, exposure has increased to 12%. Come to the options data, very interesting data. On the put side, 23,400, 23,500, all the put options have seen huge increase in the open interest, but premium has taken a sharp knock. It has seen a sharp fall. On the call side, the biggest or most active option was 24,000. So, immediate 24,000 would be very important level. Next resistance comes around 24,000. That's the reason I've taken support 23,540. That's your 20 DMA. First resistance 24,000. Second resistance comes around 24,300. That's your 50 DMA. One stock is in the band, that is Keynes. Some of the stocks that will be in focus, Muthoot Finance, because gold prices have seen a sharp increase. OMC, all marketing companies of IOC, BPCL and HPCL will be in the focus, and crude fall is positive for them, and while upstream oil companies of ONGC and Oil India might react negatively. And lastly, Radico and PG Electroplast have been seeing fresh longs.
All right, thank you so much, Sudarshan, for that. Those are the key levels and key stocks to watch out for. But now let's slip into a break. Up next, we get you updates from the world of artificial intelligence and technology in our segment AI Pulse.
Welcome back to Power Breakfast on CNBC TV 18. Now let's get you the latest update in the world of tech and AI in our special segment AI Pulse. Rachna has moved to the wall to take us through that. Rachna, over to you.
Well, the first up is the United States that has shut out the rest of the world from two of Anthropic's most powerful AI models. The Commerce Department issued an export control directive on Friday, ordering Anthropic to suspend all access to Fable 5 and Mythos 5 for any foreign national, including the company's own employees outside of US. Anthropic had no choice but to disable both the models for all customers, and this was shortly after they rolled out after months of anticipation. The trigger was a jailbreak claim. A third party had reportedly found a way to unlock Mythos' cybersecurity capabilities through Fable 5. Anthropic disputes the severity, saying the same technique works on other models, including OpenAI's GPT 5.5, which faces no such controls. Senior leaders are now in Washington trying to resolve the standoff. Then there is SpaceX that made history on Friday. Elon Musk's company raised $75 billion in the largest IPO ever, closing up 19% on day one at a $2.2 trillion valuation. Musk is now the first trillionaire of this world. He also said he will take the company to the moon. Listen in.
You know, while the other aerospace companies, they build good rockets and everything, they were simply not pursuing the technology that's necessary to make life multiplanetary, to make Star Trek, to make the exciting science fiction futures that we've read about real. And that's what SpaceX is all about, is to take the fiction out of science fiction and create an exciting, inspiring future for everyone. We want to be able to take anyone who wants to go to the moon, anyone who wants to go to Mars, or anyone in the solar system, and maybe beyond the solar system at some point.
Interesting there. But with that, we are absolutely out of time on this edition of Power Breakfast on CNBC TV 18. Nifty implied open indicating a 300-point uptick for the Indian markets. But up next, your Bazaar Morning Call to take you through more of that action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. Well, you know, it's been 3.5 months now that the US-Iran war started. It was on track to becoming 4 months, but thankfully, hopefully, fingers crossed, this is it. We have a deal. And, you know, oil's down sharply. GIFT Nifty is indicating a positive start. Let's hope all of it stays like this and there's no more sort of, you know, hurdle you know, a problem which emerges from here on. So, I mean, the straight, as President Trump Mangalam said, in a pretty dramatic, is always dramatic. He said, well, let the engines of the world's ship start, let the oil flow.
Let the oil flow. And that, you know, if there was a perfect weekend, if there was any, it had to be this one. Yeah. One, on the market side, yes, good things happen. On the sports side, great things happen. And if you're a basketball fan, the NYC Knicks winning it after 50 years plus, you know, everything has just happened. The only thing that we'd want now, if at all, are two things. One, the rain gods to thank us, and the second part is the FIIs to return. Whether that happens or not, you know, that's for another day. But today and this week looks like a fairly good one, so long as everything that happened over the weekend sustains.
Absolutely, and I think Nigel is also with us. He's not here in the studios, but he's at the BSE. It's a big day for Vedanta companies as well, as they all come to the market. I mean, all the other separate units. And Nigel is going to be sitting down with the top boss at Vedanta, Anil Agarwal. Nigel, morning.
Well, morning, guys. You know, Mangalam mentioned a couple of factors. I just spoke to my daughter, you know, as I mic'd up for the show, and she told me, Papa, it's raining. So hopefully it's, you know, the rain gods are here. Our problems, hopefully, are minimizing. I would trust her on that one because she was quite excited.
Nigel, daughter is always special, aren't they? But, you know, what a wonderful morning it looks like for the market. If you look at the Asian markets as well, across the board, we've seen big gains come by. And add to that, we forgot, speaking about this SpaceX debut as well, nearly $2.1 trillion on debut. You have the Taiwanese index up around 2.5%, the Hang Seng up by almost 1%. We have the Nikkei, which is up by 5.5%, and the Korean markets up by about 5% this morning as well. So across the board, big gains coming in. And for our own markets itself, we saw a near 500-point rally on Friday. The market moved towards that 23,600 mark. And to start things off, we might be opening around that 24,000 mark. So where do we go from here on? What does the Nifty Bank do? And more importantly, what does the Nifty IT do? Would be important imponderables. But 325 points at the open after a 500-point rally. Looks like bulls are in charge. Prashant.
All right. No, absolutely. So let's take it from the top, right? And we're simply calling it the fact that we have a deal. And, you know, good to say that because there have been so many deals which have been no deals. There have been so many advancements which have had to be backed down. But, you know, as we've said many times in the past, we will know when we have a deal, when all the principles involved, which is US and Iran mainly, but I mean maybe Israel as well, they're all on the same message. And it looks like, except Israel, the other two are on message. So, you know, I'm not going to put out the Truth Social posts because it'll take a fair bit of time. I'm going to just put out the key points of what each party essentially is saying. And let's put out the first one. President Trump saying deal with Iran is now complete. Let the oil flow. So that's the critical part, right? Now, Iran, the Supreme National Security Council saying that military operations on all fronts, including Lebanon, will end immediately. And of course, I mean, saying that the naval blockade, they're referring to the US naval blockade, which will also end. And you have the Pakistani Prime Minister, Shehbaz Sharif, and Pakistan presumably has played a role. It's called, the Iranian posts basically say the Islamabad deal in that sense. So Shehbaz Sharif saying that the peace deal signing ceremony is on Friday. So that's what we've heard. The big question, at least to my mind, is very simply put, will Israel stand for this? Because the Israelis, Benjamin Netanyahu, essentially are extremely, they will be extremely unhappy. They've been pushing President Trump to restart the war, restart kinetic action, strikes and whatnot. and of course they're in Lebanon, and that has been one of the sticking points. Nuclear enrichment, etc. apart, this has been a big sticking point. What happens in Lebanon? Iran has said, well, Lebanon is very much part of the deal, and Israel must vacate and pull back their forces from the occupied Lebanese territory, and of course stop military action there. Will Israel stand for it? We'll find out. But that's a real one. It's a real risk. Now, oil prices are down sharply, right? So prices down 4% to $84 a barrel right now. So under 84 actually. And if you look at Friday, because there was some sense of this, it was not finalized, it was not confirmed, but it was looking like a deal is brewing. And on Friday, when US markets were trading, that perhaps it'll be on weekend, it'll be on Monday. It was looking very, very imminent, right? So prices from over Friday and today are down 7% in total, which is pretty meaningful. Now, I just want to remind all of you, why is this all consequential and important for India? And, you know, not the big numbers, but just three commodities for us in terms of the dependence on the Strait of Hormuz. So 50% of our oil imports, by the way, we import 85-90% of our oil imports. Before the war started, before late February, 28th of February, 50% of our oil came through the Strait of Hormuz. 60% of our LNG came through the Strait of Hormuz, and 100% of all the LPG that we got imported came from the Strait of Hormuz. So this is, it's a big relief. The rupee will be in focus. It's got help from, of course, the Reserve Bank of India with the FCNR and the ECB and all of that. But I think, and of course, I mean, we saw a big move on Friday, 95.11. But I think this is, of course, much more consequential if this halt to all of this sort of, conflict is permanent, and, we can kind of sort of rely on it. We'll talk more about sectors, and we'll talk to companies, and we'll talk, but it's pretty obvious, right? Which are the sectors which see relief and big relief? Oil marketing companies, right? And this is not true in India, but, sovereign oil companies will see big relief because governments have taken the hit. Some has been passed on to consumers, but if the cost of the input goes down substantially, I mean, that's a big bump. City gas distribution companies, aviation companies, paints, tires, I can go on, but I mean, the list is obvious. It's no rocket science. The S&P 500, I mean, just a quick bit. It was also a pretty big day because SpaceX made its debut. It was a winning debut in that sense. There were lots of doubts about what will happen, but no real problems at all. And the S&P closed out its 10th winning week out of the last 11. It's been up 10 for the last 11 weeks. So, US also is looking strong. It's not as if, the US is starting to look very, very wobbly, which have kind of raised doubts as we start our session. GIFT Nifty, I think, is indicating a 350 odd point higher start. And it's indicating a start at about 24,000, right? So these are the levels on the spot, which I'm watching out for. So the targets are 23,700. That's the first target. It's nothing but the spot on the trend line, the downward sloping trend line from the past two highs. So 23,700 is the first. And then the 24,077 level. Most likely, I think we make an attempt towards the high, which is 24,077, before we look any further. I think then, of course, 24,300, etc., etc. But this is the first one, which basically 24,77 is the level beyond which, I mean, I think the downtrend becomes, we once again start to call it an uptrend. Immediate support is 23,550. So it's a pretty good session to report on as we begin this day. Well, Nigel has got the F&O stats and the numbers the positioning more importantly, because that's going to matter on a day like today. How much of boost will we get from short covering? Nigel, take it away.
As I mentioned the last couple of trading sessions, some of those headwinds are receding, and it's evident, right? Because if there is a deal that's going to be absolutely finalized, now it's been announced, then in fact crude oil prices head down back towards probably sub $80 per barrel mark. And as you mentioned, India's dependence on oil and gas space is tremendous, and the shutting down of the Strait of Hormuz is obviously a big negative. So that part of the equation is getting sorted out. The rupee, the RBI and the government of India, they put those measures in place, could attract anything between $35 to around $50 billion odd, which has helped the rupee stabilize. At one point of time, it looked like that 97 odd mark was going to get breached. So that's shown some stability, which is good news. Now all eyes on the FI flows, because the outflows continue. Remember, in Friday's trading session as well, we had a big rally. They sold close to around 1,100 crores. Though the net institutional number was a net buy number of close to around 4,000 crores, because the DIs, they put in the big money. But there's a couple of positives with regard to this FI number. It's coming at around 1,000 crores. Well, that's the lowest number we've seen all the way since the 27th of May. And not just that, if you compare the average selling for the month of June, it's around 5,400 crores odd. So the FI selling has come down. Now, with the rupee tailwind as well as the global cues, you will want to see some positive FI flows. Let's see whether or not they come back this week or maybe today as well, because the stage is set. They have been underweight India, and there is a good case now that maybe, in fact, those outflows stop and turn into inflows. Moving to the options data as well as the futures data, the FIs, they covered shorts. And we have been mentioning this point. A net short market actually gets some legs when those shorts get squeezed on the wrong side. And that's precisely what happened in Friday's trading session. The short positions went down by 18,000 contracts. There was long addition of closer on 5,000 contracts. So the swing factor from the FIs itself have been closer on 23,000 contracts in a single trading session. And that's why in the last few days, from having their net short positions at around 2.8 lakh contracts, the net short positions have come down to around 2.45 lakh contracts. So massive short covering is what we have seen. And the clients that were aggressively net long, well, they have gradually unbound some of those long positions. But as we mentioned in the past, a net short market from the FI perspective, with the clients being net long, that's actually a good combination. There was not just covering on index, even on stock futures, if you look at it, the shorts covered out and there was some long addition. And the cherry on the cake is after a while, we're seeing some aggressive put writing, telling you that lower levels will get defended. So in terms of levels that we're looking at, we have crossed the 20-day MA. The 50-day MA is what we breached as well at the start of today itself. I think all eyes on the 100-day MA. That comes in at around the 24,300 odd mark. The last time around, we attempted to move higher. We got rejected at around 24,300. So I think that becomes the next level of resistance on the downside, 23,500, which was earlier resistance. That becomes a bit of a support. And the Nifty Bank has been in spectacular form. I expect that index to continue to lead the way. Now all eyes are on the all-time high, which is closer to around 5,000 points away from these levels. So that's going to be the important mark. For the Nifty Bank, the 61,770 odd. We're bracing for a super trading session, a good start. Hopefully by the end of today as well, things will look as good. Back to you, gentlemen.
Absolutely, take that point. Hope that by the end of today's trading session, things will look even better right now as we speak. We are seeing a spike across all commodity indices. We're seeing a spike across a big move in the Asian markets. And now as we speak, the Nifty Bank will be extremely crucial to track today because directly linked to the macros. So let's get in Ed Yardeni, the president of Yardeni Research. We also have Arvind Sanger, managing partner at Geosphere Capital Management. Thanks a lot, gentlemen, for joining in. Ed, let's start with you. There was uncertainty on when the deal happens, when the war ends. Now, for all practical purposes, and if you look at the price action as well, it looks like the deal is here. So what happens next?
They clearly are endorsing the concept that a deal is going to happen, that it will be signed on Friday. And this it takes a lot of pressure off of a lot of countries that are oil importers. I think on a global basis, this certainly benefits emerging markets, maybe some of the developed economies that import a lot of oil, like Japan, South Korea, Taiwan. So this is really just a signal that the global bull market continues. Leadership may continue to be the foreign stock markets. After we saw some leadership during the war occurring in the United States, the war made the U.S. look more attractive because we are oil exporters, and the rest of the world, most of the rest of the world, imports oil, with the exception of the oil exporters, and of course they were mostly blocked at the Strait of Hormuz.
Gentlemen, morning. Arvind, if I can use ye to hona hi tha, if I can use it. The only question was, and Ed, that's a phraseology in Hindi, which is that it was inevitable that this was supposed to happen at some point. We didn't know when, right? Time was the issue here. It was like a match without an innings. Arvind, so it's a big relief for India, right? I would just put out the numbers: how much of LPG through the Strait of Hormuz, how much of natural gas, how much of oil, and those are big numbers. Of course, we diversified away, and the cost was higher. So for India, this is certainly a big macro relief.
It definitely is. But let's think of the world that existed before this war began. If we think about the way the world existed before this war began, emerging markets in Europe were hugely outperforming the US. This war has, obviously created a huge diversion, and U.S. as one of the energy superpowers was the winner. What has happened in the background is AI has moved further along. And so the trade at the beginning of the year was to buy the AI winners as well as European and other emerging markets and developed markets. And I think that trade can reappear, although US obviously still has the emerging markets. It still has the AI play. But I think in the Indian market and other emerging markets should benefit. Now, India had suffered a little bit in the early part of the year, even before this war. It was lagging. The question now remains, on a global basis, has enough money left India, and has India underperformed enough on a relative basis that it becomes relatively attractive? And how is the growth story in India once the storm clouds of energy prices going up and energy shortages showing up have gone away? So I think I'm hopeful, but I'm also going to be somewhat cautious to watch how the Indian fundamentals play out beyond the relief rally in terms of actual economic data.
Right, but fundamentals, were impacted largely because the war when it came to the raw material prices, right? Demand wasn't a question. In fact, if anything, it was only seeing some improvement coming by because of the GST-led cuts and everything that the government had done. And now as well, as we speak, a lot of the companies are saying that volume growth continues. And to add to that, we will have an element of price growth. The only concern was around the margins. So given the sort of underperformance that we've seen in India already, the FII outflows, etc., and improving fundamentals, do you think there is case for India to outperform from here on?
I think so. I think financials, I think some of the domestic consumption facing, those are areas that would be interesting. I still remain somewhat skeptical of sectors like IT, which have structural headwinds. But there are a lot of other sectors that are more domestic facing that certainly look like they could run. And those would be important for the overall index to outperform.
Ed, what do you make of, the way emerging markets should react to the news and also the AI trade? And in light of that, the underperformance that India has seen already, the government and the regulators have taken steps to stem the decline in the rupee as well. So all these factors, do you believe, should lead to incremental positives for India, or maybe, that's not happening in the very near future?
Well, I think emerging markets, generally speaking, as we said, clearly benefit from the end of the war. The emerging markets that produce oil clearly now are going to be able to sell it in markets around the world. They won't be constrained by the blockade of the Strait of Hormuz. And countries that import oil obviously will benefit. Now, India clearly stands to benefit. As your colleague pointed out, India gets a tremendous amount of energy products coming from the strait. But at the end of the day, that just means we're kind of back to where we were before the war, and India wasn't really performing all that well. I think partly India had a few years where it really was a major outperformer, and then investors looked around and concluded that not as much progress has been made on reforms as they would have liked, and they moved on to other areas to invest. I think right now, India is not really competing with China. China's returns in the markets have been also very subpar, but the real competition is, as you said, the AI trade. And in emerging economies, you can certainly continue to play that with South Korea and Taiwan.
Ed, the SpaceX debut happened successfully. Any implications from here on? How do you think market behaves?
Well, I've been talking about this decade being the roaring 2020s, and I can't think of a better example of the roaring 2020s than the SpaceX deal. It's 100 times revenues. It's extremely expensive, but they had no problem selling the deal, $75 billion. Now, $75 billion is not that much when you consider that the market cap of all the stocks in the United States is about $100 trillion. So it really is a drop in the bucket. But the reality is once a lot of the shares are free to be sold by the insiders, that's that's potentially something like $2 trillion worth of stock. And that's obviously could be a concern in terms of volatility. But right now, investors are buying into the idea of this company making a lot of money, putting data centers in space, maybe colonizing the moon and colonizing the Mars. If I had an opportunity to meet with Elon Musk, I'd want to tell him that there's really nothing in Mars that's worth going to. There's plenty of opportunities right here on Earth. But again, investors kind of bought into it. And it makes me actually a little nervous to see so much excitement and overvaluation of this particular stock as an indication of a wee bit irrational exuberance.
I see. Well put. Arvind, your thoughts on this? You know, the US now, if you look at the MSCI All World Index, right, it's about 65% of that. US, single hand. I mean, it was always extreme. I mean, 2 years back, we were talking about how this is an extreme number. It's become even more. I mean, SpaceX now, of course, and the others will join. So this is, I mean, this trend or whatever you want to call it is here to stay, Arvind, you think?
No, I think these extremes happen at the top of bull markets where US market cap to GDP, US as a percentage of global market cap are all at levels that are very, very bubbly. But, you know, I don't know what's going to pop this bubble, but the US is clearly priced for perfection. As Ed was just saying, you know, SpaceX valuation, it's nosebleed to say the least. And if you look at, you know, the Mag 7, I mean, I am amazed that the tech analysts advertise these companies as tech companies. These, you know, I invest primarily in companies that are in the asset-heavy business. And when you're in the asset-heavy business, no matter how fast you're growing, you don't trade at 25, 30 times earnings. And these companies went from asset-light to asset-heavy. And I think eventually the market's going to wake up and realize that no matter how big the pot of gold that people imagine at the end of the rainbow is, not everybody's going to get the pot of gold, because you also have Anthropic and you have OpenAI coming. So some people are going to be losers, and a lot of money is going to be spent. So you know, again, I'm answering your question, Prashant, in a long-winded way. But what I'm saying is these are historic valuation multiples. I feel much, much more comfortable putting money in emerging markets and Europe and other places where valuations and hopes are not built as sky high as they are in the US.
And that includes India as well, Arvind?
Yes, now it starts to include India because India has been, you know, it has become cheaper just by not going anywhere for a while Korea, Taiwan, others have moved a lot.
Well, we need you know, that thought process to sink in across the board, right? And we'll see if it's reflected in flows and whether that will start to change. In any case, we don't know how much this will help in terms of foreign flows and the enormous foreign selling which we've been seeing here in India. But it does come at an important time because local inflows into mutual funds, the retail bid was starting to look a little shaky, especially last month. So if FIs continued to sell as much and the local bid became a little weaker, the numbers stopped matching and then the market perhaps would have cracked. There was a real risk of that. I don't know if this changes it, but I think it comes at an important time. Thanks very much, both of you, Arvind and Ed, for joining us. Good speaking with you here on CNBC TV 18. We'll take a break. We're back. Interactions lined up on the other side. We'll have at 9 o'clock, Suril Singhani of Abacus Asset Managers joining in. He, of course, talks to us about what to do now in this market. Prashant Jain, a 3P Investment Managers, our Market Master of the Day. 9:30, we bring you another market conversation with White Oak Capital's Prashant Khemka. 9:40, Prestige Estates joins in on with the outlook. And 10 o'clock, Rakesh Arora of GoIndiaStocks.com as Vedanta's 4 new demerged stocks listed today. Towards the end of the program, Lata in conversation with Macquarie Capital, Suresh Ganpati, on the impact of the FCNR deposit. And of course, the change in environment this morning that we'll have because of the US-Iran deal. Stay tuned.
Right, we take a short break, but a lot of stock-specific action to track. We'll get to it in just a bit in our special Top 10 segment. But today we're looking at Dr. Reddy's, Aurobindo Pharma, Kim's, Nestle India, Misho, Eicher Energy, JSW Energy, Gold Sensitives, and Hindustan Zinc. All of them on our radar on the back of positive news flow. Mixed view, as always, on crude sensitives.
Welcome back. You're tuned in to Bazaar Morning Call, and we're bracing for a very, very strong start to the trading session. But there are individual stocks that are on our radar. Let's hop across to Ekta. She's here with all the pharma-related names that she's tracking. Morning, Ekta.
Morning. Well, I'll start with Dr. Reddy's, which is in focus because they've announced the first market-to-market launch of an oncology drug, which is Bosutinib tablets in the US market. They have a size of around $253.8 million on this particular drug. Aurobindo is in focus because UGR Unit 3 has been classified as official action indicated status. Remember, it was inspected earlier this year and had received 9 observations. So the street was bracing for some bad news possibly on this particular unit. Now, Kim's is also in focus because the board has approved a preferential allotment of around 77 lakh warrants to the promoter group, and that aggregates to around 600 crores. Warrant issue price is 779 rupees per warrant and is fully convertible into equity shares within 18 months.
Right, Rita, thanks a lot for that. I'm looking at a couple of consumer names. I'm looking at Nestle. Nestle was one of the weaker stocks on Friday. You know, the intraday of Friday comes up on your screen. And despite the Nifty actually doing extremely well, that stock was among the top Nifty losers, down 3%. And this, as there were reports of some sort of infestation in the Maggi noodles packet that was found. And the company has now informed the exchanges, clarified that they've categorically rejected any allegation regarding the presence of infestation in Maggi noodles. The reason why they say that is because they're yet to receive the complaint sample, because the complainant is unreachable. So the allegation that came was from an unverified account. Add to that, the company has also made a detailed representation supported by all relevant facts, quality records from batch and market samples, all of them to the FSSAI. So they're steadfast on their claim that Maggi is safe and not infested, and any sort of complaint that has come is strongly a rumor from unverified and unreachable sources. So all these factors should give a relief rally to the stock, but more importantly, from a Nestle standpoint, they will definitely be twice sure about this as against earlier, after especially what they faced with Maggi in the past. So one has to believe or take the company's word for it, and which is why we'll probably see an improved move in the stock after the decline that we saw on Friday. On the other hand, we have Meesho, which has made an acquisition, a 202 crore acquisition of Kirana Club. Now, you look at their revenues and you say, okay, they did just about 15-16 crores in the last year, but that's a jump. Even if this doubles this year, they've acquired this company at around 7 times sales multiple. Slightly expensive, but a small deal, but an important one. What does Kirana Club basically do? It operates a B2B e-com marketplace which connects all the Kirana and small retailers with FMCG brands. They enable retailers to discover, compare and order FMCG grocery products, basically tier 2, tier 3 and tier 4 along with rural India, where you can order FMCG products if you're a store owner through this app. They have about 4.1 million registered users already, and the revenue that this company generates is through commissions and advertising services. While it will continue to operate independently, what are the kind of scale synergies that Meesho bring will be extremely crucial to track. Growing with just light green on this because of the expensive nature of this acquisition, but green because the direction is positive.
Absolutely. Mangalam, thanks very much for that. Well, let's focus on Eicher Energy and JSW Energy as well. Sudarshan is here with details. So, morning.
Morning, Prashant. So, Eicher Energy Board has approved raising up to rupees 2,500 crore. Of that, 1,500 crore would be raised via QIP and another 1,000 crore would be raised via equity issuance, FCCBs or via other securities. On the same, Money Control has reported that company is in talks with at least 3 investment banks for its first capital raise since May 2025 IPO, and companies plan to launch that QIP at least in the month of July and looking to use the proceeds on working capital, R&D, sales and distribution. Next stock in the focus is JSW Energy. Company is in agreement to acquire Maruti Clean Coal and Power for 1,410 crore rupees, and this deal is for 300 megawatt thermal power project in Chhattisgarh. And now company believes that this acquisition would support or would aid in company to achieve the 30 gigawatt capacity target that it has given for 2030. I'm going with green for both the names.
All right. So thank you very much for that green in both names. Well, commodities will be top of mind, right? And oil and gold and, actually so much else because oil sits at the center crux of all of it. Manisha, morning.
Morning, and thank you for that, Prashant. Well, absolutely. 4.5% of a decline is what we are working with for the crude oil prices. This is after 6% of a decline in the previous week as well. So that brings us to the crude oil prices, which are trading at a 3-month lows right now. And the money seems to be flowing into the shorts as well. Remember, the last 1 month or so, crude oil prices have been so volatile that we've seen open interest continue to decline onto this one. So much so that the 2026 year-to-date open interest is the worst on record. But then, as I said, the money is flowing in, and especially towards the shorts right now. The U.S.-Iran reaching peace agreement aimed to end conflict is what the markets are working with. The text of the deal is going to be released in signing ceremony in Switzerland on 19th of June. So it's going to be a choppy, but with a bias towards lower side in sense of crude prices. And it's not just about crude as well. Heating oil is trading at a 3-month lows. You have gasoline prices declining to 8-week lows in the Asian markets right now. And everything that is related to energy, for example, palm oil or sugar, which is into ethanol and biodiesel, also has declined to a 2-month low. So there has been a knee-jerk reaction and immediate decline with everything that is connected to energy.
Take that point, Manisha. Thanks a lot for that. A knee-jerk reaction and an immediate decline as we speak. 83 on the crude right now. Take a short break, come back. We connect with Dharmesh Kant of Chola Securities for some fundamental stock talk.
Okay, welcome back. It's a big day for Vedanta as well, and lots of Vedanta shareholders will watch this closely. The 4 demerged companies will make it to the market today. Nigel, take us through the various businesses and what should we expect?
Well, Prashant, over the last 3 years, I've been explaining these businesses, and today is the day, right? Because finally, you're going to be having 5 listed entities of the Vedanta Group. 1 is already listed and 4 more will list. That's the aluminium business, the steel and iron business. You'll have the power business as well as oil and gas. So those are the 4 verticals that will list today. Couple of points to know. There'll be a special trading session up to 10 a.m. And at 10 a.m., you'll be having listing and trade will take place on all these 4 entities. Also, you need to note that the stocks will be in trade to trade, which means restricted trading for the next 10 trading sessions. As is the normal course of action when a company relists after getting demerged out of the entities. You'll be asking, why did they do this in the first place? It simplifies the group structure. An investor can pick and choose the business that he wants to invest in. From a promoter perspective as well, they can choose if they want to get rid of any of those businesses. Basically, it gives some flexibility. It's more tax efficient. It helps in capital allocation as well. What about estimates? If you just pull up a chart of what Kotak as well as Nuvama put out in terms of their target prices, well, you can clearly see that the aluminium business, that is what shareholders wanted very, very badly, because now you have a clean aluminium play that will list, and you put it, all the other entities are relatively smaller. They could list anything between 25 to say around 50, 60 rupees or thereabouts. So you'll have, the steel and iron, the power as well as oil and gas. Why is the aluminium business so important? Because it's giving that volume growth option. Remember, Hindalco is at around 1.35 million tons of capacity. Vedanta is already at around 2.6, and they have a trajectory already set out to around 3 million tons. So there is volume growth. Besides that, there is backward integration as well. Remember, the alumina refinery is going to be ramping up, as is the case with their bauxite as well as coal. So because they're getting backward integrated, the cost of production they have guided, that will come down to around $1,550 to around $1,600 per ton. And that's going to help them big time, particularly in an environment where aluminium prices are strong. You'll be worried the last few trading sessions, actually aluminium has corrected a little bit because the peace deal was likely to be announced, which is now announced. However, most brokerages are working with $3,000 to $3,200 on a per ton basis. So even if it corrects from here on, there is still cushion because estimates are factoring in much lower aluminium prices. Finally, you need to keep in mind some risk as well. In the past, the company has done intercorporate lending, which hasn't pleased shareholders. They've also, sometimes there's an eye on the royalty rates, which have been more or less, stagnant for the last few years. And promoter entity, they have been supplying some stake in the market as well. So we'll have to highlight some of these risks and we'll ask the management about them as well. The promoter entity, though, is in far better shape. Vedanta Resources, at one point of time, the debt in their books was close to around $10 billion. That's come down to around $5 billion, and the management has indicated that that goes down further from here on. So that's why those risks have gone on the back burner for now, because promoter entity in better shape, obviously they should not do something that will throw away all of this advantage. But at 10 a.m., we'll have the listing price of all these entities. And in a short while from now, maybe I'll have a chat with Mr. Anil Agarwal himself. Back to you guys.
Point, Nigel. Thanks a lot for that. So that's well explained. 4-way, 5-way merger of Vedanta. All the companies will be listed today as well. Dharmesh Kant, who's the head of research at Chola Securities, joins in now. Dharmesh, as Nigel was pointing out, that the aluminum prices have seen a big spike. Now, even if they correct from here, there is a fair amount of room because the analyst estimates are still a lot lower than even these corrected prices. So in light of that, of all the listed entities of Vedanta, which one would you back the most, if at all? And how would you view the commodity space in general now that the peace deal has been signed?
Yeah, good morning, Mangalam. Thanks for having me for the show. Commodity price, I think 1 year more of an upcycle is there for all the commodity space, though it's a volatile thing on the base metal prices and even the ferrous space. So some correction may still be there, but I think the correction, if it comes through in the metal prices, it's an opportunity to buy them. The reason being, since the deal has been signed now, a lot of rebuilding and construction work will happen in the Middle East itself, which should keep the commodity prices buoyant. At the same time, I mean, the countries like India, which was holding on to the speed of infrastructure spending, will again step up the pattern because one is the input prices will be benign now. At the same time, the concerns on the fiscal front gets addressed to a large extent. Now you know exactly what kind of a hit you are going to take on the fiscal front. So that will spur the spending. So our view is, though we are expecting a correction in the commodity prices and the stocks related to that, but that's an opportunity to buy and play it for the long term. As far as Vedanta is concerned, our base case scenario was around 400, 450 was the price range for aluminum business. And copper, zinc, lead all put together around 300 to 325 is what we were penciling in those two businesses. And 100 rupees for the balance of the businesses. So around 850 is the fair valuation for that. I think there's a scope of around 10-15% kind of an upside from current levels. So aluminum definitely Vedanta Limited should be bought into. And the other all put together, copper, aluminum, zinc should be, bought into. So these are the two businesses which we are looking forward to buying. And we are bullish on the commodity space for next 1 year. So Hindalco, Hindustan Zinc, Vedanta, Tata Steel, JSW Steel, but these are the companies which should be bought into declines.
This morning, as we look at morning, Dharmesh, because this deal and the price drop in oil, etc., are there any trades or any positions you'd like to beyond? Because things, the obvious ones will all gap up, but the point is it's decent relief, right? So it may last beyond just a single day. What's your sense, Dharmesh?
Yeah, good morning, Prashant. I mean, it's still too early to call it a day because knowing Trump, nobody expected February 28, the thing which it did would have happened. So still too early to call it. But yeah, having said that, we always assuming that first quarter should be the end of it and it's ending around middle of the June. So from here on, if you pencil in the numbers, around 1200 to 1250 would be the EPS target for, FY27. So that's a decent 6-7% upside from what we ended on FY26. So market as per se is looking good. But I think one sector which has been neglected quite a bit and people are not paying attention to that is the cement sector, because the volume has been very robust in the 3 months. I mean, almost June, 15 days has gone by. So 45 days, the volumes has been quite big. In April, they have taken quite a good amount of price hikes, 20 to 30 rupees per bag. So, and there has not been any discount being offered. So this quarter is expected to be pretty good for entire cement space. And there, I think the larger ones like UltraTech, Ambuja Cement remains the topic out there. Even regional plays like Dalmia Bharat and all can be looked into with the kind of price correction which has taken place. So cyclical play like cement should be, taken note of, apart from the obvious ones like financials and the other related with crude basket. Even refiners can see a good day, but refiners again is a trade. So as a strategic play, I think the cement sector is one which we are looking for the next 2-3 months.
Right, and just before we take that short break, Ramesh, you have a view on the paint space, because I believe that, the price hikes that they've taken have more than covered for the raw material inflation that we've seen. And competition also seems to normalize a little bit given the price hike that everyone else has seen. So that intensity comes down. A sector that was growing in mid-single digits for the last couple of trading, years, financial years, should bounce back in double digits, right?
Yeah, I mean, going by the management commentaries and going by the numbers which they have posted for Q4 and the outlook which was given in between, say, in the month of April and May, does suggest that volume growth has been there in the paint industry. At the same time, this quarter maybe some kind of operating margin squeeze will be there because the price hikes was not commensurate with the kind of input price hikes which will be there in Q1. But going forward from here on, I think paint as a space has always been expensive on the valuation multiple side. So the trading blip, I mean, 5-10% still can be there on the paint space. But overall, structurally, we are not very bullish on the sector space. For trade, for cyclical trade, definitely it warrants a buy. And the beauty of, price hikes has been anyway, 10-year, 15-year, 20-year down the line, if you go by the price hikes which has been taken, it doesn't roll back to the extent of, input price benefit which comes through because of supply disruptions which happens. So this time it was a pure supply disruption kind of an event playing out. And all these companies, I mean, Q2 and Q3 would be very good because these price hikes will stay. And the input prices, if this deal stays where it is, then definitely there would be, again, the margin uptick will play out. So paint as a cyclical trade, one can take it. But structurally, I don't think there's much, headroom out there.
All right, not much headroom out there, despite the tailwinds that we're seeing right now. At best, a trading pop. Take a short break, come back. We continue our conversation with Dharmesh. Also connect with Mitesh Thakkar and Sudarshan Sukhani for a quick bunch of technical trades for today, as the GIFT Nifty indicates a fairly strong start. Welcome back. You're watching us here on Bazaar Morning Call. We're set to open with a bang on the Indian markets, given the sort of up move that we've seen, on the gift Nifty as well as the Asian markets. May peace prevail. That's the word coming in from Donald Trump. The peace deal has been signed. A big move, extended moves on Nikkei as well as Kospi, up nearly 5% each for both those indices, 5.5% on Nikkei as well as the Korean index. Dharmesh Kant still with us. Dharmesh, this morning there has been news that Nestle has gone ahead and refuted any claims of Maggie's infestation, a reason why the stock was down about 3% on Friday already. Now, it's once bitten, perhaps twice shy, so they will take all measures upfront to ensure that there is no such Maggie-related crisis that emanates. Do you think that this, news, and as a result of which the dip in the stock is a reason to buy?
Yeah, I mean, the dip in the stock was a very, minor kind of a dip. I mean, going by the sensitivity of the news flow, had there been, much, I'm jumping the gun by saying so. Much, depth into it, the stock price should have corrected 10-15%. Because, Nestle is one of the outliers in the FMCG space, and it has been trading at around their highs, and valuation-wise very expensive as well. I think 10 years back also the same kind of event has played out, which they came out quite clean. And this time also I expect, that's my personal assessment, that they would come out clean of this kind of an issue. So definitely, yes. I mean, going by the way it has performed and the valuations which it has commanded, such dips can be bought into from, long-term investment perspective.
All right, we take that point. We'll take a short break, come back again. In fact, we'll connect with our technical experts. Pre-opening, we'll also have Sunil Singhania of Abacus Asset Managers to discuss markets and the US-Iran peace deal.
Okay, welcome back. There's 3 minutes to go for the pre-open session. Let's just get some trades out of the way. Mitesh is with us, and so is Sudarshan. Gentlemen, good morning. Good to have you with us here. Let's hope this one, this peace deal is the real deal. Sudarshan, what would you do? You got a bit of a gap up this morning. What from there?
Well, good morning. Well, from last Monday, I've been saying buy call options. The Nifty is now at support at 23,100. So anyone listening on Monday, Tuesday, Wednesday or Thursday and long in the market should take profits now. This is a very good time. The markets will again correct, not necessarily today, but soon enough. And then you have the opportunity to re-enter. If you haven't done anything last week, then this is not a good time to buy. You still have to wait for a correction in the markets to enter. That may take a few days. So the summary is, if you own calls, if you were long last week and you should be, take profits. If you are not having a position, don't buy the gap up.
All right, that takes, that's fairly clear. And Sudarshan, we remember your call. Right from Monday, you've been saying that buy calls for this series and not necessarily for a day. And that's a trade that has come out good. It's time for those who actually action that to reap the benefits and perhaps book profits. Mitesh, your call on the index right now, we're likely to open about 300 points higher as per the GIFT Nifty. Do you think it would make sense to chase that gap up?
Good morning, Manglam. First, I think a compliment to Sudarshan. He was a day ahead of everybody else in picking up the long side trade, and it's working out very well. So, great call, Sudarshan. On the Nifty, my next target is around 24,000. If you rewind back to about 25th of June, we got a closing high of 24,031 before declining all the way to about 23,100. So that high which was being created there, I think that would be an important pivot. So if you open about 3 points gap up, maybe as we approach 24,000, it might be it might not be a bad idea to book at least 30 to 45% of your position and then see whether there is strength enough to get past that. My feeling is that eventually we will get past 24,031 and possibly head towards 24,350, 300, 350 zones. I think that's where the eventual targets on the Nifty for me are.
All right. And Sudarshan, individual stocks, what would you suggest? Now that you're booking profits at the index, I'm sure a lot of individual stocks would outperform, right?
Yeah, that's right. Bank of Baroda is a buy with a stop under 265. See, the stops are not relevant because I have no idea what the gap up will be, but it's an indication. Bank of Baroda buying opportunity. Hero Motoco is a buy with a stop under 48.35. Marico is a buy with a stop under 795. And Oil India continues to be a sell with a stop above 430.
All right. Mitesh, your calls?
I have all buy calls. Chola Finance is a buy for me. Keep a stop below 1544. Look for targets of 1615. Gas Authority or GAIL is a buy with a stop at 167 for targets of around 176 to about 177. Indian Hotels is a buy. Keep a stop at 665. Look for a target of 705. And a buy on Colgate Palmolive with a stop at 2055 for targets of 2130.
Gentlemen, we'll talk again. But Sudarshan, congratulations. And Mitesh, thank you very much, both of you, for being here. We'll speak again soon. The rates are coming up at the bottom of the screen. And it's, of course, a flourish of open. Let's see if we are able to build on this. Sunil Singhania is with us, founder of Abacus Asset Managers. Sunil, good morning. Great to have you with us here. Thanks very much. Every time we've spoken in the past, you've been, of course, saying, well, this will happen, this hona hi hai, but it's a matter of time, right? And it's taken quite a few months, 3.5 months now. But it's hopefully this is it now. This is the real deal. And this takes away a significant amount of negative macro sentiment kind of pressure off India, doesn't it, Sunil?
Yeah, I think, see, no wars last forever. And obviously this war, I think both the parties also did not know what they were fighting for. So it was a matter of time. For India, it was very important because unlike some of the other conflicts, I think this was one which was impacting India a lot. It was closer home. Big, I would say, region for India's exports. Obviously, oil got impacted, currency got impacted. So I think it's a good relief that this has finally happened. But Prashant, actually, if you see the last 15, 20 days, I think the markets had already started taking cognizance of the fact Oil was not moving up despite all the negative news flow, and now obviously oil has come decisively down. We continue to believe that oil will be more like 70, 80, and I think we're almost there. We were 15 days early. Our view was that by 31st May it would be there, but it's 15 June, it's fine. I think from an India perspective, things are falling in place. The global AI trade obviously looks like peaking out. I don't know whether there will be a sharp correction there or not. But investors are looking at alternatives. The underweight India is now at the highest level ever. Technical positions point to shorts. Earnings have been good. Government has acted, whether it is a FCNR, deposit thing, or some of the other smaller, I would say reforms they've introduced. So all in all, I think looks to be now back to normal. Hopefully, currency will also appreciate to maybe 94.
You spoke about the currency.
Right. Sunil, just one point. Would you say, if you look back, right, foreigners have been big sellers. This month itself, they have sold some 45,000 crores in equity. You think that, because that is a problem area, otherwise the non-FI names of all, there's a bull market going on there. And you're well aware of that. You've participated in many of those themes. But will this foreign selling, which is a capital problem, you think this can change that sentiment around?
And I would stick my neck out and say that for the calendar year 26 will be net positive as far as foreign flows are concerned. I think there is no reason for them not to look at India. One of the largest economy, one of the most diverse economy. If you look at some of the other markets, one stock is 30, 40, 50% of the index. In India, the largest stock is like 7% of the index. Very diversified, growing at 7% even in the midst of the conflict. And I think if they ignore India, then it would be at their own cost. So I don't think that this selling is going to continue forever. And I would stick my neck out and say calendar year 26, we will end the year with a net FI inflow.
That will be quite a call. We'll keep this for the keeps as we speak at the end of this year, and hope for the FII to return. You spoke about the currency, and as luck would have it, in fact, we opened at the highest level for the rupee since May 8, 2026. So it's been a near to 3-month high that we're seeing on the rupee, 94.71. Just last week, we were at 95.71. So there has been a near 1 rupee appreciation on the rupee from, as against the dollar. But Sunil, on the mid and small cap themes, is there anything that you believe was lacking conviction on the upside because of this war? And now that this war is perhaps for the near term, a peace deal is signed, people would rush to that trade. Is there something that stands out?
So I think, very surprisingly, normally when there are external headwinds, the mid and small cap tend to underperform the large cap. But this time we have seen the reverse. In fact, year to date, the mid and small caps have outperformed the Nifty despite the conflict going on. So I think it's a reflection also of the significant earnings, I would say, outperformance of the mid and small cap vis-a-vis the large cap. Mid and small cap have to be stock specific. So I would again, reiterate that we don't have to track the indices per se, but more stock specific. But I would continue to believe that there are so many stocks which are smaller and which are doing, significantly well despite all the headwinds. Also, a lot of sectors, if you see, like renewables or even, engineering or niche engineering, I think those companies are largely in the small and mid-cap space, and which is where the growth has been, manufacturing or engineering and all. So I think, obviously, immediately you will have a big bump up in the banking side because of the huge uptick which the markets would see. But I would say that mid and small caps, generally, if you are a little bit focused more on stock picking, should do well in the next year or so.
Yeah. Fair enough. Sunil, just so areas to so you're saying banking, just by the nature of the ownership, etc., should start to do well if some of what you're saying plays out, right? That foreigners start to buy. I mean, that's where they own most. That's where they sold most. So that should do well.
I think this is a sector which was the favorite punching bag. Foreign investors, whenever they wanted to sell India, for them, 40% weightage was in banking, so they would just come and dump it. And I would say that some of the private banks, the largest private bank now trades at 11 times PE if you strip out their subsidiaries, And obviously, if big money has to come in back, and that is what our view is, that foreign investors will become net buyers in India, I think you'll start to see correction in this valuation, which is the lowest which we have seen for the last 10, 15 years in some of these companies. So the immediate uptick would be in banks, NBFCs, obviously high beta trades like CapEx, infra. But banking will stand out because it can absorb huge amounts of capital pretty quickly.
Yeah. What about, one is this broad sentiment turning around macro relief. What about earnings, underlying earnings? They've been, just your assessment, Sunil, as we look ahead?
So Nifty earnings were, I would say, muted March quarter. But if you see the broader market earnings were like 15 to 20%. In fact, I was reading a report by a leading brokerage, which says that the corporate profit to GDP ratio is one of the highest in the last 10 years. So corporate profit has held up pretty well despite all the headwinds. Even when we look at the current year, obviously, April, May, some of the companies, some of the sectors would have had some pain because of higher fuel cost or logistics issue and so on and so forth. But we have 10 months now. We are very confident that companies and sectors would recover whatever they would have lost a little bit in the first 2 months. So we continue to believe that 26 and 27 finally will have earnings which will trend up to around 15%.
Would you have a view on the metal space and the other commodity space? Today we have Vedanta's demerged entities listing as well. How would you play that and the other commodities which may now begin to come off given this piece?
So metals, we have been quite positive, and I think it's worked out well. We are among the very few houses who doesn't mind investing in commodities as long as the ROC, ROEs are above 14-15%, and I think it's played out well. We do have, risk matrices in place. We don't go beyond 9-10% as far as commodity stocks are concerned. I think even now, I don't know how the commodities globally will play out, but our view would be that commodities generally should be pretty stable and firm. There will be a lot of reconstruction which will happen. I think the trade towards electrification is going to continue. Companies have got the shock of their life when the Iran thing happened. And including India, I think most countries would want to move from fossil fuel-based energy to electrical energy, and their metals would definitely be needed. So we continue to be quite optimistic. And the good thing about Indian metal companies is that they are fully integrated. So they are the lowest cost producer and the last man standing. So we would be optimistic on this sector.
Equally on ferrous and non-ferrous, is it?
Yeah, more non-ferrous because, obviously it's a global commodity. I think ferrous also selectively, companies in India have, done pretty well in terms of, their balance sheet. So it's very well structured now. It's not very heavily debt dependent, and also on the cost side.
Also on the cost side. Any other pockets? I mean, you're a stock picker, bottom up, Sunil, and that's where you focused on. Any other areas of outsized absolute performance?
Yeah. The one sector which has been completely ignored is the consumer discretionary. I know I don't like consumer. So consumer staples will be away because for 5% growth, you can't give 60-70p, which still some of the companies are trading despite 5 years of no returns. But I think consumer discretionary, some of the smaller to mid-sized companies are now trading at valuations which would have been a dream 4 or 5 years back. And the reason is also logical. Their growth has not been that great. But when we speak to companies, I think there are finally signs of some growth coming up. So I think that is one segment where we are doing a lot of work, So small to mid-sized consumer discretionary companies, low holding significant underweight positions. I think that can be good. I think capital goods continue to be on our radar. Stocks have moved up quite sharply, but whenever we get an opportunity, we'll look at it. And I would say the renewable theme is going to continue for a long, long time.
So when you say small to mid-sized consumer discretionaries, what specific sector in the consumer discretionary space are you speaking about? Is this electronics? Is this fashion? There are not too many companies, Mangalam, you know them all, So I'm talking about the brand and the consumer-facing companies, not the manufacturing side.
The last bit that you mentioned, Sunil, the renewable area, where exactly are you focused on? Which part of the?
Actually, if you look at the whole scenario, the shock has basically led to move towards, I would say, reliance internally on energy sources. We are blessed with sun, we are blessed with wind, we are blessed with so much land. I think the whole focus on solar and wind and BESS is going to continue for a long, long time. And now when we look at the whole growth in the data center which can happen in India, I think all the data center guys would look at renewable energy sources also. So it is possible that, there will be an uptick in terms of the demand expectations, which a lot of these guys on the street are building in. In fact, I read a report over the weekend from a large broking outfit which talked about, solar demand jumping to something like 900 gigawatts by 2035. Yes, there is a lot of supply also, but it's fine as long as the demand is there. So we will be quite constructive on that side, and that should be good for the country also. Imagine, if we are able to move significantly our energy usage from fossil to electrical, I think India will become much more immune to the geopolitical issues which keep on cropping up in the world.
Sunil, it's a pleasure always. Thank you very much for joining us. And let's hope some of what you say, and of course that's a bold call, but the fact that FPI has turned net buyers for the year is such a calendar 2026. Very interesting chat. Thank you once again.
Thank you. Have a good day.
Thank you. Well, that's Sunil Singhania, one of the best stock pickers out there, sounding constructive, sounding bullish, and of course talking about a few specific areas where he'd look for opportunities. Smaller, mid-sized consumer discretionary is something he pointed out. Renewables is something he pointed out. Banks he thinks will do well from here. Capital goods and others as well. So that's one opinion coming through. We'll get you more. But some of the brokerage calls of the day. Sud is here with what is on his list. Sud, take it away.
So first one is GMR Airports. Macquarie has initiated coverage with an outperform call and target is 125 rupees per share. It expects 18% EBITDA CAGR over FY26-29. On Lenskart, there is another brokerage note, and with a positive stance, UBS has initiated coverage with a buy call and target here is 730 rupees per share. It says company offers products of comparable quality to peers at nearly half price, and its India division is nearly 6 times larger than Pioneer Titan and expects exponential earnings growth with EPS CAGR of over 44% over FY26-31. Last one is Phoenix Mills. Macquarie has initiated coverage with outperform call and target is 2100 rupees per share. It says it's India's largest pure play name in premium urban consumption and 50% mall GLA expansion, 4 times growth in office spaces, 900 key outlet hotel build-outs by FY30, underpin growth runway. Some of the key catalysts: commissioning of pipeline malls through FY27-30, completion of refurbishments of Palladium Mumbai, Market Street Bangalore and Market Street Pune, and last one is office lease up at Mall of Asia and Mall of the Millennium. These are some of the catalysts why Macquarie is positive on Phoenix.
All right. Thank you very much for that. So keep an eye out on that one. By the way, since all of this broke this morning, early morning, we will get some notes from the sell side research houses on the US-Iran deal and the beneficiaries, etc. But I think all of that will follow as we go through the next few hours. 1.6 higher, 1.5 higher, so 23,980. It's almost 24,000, by the way, on the Nifty. The Nifty Bank is up 1.5%, 57,700. The mid-cap index is starting about 1.5 higher. Friday was a super day, and this Monday, again, we are starting in a pretty strong way. The small-cap index will come up on your screen as well. And I think across the board, it's about 1.5%. Actually, small caps are up about 1.8 now to start off. So this is a very good-looking screen that you've got going up there on right now. So let's just take a look at, 340 on the Nifty? Yeah, 340. Look at that. ONGC is down, naturally. Oil is down 7% in the last 2 sessions. So you've got to react to that. Oil India, I'm assuming, is also going to be a loser, but that's not part of the Nifty. But 49 out of the 50 Nifty stocks are in the green. Shriram Finance, Ultratech, Bajaj Finance, Indigo and others, all starting in the green.
Less than 100 stocks in the red right now. It is all in sundry in the green right now. And the ones which are in the red were the obvious ones, the likes of Oil India and the broader markets. But the top gainer right now has to be, a lot of these oil marketing companies. So if you look at among the top gainers on the frontline index, you have IOC, BPCL and HPCL, all of them up between 4.5% to 5%. We're seeing some traction in the commercial vehicle space as well. Lower oil prices and higher economic activity does well for them. So Ashok Leyland is up around 5%. L&T Finance is up about 6% as well. So a lot of these financials now doing a lot better, directly correlated to the growth in the GDP. What's not doing well? A couple of these pharmaceutical names. Remember, all through this crisis, the pharmaceutical index, the Nifty Pharma, was a rank outperformer. So maybe some bit of profit taking is what we're seeing out there. The likes of Aurobindo Pharma, Zydus Life, we have Syngene, Biocon, all of them down, but not necessarily beyond 0.5% each. Some of these NBFCs, they are, the toast of today's trading session so far. Five-Star Business Finance or any of these smaller NBFCs that you see as well stand to benefit. The Nifty Bank, straight off the bat, up around 1,000 points. And then the other stock which is underperforming right now is Z Entertainment. Remember, was a big mover all of last week ahead of the start of the FIFA World Cup. But now that a lot of the World Cup broadcasts will be made on DD Prasar Bharati for free as well, would put them at a slight bit of disadvantage, but no real problems for the market. Look at Muthoot Finance, Manappuram Finance, or HDFC AMC, commercial vehicles, Force Motors. Across the board, there is gains, and these gains are only piling on as we speak. The Nifty very close to 24,000. The Nifty Bank 900 points higher. The mid-cap index 1.5% as well.
Well, this is a good-looking screen all told. There's no doubt about it, and we are at about 23,965. So this is a pretty solid-looking screen. I mean, I just only hope that there is no changes now. As we've seen many times, a deal which turned out to be a no deal. But I think this is the first time, and that's the important point. So far, we've only seen these deals being announced by one side. And then, of course, I mean, it doesn't happen, and then the market walks back all that reaction. But this time, we've heard it from US, we've heard it from Iran. The one party we've, of course, not heard, and perhaps some grumblings we've heard, is from Israel. But that's an important part of that equation as well. But, the two principles, both are on the same message, which is the fact that, this is winding down, and perhaps a deal signing on Friday, and then, of course, negotiations will on. But more importantly, the Strait of Hormuz will open, and that's what matters for the price of oil, which is down 7% over the last two trading sessions or so. Let's talk to one of the best investors out there with one of the longest track records. Prashant Jain is founder and CIO at 3P Investment Managers. Prashant, good morning. Great to have you with us here. Thanks very much for joining us. It's a good day to speak with you. And you've always maintained that oil is a big macro variable. Maybe it's a little less now. Energy intensity for India perhaps has come off over the decades, but it's still an important macro variable, and that's contributed to negative sentiment overhang for a while. And that hopefully now goes away, Prashant. So how constructive does this make you, Prashant? I mean, and first read through. You'll have to unmute yourself, Prashant.
Prashant, good morning. No, I think, we have been constructive for a while. In fact, we even wrote a note on 22nd May that this will also pass. This is a great investing opportunity. And clearly now things will improve, I think, for India. I mean, oil will improve, and I think even the FPI selling will taper down sharply. RBI has taken very constructive steps, and markets are, I would say, undervalued. So I would be quite constructive, both on the markets and, of course, on the economy. There are reasons to be constructive as well.
Yeah. You think the FPI selling will taper down? Because, and that's an important one, right? Already 45,000 crores in June. And, so you think this will help take some of that pressure off?
I feel, and I've been saying this for a while, that it makes sense to look at FPI selling along with primary market capital raising. And secondary market flows in India are quite steady, quite significant. So as long as primary market activity is down, I don't think it will impact markets too much, because this selling can easily get absorbed. But I do feel that with one of the negatives on India out of the way on the currency and on the oil, I think the pace of FPI selling should reduce sharply. I mean, the move into AI, it still remains. I think over time, even that should unwind, yes.
You know, the flows into equity mutual funds for the first time in the month of May, the data that we have, saw a sharp dip, right? And that at the margin, at least I was thinking, you know, if this pace of FPI selling, so far it was matched dollar by dollar, right, by a local buying. But if the numbers are so large remain so large on the other side, and here it becomes, I mean, the numbers don't add up, then something's got to give. Hopefully, we will not come to that, Prashant, right?
I think, see, that was also a sign of, some concern in the domestic investors. The SIPs held, but the non-SIP flows fell off very sharply. And because clearly people were concerned about the war, and this is not unusual. It always happens in crisis periods because fear becomes the dominant emotion at times like these. And that is why equities are a very simple asset class, but it's not easy to invest in sharply down markets. But I think even domestic flows should now come back pretty strongly, yes.
Okay.
Non-SIP flows, I meant.
Okay, fair enough. So sorry that, you know, I just want to go back to that one point you made about primary, look at a foreign selling with, in conjunction with primary issuances, you meant, right? You meant the IPO market, etc.?
The IPO markets or the sell downs by PE or the MNCs, I mean, all of that put together. Because both are sources of supply. One is the FPI selling and one is the primary capital raise or the blocks, OFSs by whosoever.
How are you positioned? Because if we, with the benefit of hindsight, Prashant, what is done well is the non-FII parts of the market, right? Which basically, I mean, you've got a bull market going, no other way to put it, in many of those areas. So how are you positioned and how would you look at it?
I think we are seeing greater value in large caps as a category clearly. Small mid caps, I think the fall has been very significant over the last 2 years from the peaks. And therefore, there is isolated value emerging. It is a stock. I mean, you'll have to be very selective about what you buy in that space. But there is some value in 1 in 10, 1 in 20 stocks. As far as large caps are concerned, I feel that probably all the sectors are either undervalued. I mean, the extent would vary, but I do feel that banks appear to be a little more undervalued than the rest of the markets.
Right. Banks are a little more undervalued than all the other themes. And in banks, is there a particular preference that you have for a kind of banks? Because you've earlier liked PSUs as a theme, but now is it private banks that you like or public sector banks, or you're agnostic?
So I think the divide has vanished. Actually, the divide was between corporate and retail banks. And since all public banks are very old banks, bulk of their books was in corporate loans. And that's why market started looking at private versus public. I have actually looked at, I mean, in the earlier phase, corporate versus retail banks. Now I think it's mainly a case of large versus mid or small sized banks. So while with a long-term point of view, my preference continues to be the large banks for very simple reasons. But if liquidity improves, which it is likely to, as even if CNRB deposits come in, liquidity in the local economy should improve. I think it would be favorable even for the small and mid-sized banks.
So banks clearly, I mean, you think there's value across the board in large caps, but banks clearly are the one pocket where there is more value than others. And mid and small caps, just to paraphrase you, I want to get that right. You said that they may be value, but it's kind of rare now, 1 out of 10 kind of situations. That's what you said, Prashant?
Yes, see the fall in small mid caps. If you look at the fall from peaks in the non-NSE 100 stocks, if you look at the next 400 stocks, for example, in NSE 500, the fall has been very sharp. Almost 2 out of 3 stocks are down 30% or more than 30% of their peak levels. So what I am saying is that while small mid caps as a category, to my mind, are still less attractive than large caps, but given the very large number of companies in that space and the sharp falls that we have seen, there is value emerging in 1 out of 10, 1 out of 20 companies, in my opinion. Of course, when you talk about stock picking, everyone will have a different opinion, yes.
I see. Because the way I read what you said is because I mean, mid and small cap indices are pretty much back at new highs, right? So I thought what you were saying is after the run-up, because of the run-up, I mean, there is only value now left in I mean, it's kind of fully valued in many cases. I thought that's what you meant.
See, the small mid-cap indices are not always representative of the entire small mid-cap space because the number of companies is so large.
Sure.
And these indices would also move based on a smaller subset of these the indices. So I think the large caps have borne bulk of the selling pressure from foreigners. And that's why they have underperformed more. So whichever way you look at it, I think the large caps, in my opinion, appear to be relatively better valued than small and mid caps.
Right.
Is there any new investment that you've made in the very recent past, or is it more of the same?
I don't think there is, I mean, we are a medium to long-term investor, so I don't think there is much churn in the portfolios. We disclose our portfolios once a quarter. We continue to remain fully invested. We continue to have a predominantly large cap portfolio. But as I said earlier, there are few opportunities emerging in the small mid cap space also on a very bottom up basis.
Any areas, I'm just talking about not here and now, but structurally you kind of are focused on, Prashant?
Prashant, I think, see, I mean, Indian equities, large caps, banks, I mean, that's the core. But I think we have seen an interesting trend recently. We are seeing innovation in the pharma space, in the NCE space, gain traction in India for the first time. And there are at least 3 companies that I am aware of which have one Wockhardt has already seen success. I mean, it's a historic moment for the country, for the company, of course. I think we are also seeing similar progress in few other companies. I think this appears to be a highly uncertain area, given the nature of it. But I think it could also be full of lots of promise.
Yeah, you're absolutely right. Wockhardt and maybe a few others as well. Innovation in the pharmaceutical space, not generics, but the drug discovery coming back as a theme. Anything else like this? These pockets, apart from what we've discussed.
I think even autos should benefit. The financing space should benefit. I think, see, India offers you very broad-based growth opportunities, sectors that will benefit from lower oil prices. I think all of and which were beaten down. I think these are sectors which could have a little more promise or potential in terms of returns.
Right. What about state-owned companies, the oil companies?
I think the OMCs, yes, they would benefit clearly from the sharp fall in oil prices. So they would also be beneficiaries.
I see. Would you look at them constructively, given what has happened to them through this period?
See, we are not investors because we think the longer-term growth prospects are not that promising. It's a slow-growing, very cyclical, very capital-intensive business. But I think near-term outlook for these companies could be quite promising as well.
Would you say the same of the defense sector? Long growth runway, but valuations, a lot would say, may have become a little too extreme, but a lot of people do justify that given the long growth runway.
I think, I could be biased because I was a very early investor in that space. So when you bought something at 5, 7, 8 P, you tend to become conservative a lot earlier than the market. But still, I feel the best is probably behind them. They are fully valued, in my opinion. And see, one war has ended. And the second also could end at some point of time. So these are very strong, stable, growing companies. But I think markets are discounting a large part of that growth. So they could do well, but I would not have very high confidence in that.
Got it. Prashant, we leave it there. Thank you very much for coming on this morning. It's an important one, and it's always good to get your perspective around some of these issues. Appreciate it.
Thank you, Prashant. Thank you. Bye.
Okay, I think we are going to keep getting you more opinion, but that is, of course, one of the best investors for a very long period of time, weighing in, sounding pretty constructive across a range of sectors. But large caps is where Prashant's comfort really lies. Well, Vedanta's demerged entities are going to list on the exchanges today under Vedanta Aluminum Metal, Vedanta Iron and Steel, Vedanta Oil and Gas, and Vedanta Power. Nigel caught up with the chairman of the group, Anil Agarwal, on the rationale, expectations, and of course, I mean, which among these, all these entities, 5 entities, the founder, Mr. Agarwal himself, is most bullish on. Listen in.
Intrinsic value of each company going to beyond $100 billion.
$100 billion every entity.
Company.
Okay.
All 5 company intrinsic value, because the demand supply difficulty to produce this metal, it take huge gestation period and huge capital. Why I'm successful today? The whole world backed me up.
Right. Right. All right. Got that, sir. Let's talk about the biggest part, and everyone's excited about the aluminium business. And you have been ahead of time because you created capacity, you focused on backward integration as well. Now, from around 3 million tons, how large can the aluminium business be? And also, if you have to look at it in terms of aluminium prices, now there's a peace deal that's been announced, so prices have come down a little bit. What are you factoring in terms of pricing on the aluminium side?
Price will go up, price will go down. I'm the lowest cost of producer in the world, fully integrated. I started producing 3 million ton, going to be 6 million ton, and vision is to go for 10 million ton.
By when 6 million ton and by when 10 million ton?
6 million will be in 3.5 years time, and 5 years time 1 million ton largest producer. And demand is so high, still there will be a gap.
Okay, all right. So 6 million tons in the next 3.5 years, that's going to be an interesting perspective.
And 5 million, 10 million ton in 5 years.
In 5 years.
It's not far.
So by 2032, 2031 odd, you will have close to a 10 million ton Vedanta aluminium facility itself. Got that, sir. Quick question. Last year you did around 25,000 crores of EBITDA for aluminium. And in the past, you've said that the aluminium EBITDA can scale up maybe to around $4.5 billion odd. Is that on the cards?
$5 billion. $5 billion EBITDA will be for aluminum.
Okay. All right. $5 billion.
Yes.
In the next 3 years or so?
Yes. With this production.
Correct.
After that, new production will come. I'm talking about this production.
So, all right. Interesting. So at around 3 million tons, you're saying you can also scale to $5 billion. Got that. Let's focus on a couple of other verticals then. The steel and iron ore, you briefly spoke about that. Some believe that Mr. Agarwal may sell this business at some point of time. It's around 1.5 million with a roadmap to around 3.5 million tons odd. Will you be looking to divest any of these businesses if the check is big enough?
See, we are in that business. At the moment, my focus is to create, because steel is amazing business. We need 300 million ton by 2030.
Right.
No matter everybody produce, it will not be there.
Right.
I have to produce 50 million ton of steel. Time to come. And we have infrastructure. We have a Bellary Steel, Karnataka, beautiful plant. We have the complete backup of coke and the iron ore. We are the largest producer of iron ore. And we have a complete gas availability. With this, the whole world is with me. That how you can come in, and because this is the demand supply huge gap. So this is what going to happen. My vision is 50 million ton. I'm going to start at the 4 million to 15 million ton. But if you talk about vision, it should be 50 million ton.
50 million ton. But
special steel.
Okay.
All special steel.
So as of now, you're saying you rather grow the business than sell the business.
Yeah.
You like to focus on adding capacity.
I'm selling business to my shareholder. No, they are there. Institution buying. Everybody is buying. Everybody is, Vedanta Resources itself. I delisted.
Right.
Everybody is looking at me. Why don't you relist?
Is that something you would look at? Would you look at relisting Vedanta Resources? And also, you could briefly tell us about the debt in the books, because Vedanta Resources debt went to $10 billion. You have halved it.
$12 billion.
$12 billion. It's less than half now at around $5 billion odd. So what is the debt outlook on Vedanta Resources? And by when will you be looking at this relisting of Vedanta Resources?
See, debt is always a part of business. It's nice to have some debt.
Yeah.
And we are very comfortable with that debt. It will be in 2 years' time, maybe $2 to $3 billion is fine. But the potential of Vedanta Resources, if we relist $100 billion, this is all money, $100 billion will come to India. That's what we are looking. It is amazing, and it is not debt. It is coming in the form of equity. We are the ambassador of India in the world because last 25 years we paid the dividend, we made the value tremendous. Everybody in the world who invested, a man on the street to the largest fund, everybody has made money from us and believe in us. And we always sell India. India is the best.
Okay, interesting. $100 billion of listing value, and that will be the United States, I'm guessing. You'll be eyeing a listing in the United States.
If that happens.
If that happens. But that's probably on the cards.
Yeah, this is already there on the card. We'll see how strategically it will work.
Okay, all right. Now, just a few risks, which sometimes shareholders are a little worried about. Intercorporate loans, you've said you won't do it. Is there any risk on that front? And also, what is your targeted holding, Mr. Agarwal, in each of the companies? Currently, you hold around 56% stake.
Yes.
Do you see that number hovering around 50, 51%? Would that be an option?
I will only look in growth.
Okay.
For me, मालिक बन के रहना वो जरूरी नहीं है. हमारे प्रोडक्शन बढ़े, जितनी डिमांड सप्लाई बढ़े, हमारे कंपनी आगे बढ़े, उसके लिए मैं किसी भी चीज में we will never have a stop whether I have to address the equity, whether I have to restructure, go to abroad to because the potential. I have understood.
Correct.
I have understood India. I am a person who can take the beating. I can understand whatever. I know that what are the headwinds. Right. And I have come out of it. And the biggest thing, the tremendous support of everybody, because I come from that part. I come from Bihar, a small boy who come in to here. So everybody relate with me. So that is the biggest support I have. Today, if you say one support I have, is a public support.
Okay, so no intercorporate loans is what we should be looking at from the Vedanta group, right? In the time to come.
Never be corporate loan, but we will have a debt if it is required.
Okay.
And there's a lot of ways to raise the bond, do whatever you want. There's a tremendous money available.
Shreya, welcome back. That's the Vedanta management and the conversation you can catch more of. But that was 5 minutes of what is a very interesting sit down with Anil Agarwal, top boss at Vedanta. All businesses now listed separately. Let's move on and look back at, of course, the big story today, of course, which is the deal. And let's hope this is the real one and there is no going back or ifs and buts and we kind of sort of, stay this path now. Prashant Khemka is founder of White Oak Capital. We also have Nilesh Shah, managing director at Kotak Mahindra Asset Management Company with us to run us through what they are making of this. Nilesh bhai, good morning. Good to have you with us here. Thanks very much for joining us. First question to you, Nilesh bhai. This is a significant overhang removed specifically for India, which is such a large energy importer. And so much of that import of energy before the war started came through that strait. Now with the strait opening, I'm assuming some of this macro pressure eases off.
Undoubtedly, Prashant bhai. In our economic Kundli, Rahu Kal starts when oil prices go up. With the peacekeeping deal, it is likely that Hormuz opens up over next 30 days. Oil starts flowing, and undoubtedly oil futures and oil markets are discounting that. So one big macro overhang goes from India's balance sheet. FPIs were sellers because we had high oil vulnerability. To that extent, oil prices come down. It helps us across current account deficit, which supports rupee, reduces fiscal deficit pressure, which will help interest rate and inflation, and hopefully even FPI outflows. So net very positive for India.
This FPI selling has been the big problem, Nilesh bhai. Do you think that will taper off now? Should that taper off?
So I really don't know. There were a couple of conferences in India last week, and the mood from global investors was fairly negative. They were looking at other markets which were in momentum. But let me say, the long-term money should be now considering investment in India. And then FPI outflows, we don't know how many are real investors selling and how much profit was taken away by high-frequency traders. The HFT will continue to make money and take money out. But long-only investors, I believe they should be now seriously looking at India, especially with one of the big overhang, oil goes off.
Oil and rupee as well. Nilesh, thank you so much for joining in and giving us your perspective. We also have Prashant Khemka with us. Prashant, how does this change investor sentiment and your equity picking, the thought process that you have right now? Was this an imponderable before you picked stocks? And what kind of earnings growth are you projecting now that there is peace? I think you're on mute.
Sorry, two parts to your question. Let me first address the first bit, which was how does the sentiment get affected, which is what Nilesh Bhai also talked about, and quite in agreement with Nilesh Bhai. I think one of the key negatives in recent months since the start of the war was the big surge in oil prices and India's dependence on oil imports, and as a result, the impact on current account and the fiscal and the currency. Yeah, so this particular worry does get ameliorated because of the now receding oil prices. Oil prices now already in low 80s. Obviously, before the war started, weeks preceding that, it was in the high 60s. So it's still 20% higher, but a long way down from the 105 to 110 levels that it had reached. So this is one worry that has receded in global investors' mind after the deal signed yesterday. However, it was only one of the worries. The other significant worry that investors have had and have talked about at length with us is the relative non-participation of India in what is currently the flavor of the global investing sentiment, which is AI. So the belief widely is that India, unlike the US or other EM countries like Taiwan, Korea, or even China, does not really participate in this whole AI capex boom or the AI boom in general. Worries are whether its dependence on software exports make it more in the category of the disrupted rather than benefit from the AI disruption. So that negative sentiment, there is little to change on that front, but at least one of the negative factors that people were worried about, the oil price is certainly tempered for now.
So
that's what I'll say the sentiment.
So Prashant, directionally it is positive. We can't kind of, it's not exact science, but directionally, there are two worries. One kind of is gone away. So in that sense, this is good, right?
Absolutely.
We'll take it any day. And the other one, we'll see what happens to it. What's your sense, Prashant? What does well in India? Because the non-FII parts of the market has had a bull market. Many areas, right, pockets which have done very, very well. The large FI holdings where they own is where they've sold. Do you think some of that starts getting corrected in a good way?
See, as of today, for today at least, the market movement in different stocks would reflect what people, expect to benefit from the, end to the US-Iran war. And some stocks might get hurt or be sluggish, like defense stocks. Even though defense spending may continue to be elevated for many years to come, directionally, it is not a boost to defense stocks if a war stops, unfortunately. Yeah. So defense stocks may take a beating. Today, the economic sensitive stocks, the cyclicals, would be expected to do better because it's good for the economy as well. Domestic economy, if oil prices were to recede, then there'll be lesser stress to the various macro metrics as well as at the individual consumer level. So you're likely to see the cyclicals, the financial stocks doing better, the auto stocks doing better, whereas the defensives would likely not participate in the rally today. But as you get to tomorrow, it should be business as usual, as all the prices would have, adjusted today. And from tomorrow onwards, all sectors are fair game, and it's the stock picking that would count.
Right. Stock picking is that would count. One sector which is doing particularly well in today's trading session has to be the travel-related place. So we have obviously Interglobe Aviation, which has been doing well all through last week, and now as well lower oil prices helping their cause. But look at the others. You have something like RateGain, which is again a travel play. We have TBO Tech, which is up around 10.5% on the back of hopes of increased travel. Once again, you have Travel Financial Services as well, which basically manages lounges at airport, TFS, Travel Food Services, all of them doing extremely well in today's trading session. Some of these hotel names as well, Royal Orchid for one, up around 7%. But Nileshji, what sort of sectors would you back right now? What looks attractive, what doesn't?
See, essentially, as Prashant very clearly mentioned, one of the query related to, or one of the worry related to oil is now behind us. Obviously, we expect quick normalization. And the second worry related to monsoon and third related to AI continues to linger. I think where we should be looking at is some of the mid-caps where earnings growth has been pretty tremendous. The fourth quarter overall mid-cap growth was about 36% YOY growth. Now, obviously, all mid-caps don't deliver that. So someone would have delivered 50%, someone would have delivered 5%. So one generalized theme, go for companies which are able to show earnings growth. If in tough times they have delivered, in good time they'll be able to deliver even better. But keeping that aside from a sectoral point of view, one sector which should benefit is financial services. The FCNRB, ECB put together should take out liquidity issue, and that should help them in increasing their profits, if not NIM. The valuations are now correcting, so quite reasonable. The only thing which is keeping their prices at current level is FPI selling. In whichever financial services firm FPI selling you see coming to an end, you will have a quick runaway there. The second sector is hospitals and hotels. Both these sectors are immune from macroeconomic trend. They still have higher valuation, but there is still growth ahead. The third sector could be cement. The government has committed that they'll continue to do the capex, and cement companies have improved their profitability. So overall, we think stories across small, mid, large, where profitability growth is strong, one can consider that.
Just one question, Nilesh bhai. One of the worries was the rupee for foreign investors, and Prashant, I don't know if you have a view. You'd lose on the rupee because there was this unhinged expectation that, well, it perhaps keeps going off, and maybe the authorities decided no point wasting dollars trying to defend a level. But do you expect this, if dollar, there is FPI selling stops, maybe there's some inflows, do you think there will be appreciation in the rupee? Maybe it stops falling. But if there is dollars in, won't the RBI use it to kind of rebuild forex reserves? There is a very large short dollar book overseas that perhaps has to be unwound. Nilesh bhai, you want to go first?
Undoubtedly, Prashant bhai, the rupee movement will depend upon what range RBI wants to pursue. If it is not appreciating, it will be probably due to RBI building up the reserves and cutting down FX positions. If it is depreciating, probably, there is more speculation into it. We have seen India posting current account surplus on fourth quarter, and with oil prices coming back to double digit on a sustainable basis, the current account pressure also eases off. There is $50 to $70 billion flow coming from FCNRB, ECB, and liberalized bank borrowing. Put together, RBI will determine up to what level rupee will appreciate, and undoubtedly they will use this phase to build up their reserves and square their forward positions.
Prashant, you want to come in? Just quick view on that?
I think Nilesh Bhai covered it very well. Not much to add. I'll just say that amongst the worries that we talked about, rupee decline and volatility, more or less one-way volatility is another one of the concerns that's been preoccupying many of the global investors. So to the extent what Nilesh Bhai said does play out in terms of some stability in the rupee, that would be a welcome relief to foreign investors.
You know, it's a good one, directionally positive. It's good getting both your perspectives in, Nilesh Bhai, Prashant. Thank you very much for coming on with that quick take on what is, of course, a very significant day with regards to India's macros in general. I mean, sentiment turning around. Let's just, as I began this chat by saying, hope this is it, and there is no ifs and buts and all of that stuff, right? Prashant, you're smiling, but I mean, it's been so many of those, right, over the last 3 months or so. So let's just hope this is it. Thank you very much once again for being here on CNBC TV 18. Well, I think we'll take a break. Prestige Estates Management joins us on the other side. We'll, of course, ask them about, the road ahead for the company, Irfan Razak. Of course, a little bit about costs coming off because of now this deal and what that means for construction companies. Stay tuned.
Welcome back. The market continues to do well. Now we've added a couple of other names as well. When typically the sentiment improves, we see an outsized gain come in all these high beta names. Platform companies for one. Eternal is up 5%. We're seeing some traction on Swiggy as well. And a lot of these other new age companies as well, seeing a bit of a spike. And the move from the financials has moved from banks to NBFCs now. So we're seeing increased traction in names like Shriram Finance, is up 5%, Bajaj Twins as well, or up around 4% each. Bajaj Finance as well as Bajaj Finserv, both of them come up for you on the screen. So since we're speaking about now second order beneficiaries of this peace deal, would real estate benefit from it or not as well? Well, who better than Irfan Razak, who's the CMD of Prestige Group, joining in to tell us about the demand situation and obviously what happens in the very near term now that a peace deal has been signed. Thanks a lot, Mr. Razak, for joining in. Now, just wanted to understand, in the very near term, over the last 105 days or so, while the war was on, there were two parts which impacted your business, or that's what the street expected. One was the higher cost of finance, higher uncertainty, lower remissions coming in from those regions, impacting real estate demand. And the second part was the fear of higher interest rates, getting people to not perhaps go ahead and buy immediately as well. And then you had the increased cost story as well. Now with the peace deal being signed, do you think parts of this equation will see improvement? And if yes, would you be able to quantify the impact and now as a result of which the improvement?
Good morning. Actually, this eases off the mind. The sentiment will definitely improve. And it's not as though we were affected anyway largely. Of course, there was that fear of cost going up, that fear of demand sliding down. So that fear now has evaporated. But I only hope this is the lasting one and things really get back to normal. And once that happens, I believe that we will be again back to normal business. Of course, the last 3 months we have done well and the demand has sustained, though we had this fear of the costs going up, spiraling up. And now with this clarity coming in and the oil prices dipping down tremendously, I believe even the demands from vendors for higher costs will reduce. And I believe that we will be back on a more even keel. And customer sentiment itself will be far, far better. And I think all our future launches will meet with resounding response. And that's what we believe. In fact, we did launch a large project in Hyderabad in the month of April, and that did extremely well. That's a Prestige Golden Grove in Telapur. And so I believe that we'll do better with all this good news.
All right, you will do better with all this good news. So a lot of it was basically sentiment related and not immediately impacting business, but you believe that now sentiment has improved and whatever could have impacted business later in terms of increased costs may come off as well. And, I'm looking at some of the launches that you spoke about earlier and the targets that you've made. You've said that FY30, you've indicated that a lot of the retail and commercial segments would add to your revenue a lot more. Just wanted to understand the plan with residential as well, because, I, for one, was looking at, just for academic purposes, if you must, the Prestige Ocean Towers, which is about a 5-minute walk from my house. 31 crore rupees a pop out there for a flat. Price hikes not an option for builders anymore. So what's your outlook on residential demand and your view there and the increased potential that you see from retail as well as commercial assets?
I mean, you've covered all the subjects. Coming to residential first, last financial year, we did buy in revenue on residential. This year, we have guided a 20% increase. So that means we should get to 36,000 crores of business, maybe more, but I think we have been conservative. So we have kept it at 36,000. I think we should achieve that because we've got a huge pipeline across all the 5 cities that we are working in. We've got about 60,000 plus crores worth of GDV of launches that are there. Now, the only thing that will impact us in terms of why it didn't happen is only because the approvals don't come on time and the launches don't happen. But we believe the teams are working really hard to see that it happens. And we will bring this inventory to the market sooner than later, and the demand will be there. And all cities, whether it's Mumbai, Bangalore, Hyderabad, NCR, for that matter, Chennai. So there's a big pipeline in all these 5 cities. And then I talked about pricing. I, for one, have always been saying that the prices should not go up faster. And now with this relaxation of this fear of the cost going up, I believe even the pricing will ease off. The only way our price goes up is we've got 2 inputs. One is the land, and then that's the other one is the construction cost. And of course, in a city like Mumbai, we also have the approval cost, which is pretty huge. Now, coming to residential, office and retail, we have a target of for the office segment where we are already pouring concrete, where we are getting our office portfolio ready. We have a target of 4,000 crores by FY30. And retail, we have a target of about 1,200 crores by FY30. And this is real. This is where we are pouring concrete, and this is where the product is getting ready. We've done a lot of pre-leases also. And I think this will happen. This will fructify. And the office demand is pretty robust. Retail demand is pretty robust. And especially in the retail, we have a 99% occupancy. And in the office also, it's in the around 90%. So it's doing well in spite of all this turbulence going in as far as geopolitics is concerned. I always will stay positive, and I believe that the only way to do it is keep doing your work and doing it well.
Right. A view on the unrecognized revenue, which stands at closer to 66,000 crores. Just hang in there for a moment, Mr. Razak. We are at, the clock striking 10. So you're also looking at all the 4 demerged, relisted entities of Vedanta. So the bell should strike any moment. We do see Anil Agarwal at the Bombay Stock Exchange. We heard from him as well. he did indicate that each of these listed entities should be worth about $100 billion each. For the aluminum business, he did target a $5 billion sort of EBITDA coming in from the current capacity that they have, 3 million tons in terms of current capacity. That goes to 5 million tons and 10 million tons in the next 5 years itself. So there goes the bell. And we should have Vedanta Aluminum, which is about 521 rupees, 522 rupees on the NSE pre-listing. Remember, the overall Vedanta was a lot lower. The price was a lot lower than just the price of the aluminum business. And that's something that we've been pointing out. Nigel's been speaking about that. So that's Vedanta Iron and Steel, Vedanta Oil and Gas, Vedanta Aluminum, Vedanta Limited, as well as, all the verticals of the company. There you have it, 4 simultaneous bell ringings that have been taking place out there on the Bombay Stock Exchange. You can see the visuals out there. You have Anil Agarwal, members of the family, leaders of Vedanta management. So we'll get more on this as we move along. Vedanta Oil and Gas listing at around 38 rupees. I saw a rate coming in on iron and steel as well, which was, I think, about 20 rupees a pop. And then you have, obviously, the biggest of them had to be the aluminum business, which is 522 rupees. Vedanta Power is about 41 rupees. So add all of them put together should be closer to around 650, 660 odd rupees if you club all of them as we speak. So that's about Vedanta. We will obviously get more on that through the course of the day and snippets of our exclusive conversation with Anil Agarwal on the way of the business as well. There you have it, 4-way demerger, and now all of them have relisted. Vedanta Iron and Steel 20 rupees, Aluminum about 520 rupees, Vedanta Oil and Gas about 36 rupees, 39 rupees for power. Add all of them together, about 620 rupees, plus the Vedanta, which is currently listed on the bourses as well. But let's continue our conversation with Irfan Razak. Mr. Razak, we're speaking about some of the unrecognized revenue that you have, close to around 66,000 crore rupees. What is the expected recognition timeline, and how much of this is at risk of slipping beyond FY28 due to, one, construction delays, and some of the projects which you believe may have seen some sort of demand delays because of FY28, because of the Asia war as well, the Middle East war?
I see the 66,000 crores of unrecognized revenue is where the sales have already been completed, contract signed with the customer. As per the accounting policy, we have to recognize this revenue only after the product is ready and the product is delivered to the customer. And this is a continuous process, because what happens is every quarter some project will get completed and that comes into the P&L account. And then every quarter new sales happen. So this will only go up as we go along, because if you take one financial year, coming financial year itself, our projection is to do another 36,000 crores worth of sales. So that will take it up to some almost 1 lakh crores of unrecognized revenue. Out of that, there will be completions. So that completions will get deducted. Initially, in earlier days, we used to do on this percentage completion methods. There was no lumpiness. Right now, what really happens is all the expenses front-ended, but the revenue and the profit is always back-ended. So it gives a bit of doesn't give a clean image to the investor what is really happening. But I think we should really look at the unrecognized revenue. And if you percolate that and multiply that into the PAT margins that we've already declared, that will show the amount of value in terms of profits that's sitting there in the company, which has to get recognized. So it's a continuous process.
Is a REIT in the offing? Mr. Razak, is a REIT in the offing?
No, there are many things in the offing. One is our hospitality business. Second is the office. And third is the retail. So ultimately, we'll have 4 different type of entities which will eventually happen. One will be the residential, then it will be the office, then the retail, and of course, hospitality. It's all work in progress. We need to get there. And I think by 2029, all this should fructify when there's a certain critical mass. The teams are working towards it, and that's a goal. We've even set a sort of logo within the company saying Mission 2030. We are working towards Mission 2030.
Yeah. All right, take that point. Thanks a lot, Mr. Razak, for joining in. Short but effective conversation on a day which is great for the markets and sentiment at large as well. But as we were having that conversation with Mr. Razak, we obviously saw the rates coming in for Vedanta's four-way demerger as well. Rakesh Arora was the founder, GoIndiaStocks.com, joining in now. Rakesh has obviously been tracking this space for a very long time. More importantly, has been with us through this entire demerger, giving us a sense of how it would be. And turns out it's exactly how you predicted. You know, the aluminum business, 522 rupees is where it is listed. You've heard some comments coming in from Anil Agarwal saying that each of his businesses, he does believe, could be about $100 billion in value. The aluminum business itself will be about $5 billion in EBITDA, 10 million tons in capacity. How would you rate the commentary, the outlook, the current state of things that we're in, and the prices, all of them together?
Good morning. So I think, see, aluminum prices have kind of peaked out, and if Anil Agarwal ji is talking about 10 million ton capacity from 3 million ton, that itself tells a story that there's a lot of capacity which is going to come in. And we are expecting 10 to 15 million ton of capacity coming up in Indonesia. So while China has had a cap since 2017, they are stuck at 45 million ton, but other countries are increasing, and there's no shortage of bauxite, which is the raw material for aluminum. So I think $3,600 is kind of peak for aluminum, and a fair range would be more like $2,600 to $2,700. So 532 is an excellent price if investors want to book some profits here.
So, Rakesh, hi, morning. So, for aluminum at 500, you'd say book some profits. That's the call?
Yeah, meaning your own colleague Nigel has put out an excellent, valuation chart in his tweet. I think his number is around 400 something. Our fair value was 432 and bull value was 502. It's beyond that. So I think, this is stretching a little bit too much.
I see. What about the other businesses? What would you recommend? Anything else?
So, let's see, oil and gas would be under pressure because of, the Iran deal. And so our fair value was around 39 rupees, probably opening around that only. So there's not much, in oil and gas, maybe on dips. If things, if it goes to 23 is our bear case value. Steel, our valuation is around 27 and bear case is 15. So, there will be a lot of selling in these, segments because people don't view them as, industry leader or something like that, which is the case for Vedanta Aluminium. So I think, these segments will trade much lower than the fair value.
I see. So mota ho gaya, right? That's the call, Rakesh, across the board.
Yeah. The rally was started in 2020 since the 75 rupee was the, price when they said they want to delist the company. It's 10x plus, you add all the dividends. It's been more like, 15 times since then.
So with the kind of projections that Mr. Agarwal is making on aluminum demand and, the capacity increase that they are going to make from here on, and I remember him saying in the conversation itself that despite him tripling his capacity from current levels, there will still be a gap between demand and supply. How much weightage would you put to that comment and, value the company on that?
Talking about capacity increase and the price increase, the same bread doesn't really gel well for commodities. Already we are seeing that there's large inventory built up happening in China. They have been producing to hilt, but demand has been slow. So the inventory built up in China is around 1.3 million ton. And as I was mentioning that we're expecting large capacity increases happening in second half in Indonesia. And this is going to continue because these are all Chinese companies who are establishing these plants in Indonesia. And if Mr. Agarwal comes through on his capacity, that's extremely bearish for aluminum.
All right, we take that point. Thanks a lot, Rakesh, for joining in and giving us perspective on this listing. It was a strong listing. And as you pointed out, good time to book profits. All four listed entities should come up for you. They are seeing some bit of profit taking from the peak as well. Less than 500 rupees for the aluminum business, lower circuit for oil and gas. Obviously, these are in T2T segments. Iron and steel is the only one which is seeing some bit of traction, listed at 20 rupees a pop, currently at 21 rupees. Vedanta, the overall entity itself, is down by about 1.5% as we speak, down 4% from the peak, just around that 300 rupees mark. What we'll do is we'll slip into a short break on that note, come back, get you more on the markets, a lot of stock-specific action as we're looking at a near 320 gain for the Nifty, 600 points for the Nifty Bank, which is marginally come off the highs, but understandably.
Well, markets, of course, are holding on with the gains and across the board. I mean, 300 points in the Nifty, maybe a bit of a taper off from the day's high. But then, of course, I mean, Friday was a big day as well. It was a 2% day for the markets, and it's another 1.3, 1.5% kind of day. So we've got a full day left, and things will happen, things will move. But if you can just quickly put up the Nifty Private Bank Index, the PSU Bank Index, I think you'll clearly get a sense of which way things are moving. About a 1% pop on the private bank index, and the PSU bank index is up about 1.3%. Lots of NBFCs are doing very well. Shriram Finance, by the way, is the biggest gainer as far as the Nifty 50 stocks are concerned. Across the board, I mean, we've had top opinion from Sunil Singhania, Nilesh Shah, Prashant Khemka, Prashant Jain. One thing, of course, has come through from all 4 or 5 of those conversations. Financials perhaps is the place to be. As a consequence of this, war winding down. So what we'll do is we'll take a quick commercial break here, and we'll ask someone who tracks the financial services space very closely. Lata will be speaking with Macquarie Capital, Suresh Ganpati, on what to do in the financial services space in just a bit. Stay tuned.
Welcome back. As Prashant was saying just before handing over the baton, that the bank Nifty has emerged as one of the best performers in the month of June itself. We have seen a 7% rise in the Nifty bank. That's today's chart, which is showing a 1% gain. But if you pulled up the month to date, or a slightly longer period, probably from the time of the monetary policy, you're seeing a fairly decent jump. As you can see, 6.87 is the 1 month jump. But if you only took it from June, then it's a 7% jump that you're seeing in the Nifty bank. The Nifty, on the other hand, over the same period has jumped by about 2.5%. Much of it coming in the last 2 days, Friday and Monday. The reason why the bank Nifty is doing extremely well is twofold. One, yields are going down, which means banks should be able to borrow more cheaply. This is for two reasons. The expectation is that as crude falls, inflation will not be as high as originally expected. So rate hike expectations are beginning to get trimmed down today. But more importantly, it is the FCNRB announcement, FCNRB deposits, and the ECB OFCB announcements by Reserve Bank. Sorry for all the abbreviations. An FCNRB deposit, the Reserve Bank does the entire hedging. It accepts the cost. Whereas for an ECB, an external commercial borrowing or overseas borrowing by banks, the RBI takes about 1.5% of the swap cost. What this means basically is that banks are going to get cheaper deposits compared to what they were getting from the domestic market. You will be able to get it probably at 100 basis points cheaper from foreign deposits. The impact was immediately seen in the CD market, the certificates of deposit market, which is where banks borrow from the wholesale, from the bond markets. There you saw a 50 basis point fall in the shorter term yields and about a 40 basis point fall in the longer term yields. All in all, it means that the cost of deposits for banks is likely to fall. The cost of funds falls. And that would also mean that the net interest margins could likely rise. A second reason why we are seeing banks do very well is the latest number that came from the Reserve Bank in terms of credit growth. Credit growth in the banking system is at a 5-year high of 17.7%. This was as low as 9 to 10% in mid-2025 calendar. In, say, June, August of 2025, you saw the yields fall, the credit growth fall to about 9%. Compared to that 17.7 growth in credit growth implies that banks are going to make a twofold profit. The amount of loans that they give plus the money they make on each loan. And that explains why you're seeing such a big rally in the Nifty bank. Well, we are still awaiting our guest, Suresh Ganapathy. Meanwhile, let us go to the other market that is absolutely on fire, the crude market in the other way. It is the bears who are celebrating at this point in time. Manisha Gupta for all those details.
Thank you for that, Lata. Well, absolutely, bears are celebrating, and you're looking at fresh money coming into the markets as well. So when you look at the crude oil prices, after 6% of decline in the previous week, we are trading nearly 4.5% on a weaker side right now as well. And with this is the lowest level that you saw in the crude prices on 10th of March. So it's a 3-month lows as well trading into the markets there. Well, interestingly, when you look at the money flows that are supporting shorts right now, the money has been very, very confused when you look at the crude oil prices. A lot of traders actually left in the past 1 month because of the fatigue in investors. There were statements, there were hourly tweets coming in. There were no clarity in sense of availability of fundamentals in case of crude as well. And that was clearly leading the markets to leave in sense of money there. Also, the real world availability, volatility and Trump contradicting tweets was all bothering the space. The open interest in 2026, when you look at that, has declined by 17% on an year-on-year basis. This is the fastest decline that you have seen since 2009, and the open interest is at a July low as well. The 2026 open interest so far is the worst on record. So this is how the monies have been moving out of crude. Longs, shorts, open interest, all of that has seen a decline. But with the kind of moves that we're looking at, the US-Iran reaching a peace agreement aimed at ending conflict and to reopen the Strait of Hormuz by the end of this week clearly has eased the prices. We were at $120 a barrel on the highest level when the conflict was on, and now we are trading at around 83. So a very sharp decline from the highs that we've seen in this year. The agreement also includes the provisions for the dismantling of Iran's nuclear program and economic incentives if Iran does keep up to its commitments. And the text of the deal is expected to come out by 19th of June. That is in Switzerland. That is when the signing is also expected to happen. So it's not just the crude oil prices that have seen a decline. Heating oil is trading at a 3-month lows. You have gasoline prices trading at an 8-week lows. It also is about the cotton prices at a 2-month lows. And everything to do with ethanol and bioenergy in the international markets has seen a decline as well. So palm is trading 1% down at 2-month lows. Sugar has seen a decline to a 2-month lows as well, trading below 14 cents. So everything to do with crude has seen a decline. But the metal prices have been trading on the higher side. So gold prices up 2% in the overnight markets. They are trading above $4,300 an ounce. Silver prices gained 4.5%, back above $70 an ounce. You have copper prices up 1% in the Asian markets right now. Zinc is trading very close to its 4-year highs. You have aluminum prices trading in the positive as well. Zinc especially is also looking at some support because the International Lead and Zinc Study Group says that zinc is in deficit at 19,000 tons in this year. But this is going to be a loaded week, not just in sense of the peace deal that the markets will continue to watch out until 19th of June, but Kevin Walsh is going to hold his first Fed meeting in this week. And then you have monetary policy meetings also coming in from Australia and Japan. We've seen Europe already raise interest rates first time since 2023. So markets will keep a very, very close eye on monetary policies there. And Kevin Walsh's first statements, first monetary policy clearly is going to be a highlight.
Okay, thank you very much for that, Manisha. I was expecting that we are going to hear the Finance Ministry, and that's why we're waiting. Can we cut to the Finance Minister?
So it's a very powerful wealth creating mechanism, the stock market. I've been blessed with one of the most wonderful stock market in the world. There are only 2 countries which are compounded stock markets. One is US, of course, and second is India so far. So I have 2 points to make. One is the only way we can, the way we have gone about in the past is because of relentless growth of 7 to 8%, and that has given to the market 13 to 14% kind of compounded growth in market cap. Now that has created a problem with the FIIs. FIIs today, they hold about $800 to $900 billion of our stock, which is 16% of the market, 33% of the floating stock. In last 10 years, because we have done very well as an economy, our holdings, their holdings have grown at 3 to 4x, whereas my forex reserve has grown just about double, from 400 to 800 billion. Now we have reached a situation where forex reserve is just about 700 billion, and their holding is 900 billion. So their holding to my reserve is less than 100%. So how do we, because they're very important, integral part of the entire system. How do we move forward from here in terms of, this is there as a situation. We are doing very well. Growth is the only way out, and we are pushing the growth ahead. But when you grow at 7.5%, 8%, my corporate profits grow at 14, 15%. And hence stock market will also grow at 13, 14%. That will build their value of the current situation as it is to 1.5, 2 trillion in next 8, 10 years. So do you see, has it been, I'm just flagging the issue the way it comes in my mind. So any comment on that?
But 70% of the growth is ours, while 30% is theirs. 70% is our growth.
Yeah. It is our growth only which is creating challenge for us.
I think you've answered the question yourself in a way. Our own growth, our own participation in the market has really buoyed the stock market considerably. And as is the nature of the market, there are cycles when people make their profit, go out, come back, and so on. But not just leaving it there, between the RBI and the government, we've done some analysis and come up with an announcement last week where the bond markets can be a very good, magnet to absorb those capital which can come in, making it into, FAR so that the compliance routines are not going to burden people, and the withholding tax treatment which we've offered, we think will be the first step towards drawing some capital back, although we've at the moment confined it only to the bond market. But certainly that's not the end of the story. We'll be doing more. We recognize we need more foreign capital to come in. But the fact that RBI has now allowed public sector undertaking and banks to go out and pick money from outside, giving them a framework in which they can do it. And in that framework, a very important aspect is the hedging is at the RBI's expense. They don't have to hedge for the risks, particularly the currency-related risk, the volatility, the exchange rate risk. That will be on RBI. And as a result, the banks can now go unfettered to raise capital from outside. So we have taken a very calibrated approach to make sure that the markets do receive the required investments.
Another point. Hello. Yeah. Another point which is more positive is that because of there is an unprecedented capex boom all over the world, thanks to AI build-up, which is one of the largest build-out all over the world. Second is defense preparedness. Third is energy transition. And fourth is GCC boom in India. All these four are combining into massive opportunity, even to Indians. I mean, whether in various forms, and it will become even more. But some of these opportunities are very, very short-termish in character. Like it may be there 16 months, 18 months, 20 months. So we need to respond to these opportunities very, very fast. Some of the corporates I met, they said, sir, it is not about the demand. It is about how fast we are responding in terms of supply, whether it is from regulatory side, whether it is from permission side, whatever it takes in India to get them moving, because that can also bring a lot of forex. So they are saying it's a real challenge is supply side. Is it in the minds of the government?
Of course. In fact, we've been engaging with the states, not just the center to have a policy on data centers and GCCs, but also talking to the states to make sure they understand that these are going to be immediate job-generating investments. I'm not sure if it is 15 or 16 months, but it is certainly going to be, at least in the coming decade, a predominant way in which data is going to be used. And as long as it is happening in India, I think it's good for the data security, and also in the process of creating the jobs, you will give a certain vibrancy to the economy.
D-Street cheers. The peace deal signed in Geneva on Friday. The Nifty opens with a gap up of over 1%, eyeing the 24,000 mark. Broader markets outperform with the metals leading as the sectoral gainers. It's the pharmaceutical stocks which see a wee bit of profit taking.
The peace deal between the United States and Iran sparks a sharp fall in crude oil prices, which dipped below $84 per barrel. Interglobe Aviation is one of the top gainers, up close to around 4%.
Crude sensitives also surge in trade as crude oil prices slump, refineries rally. It's the paint stocks which see an up move. Alongside that, we also see travel operators surge, further aided by a bullish Motilal Oswal note.
Peace deal sure lifts L&T. The stock was badly beaten down when the war did start because of its significant exposure to West Asia.
Tata's demerged entities list on the exchanges. Chairman Anil Agarwal tells CNBC TV 18 that every business can be a $100 billion company and adds that he could look at relisting Vedanta Resources. He also says the aluminum business capacity is headed to about 10 million tons per year over the next 5 years.
Well, hello and welcome to Chartbusters.
We'll just say cheers because there's not much that needs to be said right now apart from the fact that the market is definitely cheering the peace deal that has been announced between US and Iran. Now, be that as it may, the uncertainties aside, the street still believes that this is a fairly significant peace deal, and the price is telling you that. Closer to 24,000 on the frontline index, oil prices moderate, and we have seen all the other parts of the market outperform. The Nifty Bank is something that we'll be keeping an eye out on as we move on in today's trading session. That's largely because it's been outperforming over the last few trading sessions, did well in today's trading session as well, but now has come off marginally from the highs. The important part is that, the financial trade is moving now below the banks and going into NBFCs and going into all the other players of the financial space as well. So if you look at something like a Bajaj Finserv, Bajaj Twins, all of them doing well. Shriram Finance is among the top Nifty gainers. Commercial vehicles, rate sensitives, all of them doing better as well. Perfect time as any to then get a technical check on the market. We have Shivangi Sarda joining in. Shivangi, the market's doing extremely well. But the question is, should one chase this gap up or should one wait?
Morning, Mangalam and Eicher. Of course, market is taking cues from the color of your tie. And we've seen that, the markets are kind of holding at the higher levels, which is quite positive. And even after the gap up multiple days on Friday as well as today's session, we're seeing that a good amount of short covering has led to stabilizing Nifty levels over here. Of course, India VIX has also kind of cooled down significantly, which is adding to the momentum. And the fact that it is below 15 is, signaling that there is comfort in the market right now and any declines could be utilized for buying. We've seen that June has been slightly volatile, but July seasonality-wise has been positive, 80% of the time in the last 10 years. So overall, good momentum expected here, and these dips should be utilized to accumulate good stocks. Immediate basis, we are expecting 24,200 levels, and the support could stand at 23,700 zones. Talking about Bank Nifty, of course, this has been the major driver in this immediate rally. And we've seen heavyweight private banking names adding to the, this rally, and they've done most of the heavy lifting from the last 8 odd trading sessions. Today, we're seeing some bit of profit booking at the higher zones, but then again, we are expecting this index to again consolidate slightly because that after the rally of the last few days, we've seen consolidation is also healthy at these levels. Now we're expecting 58,000 and 58,500 on the Bank Nifty index with a support of 56,850 zones.
Got it. What about individual stocks?
So individual stocks, first up on my radar is Eicher Motor. We've seen the entire auto pack is doing quite well, and a good amount of attraction can be seen here. Now, of course, with the entire sector tailwind, but this stock individually has also surpassed its previous hurdle zones, which it was unable to from the last 40 trading sessions. Now, volumes have added up in the last 3 sessions, and RSI is also showing a positive divergence here. So this one's quite positive with a good amount of short covering as well. We're recommending a buy here. Now, Eicher Motor, the next targets that one could look at is 7,900 and with a support of 7,350 zones. And the second pick on my radar is NAM India. We've seen this entire sector pick up, and this one has been quite a stable one on the weekly basis, consolidating from the last 7 odd weeks. But now momentum is picking up from the 50 daily exponential moving average. And this one's looking quite positive for a good up move. So we're recommending a buy here with the next target of around about 1,200 levels and a support of 1,100 zone.
All right, Shivangi, thanks a lot for that. You did say that the market's taking cues from my tie, which is green, but I hope that, the economy takes cues from Nigel's tie and returns to the pink of health. You have something to say to that?
Absolutely. I would like to see that as a pink and not red.
That is pink. That's
pink. That's pink.
Hot pink, if you must.
Okay, all right, Shivangi. Always good to have you on the show. Catch you soon. Well, time to slip into a short break. On the other side, the management of G&G Electronics will be joining in.
Welcome back. You're watching us here on Chartbusters. G&G Electronics, that was a stock on our radar, doing extremely well in the last couple of days of this the previous trading week, and that's because after the promoter sold 4% stake to a host of mutual funds, there were fairly strong buyers in that as well. We do have with us Sharath Khandelwal, founder and managing director of G&G Electronics, to join in and discuss the growth outlook for the company. Thanks a lot, Mr. Khandelwal, for joining in. You know, last couple of days the stock did well largely because the promoter sold stake to actually, meet the minimum public shareholding norms. Top mutual funds were buyers. What we want to understand from you is the 2 to 3 year growth outlook, along with dissecting the refurbishing industry as well. Now, if we look at your last year's performance, the full year you did about 34% revenue growth. Fourth quarter itself saw an accelerated growth, around 43% out there, and margins were slightly shy of that 10% mark. You've guided for about 25% growth in FY26 with 11.5% margins. Why such a low growth target when you've already done over 30% in the previous financial year? Is there a chance that you could outdo your guidance? And on the margins, what would be the drivers?
Thank you, Mangalam. Thank you for inviting me. We have good headroom in front of us and very strong tailwinds. We have given conservative guidance in our earning call, and it's better to be conservative. If at all we have to revise our guidance, we'll do during our next earning call, which should happen in first week of August. The growth in this sector is immense. We have witnessed very significant price rise in brand new computer, propelled by not only shortage of memories, but SSD and processors also. The prices have risen in brand new side by 50 to 60%. IDC has projected global computer market compression, brand new computer market compression by 11.3%, which was like 284 million in 25 to 60 million in 24. That will leave a gap of around 30 million, even if we don't factor in any growth in computing demand. But a very important point to note that the computing requirement is not going down. The brand new computer sale will go down, and that gap will be fulfilled by the refurbished segment. And we are in a very good place to take advantage of the same, because we have created a strong positioning for us, not only in India, but across the world, where the products sold by us are like new in terms of functionality and cosmetic, and our warranty is very credible. So people want to buy refurbished products, but they were not able to buy. But we are solving the trust issue. Trust is a huge margin lever here.
Okay, all right.
Unambiguously clear in that it's going up. Yeah.
Okay. Hi, Mr. Khandelwal. Thanks a lot for speaking to us here on CNBC TV 18. A quick question: what kind of volume growth are you looking at for this year? If you could help us out with that, is there an upside risk to that? And also, there are two elements: volume and pricing. How much will prices move up?
So thank you, Nigel. The volume growth, I will talk within the framework of guidance. The volume growth is around 22%. The pricing growth at this point in time, we expect 3%. But yes, as I did mention, we have now good headroom and strong tailwinds.
So
we are being conservative.
I understand that you're being conservative, which is why I'm trying to get a more realistic picture out here from you, and not just a conservative picture, because you've been doing well in the past. The industry by itself, refurbished market, is expected to grow at around 30% plus CAGR. In that, you are guiding for 22% growth. That's just mathematics, right? Because you expected the computer industry to compress by about 11%. Yes. The refurbished industry is growing by about 30%. You minus that gives you 21 to 22% in terms of volumes. But what we want to understand is what is a realistic number that you can do? Because this, after you've just sold 4% stake in the company, top mutual funds have bought it. So obviously everyone wants to know what the realistic growth picture is here.
I can only tell that the minimum growth is what we have guided, but realistic growth hopefully should be more, and will come with the guidance during our earning call. But I think I have expressed my thoughts very clearly. We have very good headroom and tailwind and good margin drivers available with us. The overall three strengths that we have, which is the procurement strength, global procurement, refurbishing strength, and very strong distribution network that we have, they create a very good compounding business model.
Okay, all right. Yeah. Mr. Khandelwal, what about margins? You mentioned margins a few times, as a passing remark in this conversation. You're guiding, I believe, for 100 basis points improvement in comparison to last year. What are the drivers out there?
So obviously our proposition is getting wider acceptance and we have established new distribution partnership across the world. In India, we have partnered with very top distributors which were only selling brand new computers till now. And we are reaching more close to customers. Business is our ultimate customer. Business education sector is our ultimate customer, and there is a greater acceptance due to quality, consistency, and warranty. So even the headroom was always available with us before the shortage came in November, and now the shortage is also presenting a good headroom for margin expansion, because any which way we peg our product around 30% of a brand new computer. So even if we move it to 35%, you can imagine what kind of margin expansion it can come our way.
All right, we take that point. Just a final question before we let you go, and this is a two-part one. First one, the street wants to know whether you will sell any more stake or not, or now that you've met that 75% norm, this is it. Can you give us a one-word answer on that?
No. Yes. No.
So you are not going to. You said no and yes.
Mr. Khandelwal, that was a tricky one.
Oh, no. I'm sorry. You asked, can you give me a one-word answer? Then I said yes. The answer is no.
Okay, so you are not selling it. Perfect. And working capital days, 178 days. They've been increasing over the last 3 years. It's an inventory-heavy model, right? So where does that settle?
No, when working capital days, if you see the projected sale, it is not that historical basis. Obviously, they appear to be high. There is obviously a scope of improvement there. But at this point of time, let's remember one thing, that working capital is the only investment that we have. We don't have any fixed capital or machinery kind of investment. It should moderate, obviously. When we see on the projected level, they don't appear to be that high, and we have to secure inventory in advance given the current situation of price increases.
Take that point. So your investment is basically inventory, and that's why the working capital days are higher.
And the partnership with distribution partners, which is giving greater access to the business customers around the world.
Thanks a lot for clarifying that. Your growth guidance, margin expansion, as well as saying unequivocally, no more stake sale coming in the very near future, at least. With that, we take a short break, come back, get you more on the markets and a lot of stock-specific action on the other side.
Welcome back. Well, the markets have briefly gone ahead and kissed the 24,000 odd mark on a Monday morning. So the bulls will be quite enthused, currently at the high point of the day. But the rupee as well as is up by close to 0.5% today, in sync with most Asian currencies, celebrating the potential opening of the Strait of Hormuz and the fall in crude oil prices. For the same reasons, the Indian bond yields as well have fallen to 2-month lows. Lata joins us to tell us about all the money market action. Well, Lata, it's not just equities. The bonds as well as the rupee market are very well behaved.
Absolutely. It's a huge sigh of relief for even policymakers, because where it hurts most in policy making is not the fall in stock markets, but the fall in the currency. And it was a one-way street. Now, clearly today and as on Friday, the market is rising in its own ebb. And I want to dwell a little bit on this. Actually, the FII shorting, which is very much seen in the NDF market, the non-deliverable forwards, or the outside offshore market, had actually stopped a good 2 weeks ago, because the rupee at 96 was seen as having had all the bad news. Now what we are seeing is domestics coming in and offering their dollars, clearly understanding that at 95 we are not going to see this 95 again, so let's sell it now. We are seeing corporates, largely exporters, but also some importers who are overhedged, coming in and supplying dollars. I must say that this is an all-Asia trend at this point in time. Indonesia has, the rupiah has rallied actually over 1%, and so has the Filipino peso. All of them are also rallying, but the rupee is rallying for the second straight day. Domestic selling dollars is very important. Now, there is one bit of a debate in the market, with some dealers fearing that the Reserve Bank will stop too much of an appreciation, because in that case their hedging cost of the FCNR deposits could rise. But there are a bulk of people who are absolutely dissenting against this. Their point is that the Reserve Bank's bunch of steps was, a test of their resolve to stop the falling rupee and actually reverse the trend. So any kind of dollar buying to stop appreciation is absolutely unlikely. Figures on the street are between 93 and some going to even 92.5 for the dollar rupee, as the FCNR deposits start coming in, and as the end of the war becomes more crystal clear and the Hormuz Strait actually opens. I must bring in a word on bond yields as well, because that impacts the entire economy and all of us. You've seen the yields fall to 6.85. The high that they had seen in May was 7.17. So we're talking about, a 35 basis point fall in yields, and you're seeing that benefit impacting NBFCs in particular. NBFCs today are rising more than bonds, more than banks, for the simple reason that they are borrowing from the market, but banks also will get a mark-to-market benefit and probably cheaper deposits as well. So all interest rate sensitives celebrating the fall in yields and the rise in bond prices.
Take that point entirely, Lata. Thanks a lot for that. So NBFC is doing extremely well. Just take a look at HDB Financial, which is up around 9.5%. And across the board, there is a fair amount of buying. But just before we wrap up on this edition of Chartbusters, pull up the intraday chart of the Nifty IT. The IT index has been a rank underperformer, but today it's finding signs of buying, currently at the high point of trade, and that ensures that the Nifty stays above that 24,000 mark. With that, Nigel and me, thank you for watching us here on Chartbusters. You stay tuned. Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia. 24,000 is on the screen, and to see that, Ritu Singh is joining us from Bangalore as well. Albeit for a brief period, yes, but we still have an entire day left, and 24,000, the bulls would hope that it sustains on the screen. So it's a good start to what is a very important week for our own markets as well, especially considering the US-Iran peace deal that has been announced, at least as of now, and as a result of which markets across the globe are cheering this news, be it in Asia, be it the US futures. Oil prices are down, precious metals are up, bond yields are falling, the currency is appreciating. Everything that could possibly work well for our markets did so on Friday, is doing so today as well. Morning, Ritu.
Good morning, Hormaz, and that's why you're seeing almost 7 stocks are advancing for every 1 stock that is declining. It's looking good on the markets. The big picture is looking good. 24,000, we touched that, but now we're just slightly below that. 23,972 is where we're at. We're still up almost 1.5%. That's good gains to hold on to. Let's see if that rally sustains. The Bank Nifty adding to the momentum, up by 1.2% almost as we speak, and the IT pack also doing pretty well. Pull up the India Volatility Index is below 15 for, after a long time. Perhaps this is the level we saw just before the Iran war started. That's down almost, 5% as we speak. So that tells you about the mood of the market as well. Pretty much everyone participating in this rally. Metal is the top gainer, auto, realty, financial services, all of them doing very well. Some pharma stocks are sulking in trade, on specific news. But apart from that, it's looking pretty good, trading on optimism today. The rupee that you spoke about, that opened at 94.68 to $1 versus Friday's close of 95.11. And this is the highest level we've seen since the 8th of May. Now, of course, you have the rupee trading at around 94.52, driven by that, of course, promise of a peace deal between US and Iran, which has sent oil prices sharply lower. That, in turn, is the fuel for today's rupee rally. And, this collapse in oil is triggering a broad risk-on move across asset classes, equities, all the Asian currencies, bond yields, all of them rallying. Oil prices, in fact, at the lowest level that we've seen since March. Both the major benchmarks, we put up that for you, they've dropped by more than 4% because of this geopolitical risk premium rapidly unwinding on the back of that promise of a deal. Currently at about 83.51 is where the Brent is. The 10-year bond, that opened at a 2-month low as well, 6.85. It's down quite a bit from the previous close of 6.92. The logic, of course, is straightforward. Lower oil prices, lower imported inflation fears, and that reduces the pressure on RBI and is lifting bond prices. But Hormaz, over to you for specific stocks and news.
Right, and there are plenty of them. There were plenty on Friday, and most of them are led by this short covering move that you are seeing. It's from the recent swing lows of around 23,150 odd. The Nifty is up almost 800 points now in just a matter of a few sessions. So, it would not be a surprise if you see some bit of resistance at that 24,000 mark. May also see some profit booking as well. That could be par for the course. But in case the index does manage to cross 24,000 and sustain above it, that will be viewed as a big positive by the bulls. We are above that one important level of 23,800. 24,000 is the next important level to watch. Now, of course, you spoke about oil prices, you spoke about the appreciation in the currency and on the bond yields as well, which is having an impact on the PSU banks and a lot of these NBFCs. You just heard Lata why so a few minutes earlier. But of course, no bigger impact of the falling oil prices than on the oil marketing companies. They were up and about on Friday's trade. They are continuing to do so as well. HPCL set its record date for its dividend payout on Friday. It's 5% higher here. BPCL up 3%. IOC too trading gains of around 3.5%. You take a look at the stocks which have an exposure to West Asia. The big ones being L&T, of course. L&T has now turned positive on a year-to-date basis after this 2-day up move that the stock has seen, was up 5% on Friday, another 3.5% today. Kalyan Jewellers, though, is seeing a big short covering move on the upside, 8.5% higher on in today's session. Most of the other West Asia exposed stocks are seeing some choppy moves. But the travel names are the ones that are doing well. It's some positive brokerage note coming in from Motilal Oswal on TBO Tech. Of course, 7% higher on the stocks. Travel Food is up 6%. And Leela Palace Hotels too trading with gains of around 10% in today's trading session. The CVs and the CV financiers did very well on Friday. They are doing equally well today, if not more. Ashok Leyland was up 10% on Friday. Has added another 4.5% to that. Shriram Finance was the top Nifty gainer on Friday. Remains so in today's session as well, and Tata Motors commercial vehicles too, after a significant period of underperformance, has seen some bit of covering from lower levels, another 5.5% added in today's session. And lastly, stocks that are seeing a 52-week high, there are plenty of them, but APAR Industries though, they can't not talk about it, because ever since the management spoke to us last week, the stock has been on a tear, 6% higher in today's session as well, another 5% added on Minda Corp, and IFCI, which was up 20% on Friday, has added another 4.5% to its tally, Ritu.
All right, Hormaz, thanks very much for setting that up for us. But let's focus on the macros. That is very much the story of the day on the back of that, promise of a peace deal between the US and Iran. Of course, the officially, signing still has to happen. So we're still trading on optimism. But what does all of this mean for the Indian economy? Let's bring in Soumyakanti Ghosh, Group Chief Economic Advisor at State Bank of India, who joins us now. Mr. Ghosh, thank you and a very good morning to you. Like I said, we're still riding on optimism. The deal is yet to be signed. Hopefully that happens on Friday without any kind of issues. But, given the move that we've already seen in oil, the recovery we're seeing in rupee, to begin with, how does the macro math change? I mean, what kind of sustained levels do we have to see, to be able to say confidently that some of these worries about imported inflation, etc., the pressure on CAD will begin to ease?
Yeah, thank you, Ritu, for having me on the show. I think, first of all, it's a very good news that the deal is possibly going to be stuck. I understand that the deal could be signed on the 19th of June, so which is just only a couple of days away. So that's the first thing. The second thing is that we'll all hope that this deal is not short-lived and long-lived and gives a solution to the Middle East crisis, which has been brewing now for the last 3 months, if I believe it is correct. I think last 3.5 months. So any solution will be greeted by the market very emphatically, and that has been the case today also. And so these are the positive points. On the macro front, I think the most important point to note is that if I leave aside the interest rates and the other things for the time being and concentrate purely on inflation, I think inflation has perhaps continued to surprise a little bit on the downside. Even this month, inflation number, the street was expecting an inflation number in excess of 4%. It came in a tad below 4%, I think around 10 to 15 basis points lower than the market consensus. Last month also, the numbers were on the lower side. Core inflation continues to be contained and around the same levels that with the headline inflation. I think both of them are converging. And the only worry is that the rainfalls are significantly delayed this year. I think the cumulative rainfall shortfall is now close to 30%. Hopefully, if the rains pick up, that will be good news. Otherwise, the prospect of an El Nino and others is now haunting us, and that could actually act as a bugbearer for inflation numbers or other economic activity going ahead. On the other front, I think the current account deficit, after this FCNRB implementation, hopefully the current account deficit will now trade much lower. The fourth quarter current account deficit was again a surprise. I think the positive things in there, apart from the market volatility, all the macro numbers are throwing a surprise. The current account deficit was a surprise on the back of strong remittances in the month of March, which may have been front-loaded because of the Gulf War. And also the GDP growth rate for the last quarter was again a very positive surprise at 7.8%. I think the market was 50 basis points higher than the market consensus. So overall, I think macro numbers has continued to surprise us positively, but we have to be very careful going ahead because the monsoon is going to be one of the reasons. The news on El Nino is not that encouraging. Hopefully, I think the clouds will now come in instead of going away as the common parlance.
But more immediately, Mr. Soumyakanti Ghosh, with the expected oil trajectory, let's keep fingers crossed that this deal does materialize by Friday. We see it getting signed. How does the outlook for inflation immediately change? Of course, oil was a risk. Perhaps that's receding a little bit. But now you pointed out monsoon is a bigger fear factor. And then what does that mean in terms of RBI's rate hike trajectory? At least thanks to some of the easing of pressure on the inflation front, perhaps on the rupee as well. Do you think the immediate worry that we could see a hike in August or even October, that at least we could set aside?
Yeah, I think Ritu, on the inflation front, let's first take the question on inflation. I think on the inflation front, the RBI has clearly said that the assumptions of crude is around $85 per barrel throughout the year. If it goes to around 95, which is also the assumptions of the IEA, the inflation number will be around 5% or higher. And that's exactly the RBI projection at 5.1%, which is also our projection. So that's point number one. The second point is on the rate hike. I am still not significantly convinced of an early rate hike or even later. We are keeping our fingers crossed, and it will be completely data dependent, because please note that the 90% rainfall shortfall projection which the IMD has given, that is the weakest since 2001. So I think with such a strong, weak forecast of rainfall, delayed rainfall, and the growth consideration could actually take center stage somehow down the line. If that is the case, I think the RBI will take a considerate call on possibly a rate hike, because if the recent measures are any indication, that are largely positive, and that would bring a significant amount of liquidity into the system. So this means that the questions on this deposit and credit growth widening could subside, at least for the time being, or in the second half of the year. But on rate increases, I think the fears of an immediate rate increase, I am not so much convinced, given that the Reserve Bank may like to look through the cycle, the rainfall, and then take a considerate call in the second half of the year on the outlook.
Right. Mr. Ghosh, is this a bit of a catch-22 situation for the RBI? Because on one hand, there is a potentially receding headwind in oil prices, and then there is a potentially upcoming headwind in the form of a subpar monsoon, as you highlighted as well. In that case, where does the RBI lay its emphasis on? Does it look to focus on the growth trajectory, or does it look to manage a potentially rising inflation? Well, yes, oil prices are falling today, but then there will always be this risk premium that will be associated with oil, because supply chains are not fully back to normal yet.
Exactly. I think we should not, I think why will we celebrate this deal, but I think to be very cautious on the oil front, because there has been a significant damage to the Middle East infrastructure, and it will take quite a while to build up that infrastructure. So oil prices cannot go back to the earlier assumptions around 50 to 60, which was being forecasted. So it could at best stay at this level, some rally, and it could stay at this level. But the good thing is that even if stayed at this level around 90, that will be good news for India. On the other front, I think it's going to be a very delicate situation of the central bank. It has to look through the growth consideration. It has to look through the rainfall. And if the rainfall if the rainfall is at least, is lower than what the RBI, the forecast actually gets completely downgraded over a point of time. From 92%, it is downgraded to 90%. Maybe if that gets downgraded, that will of course be a concern. While the link of the drought with the food inflation is not given, because there are years when there has been the rainfall has been not been that adequate, but food inflation has been contained. But I think a bigger worry for the Reserve Bank is that in spite of the increased fertilizer prices, against the background of the Middle East conflict, one crisis is subsiding, but another crisis could actually start in terms of an inadequate rainfall. So I think that should be the priority 9 for the central bank.
Just to sum up all that we've discussed, as a result of these, what is your updated? Will you revise the growth number upwards? Do you see a lower CPI number for the year? What is the CAD estimate? These 3 headline numbers, Mr. Ghosh.
No, I think as of now, we are comfortable with, and we are actually given out earlier a projection of 6.6%. So I think we are comfortable with the 6.6% number at this point of time, which captures both and it's evenly balanced, which captures both the upside and the downside, we believe properly. Inflation, we are at around 5.1%. There is possibility of an upside to the inflation numbers. And on current account deficit, we believe that a deficit of around 1.5% could be reasonable to assume, with a capital inflow around 55 billion in the current year after the implementation of the measures.
All right, Dr. Soumyakanti Ghosh there. Thank you very much for joining in with how the macro math may change as a result of this deal getting signed and the resulting reactions we're seeing. on the crude and on the rupee. Thanks very much for that. We'll slip into a short break. Up next, we're going to focus on the bond markets with Manisha Gupta when we return.
Welcome back. The index still around about 350 points higher, trying to cross and sustain above that mark of 24,000. A couple of stocks before we move on. HDB Financial is one such name, 9% higher on the stock, the biggest single day gain in nearly a year now. And from the 52-week lows of around 550 odd, the stock is back at 700 rupees. Of course, still below its IPO price, which is at 740. And Swiggy is one other one that's popping up in the list of gainers today, 6% higher on that one as well. Of course, another rank underperformer, well below its issue price and well below its post-listing high as well. As promised, shifting focus to the bond markets then. Manisha Gupta is here with the latest. Manisha.
Well, thank you so much for that. It's a definite decline for the bond yields today. The G-Secs are doing 2-month lows and the corporate bond yields for 3 to 5 year bonds also have seen a decline. This comes in from the pressure in sense of crude oil prices. Remember, we have seen 6% of a decline in the previous week. It's open nearly 3.5% on the lower side today as well. Peace deal between US and Iran is something that the street will watch out for. Expectations are that there could be a signing happening in Switzerland on 19th of June. And that is when we would have a detailed text also of what the deal really looks like. But until the deal is done and after that as well, it would be 90 days before we see a final resolution on what both the countries are looking at. The public sector banks clearly have been the most active participants when you look at the secondary markets therein, and that is where the liquidity majorly seems to be coming in from as well. A bit of an easy day today, and that is where the support is from. If you look at the bond issuances, well, we've seen a slight decline on Friday vis-a-vis where we were on Thursday, and that's exactly what the secondary market did as well. Friday was slightly weaker a day in sense of bond issuances and the number of deals and volumes done as well vis-a-vis what was Thursday, but today promises to be a stronger day. Remember, it's a loaded week as well. It's not just about the Switzerland signing between US and Iran. It also is about the monetary policy meetings that you have in Australia, in Japan, and the most important, Kevin Warsh's first Fed meeting that also is in this week itself. There also are private bond issuances that you should be keeping an eye on. First one on my screen is Aditya Birla Capital. They're looking to raise 16 billion via 2 bonds, including a reissue as well. And then you have Geo Credit Limited looking to raise 15 billion as well. They are doing this via 5-year bonds. You also have ECAP Equities looking to raise 2.25 billion. They're doing this via 2029 April bonds. InCred Financial Services is in the market looking to raise nearly 1.5 billion. They are doing this via 2-year bonds. And then finally, you have Finserv Financial Services. They have invited bids to raise nearly 1 billion, and they are doing it via 2-year bonds. All of those biddings, by the way, are today.
Thanks very much, Manisha, for taking us through that. We'll slip into a short break, but when we return, we're also going to be discussing market technicals with Saumil Mehta from Mirae Asset Sharekhan, so stay tuned for that. Welcome back. You're watching Trading Hour. As promised, let's get you our guest for the day. Somal Mehta, Head of Retail Research from Mirae Asset Sharekhan, joins us now for a quick technical check of the market. Somil, it's been a good start. We briefly touched at 24,000. Now we're just below it. 23,972 is where we're currently at. What are the important levels near term that you'll be watching out for on the frontline index? Where could we go from here? And in the current market, what are your top stock picks?
Good morning to everyone. See, the bias is definitely positive. We've broken out of our range, and I'll be expecting a good momentum continuing from here. The most important key level at this point of time is the 200 daily exponential moving average, which is around 24,400, 24,500, around those levels. So that will be a crucial hurdle for the markets, and I think that will be crossed in the medium-term outlook. The second hurdle, which is 24,600 levels, which is the previous swing high on the quarterly charts, that will be a crucial hurdle as well, but that would be my target. 24,600 would be my target in the short to medium term outlook. If we close above that, then the next level will be 25,100. So these are some very crucial levels on the upside. On the downside, 40 daily moving average, which is around 23,700, that will be a crucial support for the markets. I will not be expecting markets to go below this level. So, and the bias would be buy on decline, positive bias. And I would be, suggesting to still be more stock specific and sector specific from these levels. Bank Nifty, very similar. My targets would be around 59,200, which is the previous swing high. And the support would be around 56,700, which is the previous swing highs, gap area where there is a very crucial support. There are two stocks which I've chosen for today. One is from the auto, Tata Motors passenger vehicles. It has taken support at 200 daily exponential moving average, sustaining about 200 daily moving average after a very long time. We have seen an ABC corrective completing on Tata Motors, and I'll be expecting this now, the new move on the upside to start and continue. The targets would be 442 in the medium term outlook, and my stop loss would be around 380. The second stock I've chosen is L&T. L&T is again very similar. Consolidation about 200 daily exponential moving average. This consolidation has broken on the upside, trading above averages. Great setup. In the medium term, stop loss would be 4,000 and my target would be 4,600.
Somil, pleasure having you today. Thank you so much for sparing time and joining us with your views on the index and on specific stocks as well. Take a short break. Continue our conversation on the markets with Seshadri Sen from MK Global Financial Services on the other side. Welcome back. Still holding on to those levels above the mark of 23,950 is the index. Good time to get in the latest trends from the F&O space. Mangalam is joining in from the F&O desk. Mangalam.
Well, it's understandable that we're seeing some bit of, profit booking at the higher levels. But the important part is that it is a very strong day of trade so far. The Nifty Bank, after having seen a bigger rally, is moderating a little bit in the sense that it's not growing as fast as the Nifty, but it's still higher in today's trading session so far. The mid-cap index is also outperforming. So the sentiment is fairly strong. The good part is that over the last half an hour or so, we did see some traction build in the IT space as well. So that's an important segment to track for the market. So let's see whether the IT stocks can get, some of their fervor back. If that happens, then, you have 2 or 3 engines fighting for the frontline index. The India VIX is moderating, so that's a positive. Alongside that, you have the benefit of a lot of FII short positions. So, the start of last week, the FII longs were just around 9.5%, rather 7.5% to be precise, and that jumped all the way up to 12% throughout the week. But still, the FII positions are 88% on the short side. And as we speak, if you look at the Nifty futures, the open interest is down with the Nifty futures being higher. The Nifty financial services as well, the futures of that index are, seeing some bit of long unwinding. And as a result of which, we are seeing a fair amount of shorts being covered, at least on the Nifty. So that's something that we will monitor as we go along. And the short covering is not just limited to some of the index futures. If you look at the calls as well, all those were written the 23,600, 23,700, 23,800 calls, hoping for some resistance to come by, then have been caught on the wrong side. So they are swiftly unwinding their positions, and that's caused this up move in the frontline market, and that's holding it up as well. And while that has happened, a lot of the put writers are back into the fray as well. So 24,000 put writers are very active, telling you that maybe if the Nifty crosses above that 24,000 mark, there will be a lot of support coming in at the psychological mark. But right now, 24,000 put trading at a premium of near 120 rupees tells you that the support of the market has moved higher towards the 24,850 to 23,850 to 23,880, 890 thereabouts. So we've also seen writing at the 23,900 put. The Nifty put-call ratio slightly higher, but it's moderated from the peak today. So that's creating some headroom for growth as well. And the important part, despite this up move that we've seen, there are some technical supports that are very strong for the market. The 50-day moving average, 23,719, is an important support on the lower level. And on the way up, for the next leg of rally to come by, we will have to have the Nifty cross that 24,300 mark, which is the 100-day moving average. Because once we do cross that, then the road to 25,000 opens up, because that's where the 200-day moving average is.
All right, Mangalam, thanks very much for setting that up for us. It's a good time to invite Seshadri Sen from Emkay Global Financial Services for his views on the market fundamentals and sectoral picks. Seshadri, thanks very much, for joining us here, for taking the time out. Let's start with the news of the day and the reaction that we're seeing on the back of the promise of that peace deal on oil prices and the subsequent macro effect. Besides the obvious sectors, the oil marketing companies, the auto, so some of the aviation names, paint companies, where do you think, we'll start to see some of the gains? Financials, for instance, where we've seen heavy FII selling. Could interest return there?
Yes, so beyond these obvious sectors, there are two other themes I think that will play out for the remainder of the year. One, as you alluded to, financials gains indirectly, because we've seen a little bit of tightness in domestic liquidity, and fairly obviously with the kind of pressure that has come under the rupee, it does flow through to domestic liquidity, and short-term rates have been high for the last 3 or 4 months. We think that will start to moderate, and that always has been a powerful catalyst for the financial sector, because most, even banks and NBFCs, most of their borrowing are in the 1 to 2 year bucket. Some of them spill over into 3 years. So when that borrowing comes down, there is a general feel-good factor that spreads around that entire sector. We've already seen the credit cycle recover very sharply from the second half of FY26, and we expect that momentum to continue. So financials as a short-term, as a second-order beneficiary of this is fairly obvious. You could play through some of the wholesale borrowing dependent banks or some of the NBFCs. I think the NBFCs, which have underperformed for some time, are showing a very strong recovery today. The second is the consumption cycle itself. We've been talking about it since last year after the GST cut. we did see a very strong recovery in the consumption cycle. There was some skepticism of whether it would spill over into FY27, but the track record so far has been quite good. Now that this headwind is out of the way, there is uncertainty. There was uncertainty about supply chains, prices, availability of finance. All of that is now out of the way, and I think the momentum in the overall discretionary consumption cycle in India will continue to be fairly strong. So these are two second-order beneficiaries that we see. Consumption, and there again, autos comes into play as one of the best ways to play this theme, and financials.
Seshadri, morning. Thank you for joining in. You mentioned autos. A specific question on that as well. The numbers so far have been fairly strong, fairly robust. Yes. And the commercial vehicle segment also is an indirect beneficiary because of the falling oil prices, then therefore the costs coming down and so on and so forth. But the entire sector right now is heading towards a bit of a headwind in the form of a subpar monsoon forecast. And if that happens, does the entry-level auto segment gets impacted because of a subpar monsoon, and therefore the commercial vehicle cycle as well, particularly so on the tractors front? And then, of course, because of a subpar monsoon, if inflation goes up and so on and so forth, that second-order impact on the sector to be felt as well?
I think the impact of the monsoon will be a little bit overdone. Yes, there is some impact. Different categories will obviously have different levels of impact. And, as you just discussed, for example, the tractors is disproportionately hurt. But there are other tailwinds for the sector which should be able to allow this industry to be able to deal with a slightly subpar monsoon. We also note that, in the last few times that, monsoons have been, the government's done a very good job in keeping inflation under check. So yes, rural incomes and farming incomes may get impacted if there is a drop in overall crop production. But for the rest of the ecosystem, the second-order impact on inflation, etc., may not play out as badly as it has, say, 10, 15 years ago. So I would be, I wouldn't worry too much about a subpar monsoon. Yes, it will have an impact. It will be different across categories, but there are enough tailwinds to carry the industry through that kind of a blip.
So, Shadri, be that as it may, that's the auto side. But what about the consumption side, the FMCG names and the rich valuations there? You see a further upside, you see some of the demand getting hit. And, very quickly, also, if you could share your thoughts on the pharma pack, which has been doing relatively better of late. Do you see further upside in the near term?
Yeah, we are sort of neutral on pharma, stock selective, and I think that sector will continue to do well. It's a good, nice structural play. Valuations are a little stretched, but the quality of earnings is improving across the board. So some of those valuations are worth paying. They're not a high beta sector which will immediately explode, upwards. But from a long-term compounding perspective, we continue to like pharma.
As you mentioned, financials, yes, but you've initiated coverage on the textile names recently. The tariff impact has almost now become a story of the past, right? Because most of these stocks are already looking at recovering from those lows, and they are finding newer markets as well. What's driving your thesis behind this textile names?
Well, I think the FTAs are a significant structural positive for the textile sector. So for a long time, the textile sector, India Textiles, has struggled competitively with many other countries in the region because there have been unfavorable tariffs, not just in the US, but many other regions as well. With the UK and EU tariff, FTAs coming through, and will take some time to operationalize. But once they are done, I think that will open the door for the textile sector to start competing more effectively. So yes, from a slightly longer term perspective, we remain. You're right that some of it is in the price, but we remain constructive. And again, if the resolution of the tariff issues with the US will also be a major positive for the sector.
All right, Seshadri, appreciate you taking the time out and joining us here with those views. Thanks very much for that. We'll slip into a short break now, but on the other side, Reliance Jio's run makes it to the top 20 of the world's intellectual property organizations' patent cooperation treaty rankings from outside the top 300 in just a year. We'll assess Jio's deep tech pivot after the break. Stay tuned. Welcome back. Let's get you the macro signal for the day. Now, if you want to know what businesses and consumers are really thinking, don't just look at the stock markets. Let's also look at bank loans, because we had the latest data that was released last Friday, which shows India's credit growth has surged to 17.7% as of the end of May, which is up from 9% a year ago, which is the fastest pace that we've seen in years and comes despite persistent concerns around global growth, geopolitical tensions, and of course, the weaker capital market activity. Now, Now, at the same time, deposit growth is running at just 12.2%, and that leaves a gap of more than 500 odd points between credit and deposit growth. So the system CD, which is the credit deposit ratio, now comes to about 82.7%, which is well above the 75-80% kind of a range, which is typically considered comfortable for the banking system. Now, what's also striking is this is not being driven by just any one particular segment of the economy. So look at the numbers. Services credit growth is growing at 18.6%. Industrial lending has accelerated to 15.1%. Personal loans continue to expand as well. Within retail lending, vehicle loans are growing at 18% year on year. Gold loans have surged more than 120%. That, of course, is supported by the high prices. MSME lending remains strong. Credit to micro and small enterprises is growing at 30% year on year. Medium enterprises nearly 20%. But there is an important nuance to this credit growth story. Now, analysts we've been speaking to point out that some of the borrowers who would traditionally raise money through bond markets are also now increasingly turning to banks instead. So higher bond yields, weaker debt market issuance, that pushes NBFCs and large corporates back towards bank funding, which had gone away from banks over the last couple of years. Now, that is also visible in the data. So credit to NBFC is growing at almost 28%, while large industry lending has also returned to growth. So part of the surge reflects banks gaining market share from capital markets. But even after accounting for that, the breadth of the growth across MSME, retail, services industry suggests there is underlying economic activity which remains healthy. The takeaway is this: businesses are borrowing, consumers are spending, credit growth is running at its fastest pace in years. But the question has been whether the banking system can fund this credit growth comfortably. And that's where RBI's recent foreign currency non-resident bank deposits, that is the FCNRB, and the external commercial borrowing measures can play a significant role. That's a macro signal for the day. We'll slip into a short break. Up next, we'll get you more on the markets, so stay tuned.
Welcome back. Jio is now in the same patent rankings league as Huawei, Google and Apple. Now, the telecom giant jumped 320 places in the World Intellectual Property Organization's Patent Cooperation Treaty rankings to break into the global top 20. With over 6,800 total filings and a sharp pivot towards 6G, AI and cloud technologies, my colleague Sonal is joining in to help us make sense for what this means for the company going forward. Sonal.
Well, Jio Platforms has made a significant leap on the global innovation stage. According to the World Intellectual Property Organization's Patent Cooperation Treaty rankings for 2025, Jio has now entered the global for top 20 patent applicants, ranking 20th worldwide. What's particularly notable is the scale of this jump. Jio has climbed 320 places in just 1 year, placing it alongside global technology leaders such as Huawei, Samsung, Google, Microsoft, Nokia, LG and Apple as well. The company's patent portfolio is concentrated in next-generation technologies, including 5G, 6G, artificial intelligence, cloud-native platforms and digital infrastructure. Now, as of March 2026, Jio has filed more than 6,800 patents globally. Of these, 2,393 patents have been filed in India and 4,424 have been filed in the international markets. The company has also secured 1,009 patent grants worldwide, including 538 in India and 471 overseas. Jio says it is actively developing future technologies such as 6G networks, satellite communications, and its agentic AI platform, JioBrain. The achievement is even more significant considering global PCT filings grew by less than 1% during the year. The ranking underscores Jio's transformation from a telecom operator into a deep tech company and reflects India's growing presence in the global technology innovation.
Sonal, thank you for putting that together for us. By the way, the markets are doing what they are, 340 points higher on the index, but take a look at the stocks that are flying. HDB Financial is now up 10%. And it's extended its gains from where we started the show. So at the day's high now is HDB Financial, 707 now on the stock. Kalyan Jewelers has now surged to 10% circuit. Leela Palace has moved into a 10% circuit. And 5-Star Business Finance too at 10.5% higher, the top gainer on the Nifty 500 today. Take your leave on this edition of Trading Hour from Ritu and me. Thank you so much for watching. Halftime report on the other side.
Stocks see a broad-based rally on Trump's announcements of a deal with Iran to end the war and open the Strait of Hormuz. Market gurus say that this will lift a big overhang on Indian equities, but lack of AI plays will remain a dampener.
Vedanta Group Chairman Anil Agrawal says each of the four arms of Vedanta listed today, spanning aluminium, power, steel and oil and gas, can be a $100 billion company. He adds that parent Vedanta Resources may consider US listing at a $100 billion valuation.
Brent crude has slided to around $83 per barrel after Trump says the US deal with Iran is complete. Travel and tourism related stocks and those of truck financiers rally on the hope of a drop in fuel prices ahead.
The finance minister says and highlights the challenge in importing inputs given war-led volatility. She also flags not so good monsoon, but assures that the country has sufficient stocks and faces no food shortage.
Hello and welcome to Halftime Report, live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Bhutra as well as Vinny Motiwala. Well, it is turning out to be a great day for the markets at this point in time. We've almost recaptured 24,000 as we speak sustainably, and we have the mid-cap index which is outperforming with a gain of around 1.84%. But what is on your screen is a little disconcerting, but maybe it is transitionary. We do have the May WPI data which has hardened all the way to around 9.68% versus that 8% level that we saw in the previous month and versus our poll of over 10%. So there is definitely a huge uptake which has taken place in the WPI data. But remember that a large part of it was reflecting what took place in terms of commodities and the US-Iran war. So maybe this could be something which could be transitionary as we speak. Remember, Brent crude has softened all the way to around $83 per barrel. So that's on the WPI data. Markets doing well. Maybe they look at it as backward looking at this point in time.
Hi. Hey girls, good afternoon. So markets are taking a breather for sure. WPI data will be important to track yet again. What happens next? That's the big question, right? How soon does it take for us to see a lower number? Because these are wholesale prices. Commodity prices in general have been higher in last 2 months. So we'll just get Lata in a bit and decode these numbers for us as well. It is lower than the poll. We were expecting a number of 10.37%. So it is lower than that. So that is, of course, a relief. But again, it's a month-on-month basis increase that has come by. Lata, what do you make of these numbers and how soon does it take for these numbers to reverse now that, yes, there is some breather that has come by?
Yeah, it can come down quickly depending on how quickly the fuel prices fall. Fuel prices was one big reason why you saw that big rise in WPI. You should see the rapidity with which WPI has risen. You know, as recently as November of last year, November 20, which is what, 7-8 months back, it was minus 0.13. It was under 1% even in December. And from January, it has been rising to 2%. As recently as April, it was 3.88%. And, you know, from April to May, you've seen this jump to 8.3 and now to 9.7. Yes, it's a consolation that it's a little lower than our poll, which was, 10.37. But practically everyone who responded to our poll was in the double-digit ballpark. It was between 10 and 11 that I got most of the readings. And therefore, this is, okay, to that extent, a bit of a relief. Maybe the impact can come sooner than we realize, because we heard only about last week, you all were reporting, urea prices have crashed from, over $900 to around $450. So things can come back on rail pretty quickly. But at the moment, this can also feed in to the, consumer price inflation. Actually, let's get to the expert in. We've got Kanika Pasricha joining in, the Chief Economic Advisor at Union Bank. Kanika, at 9.7 almost, what is the sense? Are we likely to see it peak off, or are there a few more months of double-digit WPI?
So Lata, first of all, thanks for having me on the show. As you yourself were saying that for a few months ago, even in December, the number was below 1%. Even in the month of March, it was below 4%. So consistent rise in WPI has been partially base effect and partially, of course, the underlying momentum because of the West Asia conflict. So even in the next few months, we see this we see number closer to double digits continue purely on base effect. And at least even if the momentum comes down a bit, the numbers may stay elevated is what we see. In this specific number, if you see our number was also close to 10.5%. There's a downward surprise in food and fuel, which implies core WPI, which clocked 5.5% in the last month, even in this month may have sustained at an elevated 7 to 8% number. I'm just awaiting the final numbers there. So core numbers still stay elevated here. Thanks.
Well, actually, the government has also released a new PPI index. So actually, this is quite a seminal release today. We have a new WPI series with FY23 as the base year. And we have a new series altogether called the PPI. We have a lot of analysts have been complaining that India should also release a PPI series, and that's also come in. The PPIs, new PPI series, let me see if there are any numbers. It's coming in at 109 versus 108.6 in April. So there are only two reads. We can't have a YOY number since we don't have a previous year's number. But month on month, it has risen by 1%, which is a little, big. From 108.6 to 109.6. Should that be a worry? It's almost a 1%, 0.96% increase from April to May. Would that be a worry?
Yeah, so if you see annualize that month on month, the number comes in close to 11.5%, 12%. So of course, it's a worry, just showing that underlying producer price inflation still remains close to double digits, or at least at that levels. If you look at a broader PPI index with a bigger, better methodology, a larger number of products also covered. So when we were comparing PPI with WPI in terms of the weights, there wasn't too much dramatic changes seen. So of course, it's a concern. As you rightly pointed out, now the trajectory matters because we've got to see where the crude oil prices also settled, whether they settle at $85 or at $95, which was the core assumption for the MPC as well in their policy. Thanks.
Hence, is this the peak, or should we be prepared for something worse? Because all of 25, we had negative WPI numbers. I don't know how it is in the new series. A lot of data is coming in, and I think I should also give you time to look at the numbers before asking you to reply off the cuff. But do you think broadly the WPI doesn't get too bad?
Yes, I would agree with you. Just one core assumption, not on the commodity side, but more on the food inflation side, given El Nino concern remains, cumulative rainfall deficit is in double digits. If food price shock doesn't come in, we may see WPI close to peak.
Okay. Fair enough. Okay.
12%, nothing beyond. Thanks.
Fair. Sorry for interrupting you. I think I must give you enough time to go back at the new series and the PPI series. Just wanted to point out that the May WPI is also high because of the single increase in fuel. The new May series on fuel is up 30.3%, and in April it was up 24.89%. Obviously, because a year ago the crude and the domestic prices were not as high as they are now. So possibly, if the crude prices fall, we may see the impact in WPI. We may not see it in CPI till the domestic prices are lowered, and that is unlikely because the entire price hike has not been, even transferred to the consumer.
Okay, Lata, thank you so much for joining us, taking us through the WPI data as always. And thank you, Kanika, also for joining us and taking us through the details of what we should be maybe looking out for going forward as well. So thanks so much for that. But on that note, we're going to slip into a very short break. Up next, Sonal will focus on the markets, stocks, performance. Since the start of West Asia war, what's the change there now? Today, we're hearing some positive news here. So what's all of that and what are the details there? Stay tuned in for that. Welcome back to Halftime Report on CNBC TV 18. Nifty obviously is holding on to very strong gains in the trading session. What's the reason behind this? US Iran have announced a deal to end the war and open the Strait of Hormuz. But how have the key indices, how have the stock market performed since the start of this West Asia war and the conflict? Let's go across to Sonal, who's at the wall, standing by to take us through that. Afternoon, Sonal, back to you.
Well, the big question is it for real this time? But let's assume it is and understand how have markets performed since the start of this war that happened on 28th of Feb. First, on the major indices, well, Nifty, which is down 4.9% since the time this war has started. Nifty Bank has underperformed as well, down 5.2%, one of the major reasons for the market fall. But surprisingly, we do have the mid-caps and the small caps that have participated towards the upside. So the mid-cap index, which is down 4.2%, small cap index is up around 9.2%. So there's been a big rally in select mid and small caps as well. Let's move on now and talk about some of these constituents of Nifty which have led on the upside and some on the downside as well. Adani Group stocks have done really well. We do have Adani Enterprises, which is up 37% since then. Adani Ports is up 20%. What crude oil? Because crude oil prices, despite them going higher, Asian Paints has still outperformed. It is up 17% since the time war started. We have Grasim, which is up 12.8%. Trent too has seen gains of around 10.5%. But there are big losers as well. Insurance stocks haven't done so well. HDFC Life is the biggest loser, down 20%. IT names, of course, they have to be on the list. So we do have HCL Tech, TCS. Both have down anywhere between 17.5% to 19.6%. We do have SBI Life as well. And SBI, since the time the company or the bank reported its numbers, has been underperforming. Now let's go to the mid-cap index because there have been big performers. BSE is up 54%. We do have BEL, which is up around 47%. Premier Energies is up around 43%. Vodafone Idea, there's a surprise entrant here, which is up around 43%. Let's talk about the losers now. Ashok Leyland, which is doing well today, has been declining 24% since the time this war has started. We have RVNL, SBI Card, M&M Finance and APL Apollo. These are some of the big losers from the mid-cap space since the time this war has started. Now in the small caps, there is a surprising name again. Ola Electric. This stock is up 78% since the time this war has started. We have Welspun Corp, Deepak Fertilizers. This is an import substitution story. Angel One has done well, and so has IFCI. So these are some gainers in markets. We do have losers, the likes of IDBI Bank, there's Force Motors, Signature Global, PG Electroplast and Ramco Cements. These are some of the losers that we have in the markets. But how has India performed versus its peers? Well, Nifty is down 4.9%, whereas Dow Jones is up 4.5% since then. S&P is up around 8%. Big performers or big outperformers, I have to say, in the Asian market, so to say. Kospi is up 36%, Nikkei is up 17.5%. Taiwanese index is up 28%. Hang Seng is underperformed, but other than that, most of them have been these big chip AI semiconductor stories. Crude oil prices, those are up 14%, but do remember the prices are lower today. They touched levels of $126 per barrel during the war as well, but now seeing some profit booking. But this is how markets have been since the time war has started.
Okay, all right. And hopefully the war has ended now. But thanks, Sonal, for bringing us all of those details. That's the sum up. And just want to point out with regards to the broader markets and just extend that point forward that Sonal had brought up. We have the mid-cap index, which has rallied around 4.6% since the start of the conflict to now. We have the small cap index, which has done even better, which is up around 9.3%. But the big kicker has actually come in from the micro cap index. The Nifty micro cap index at the same time has risen around 15.1%. So that's the kind of market gain and stock-specific gain that you've seen for the broader markets. We'll take a break now on the back of the Nifty doing well and, in fact, just about hovering around those 24,000 levels. Let's see whether that gets there sustainably. But up next, we'll get you an exclusive conversation with the management of Vedanta. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty is managing to hold on to gains 23,900. About that, what the Nifty continues to trade at, slight bit off that day's highest point, but still gains of 1.24% for the Nifty 50. Even obviously, advance decline ratio is in the favor of advances versus decline. And some of the names that have run up in the last 20-30 odd minutes, Schneider Electric pulled that up. We've seen some announcements come in here as well. We have Saregama India that's in focus. That's also up almost 1-2% in the last 30 odd minutes. Oil India, Elcon Engineering, these are the other names that are in focus as well. But let's move on and talk about Vedanta's demerged entities, which listed on the exchanges today. In fact, my colleague Nigel actually caught up with the company's chairman, Anil Agarwal, on the same. He began by asking whether they will take royalty rates. Listen in.
Royalty, we have about around 2 to 3%, and that is the biggest selling factor in the world, because when we listed our company in London, they are not charitable institution.
Correct.
So they said we'll give a dividend, and then we'll have a brand fee, because you created a brand, and that's how you're getting the money.
But this fee will not be hiked, sir?
No, not at all. It's going to be reduced. Okay. It's going to be reduced to 1 to 2%. Against that, the kind of money comes in is 100 times. So you give this at 2%, against that, the kind of money we bring in.
So you're looking at basically the royalty rate could potentially come down, is what you're telling me?
Should be.
Should be.
Come down.
That'll be interesting, Mr. Agarwal. But you know, you're going to be having 5 listed entities, but ye dil mange more, right? The street will be waiting by now. Hindustan Zinc, when is that demerger going to take place? Because you briefly alluded to the fact that silver has huge potential as well. So could we be looking at a restructuring at Hindustan Zinc as well, say in the next 6 to 12 months from here on, a demerger in Hindustan Zinc?
Each of our company has a potential to be demerged, to create amazing time to come, because talk about your Hindustan Zinc. Silver, we have been through technology, never ever thought India will produce silver. We produce silver. Then we are going to produce largest fertilizer in the country.
Right.
The critical metal, palladium, rare earth. These all will be Hindustan Zinc going to be one of the largest company in the mineral sector.
Okay.
So that's what we are looking at. Hindustan Zinc can be a couple of companies potentially.
Okay. And you have told us about all these pieces of the Vedanta group that we know, with regard to metals, mining, the other verticals as well that you've spoken about in this interview. Is there any other new ambitious target that you have, or some unrelated business that you're looking to get into as of now, or you're happy with what you have and you want to grow all these businesses?
My hands are so full, but my shop is, I'm sitting in the shop. I'm not going to hunt, but somebody comes. I have to fulfill my shareholder desire. They know me. If some aluminum company in India comes, or anything, I'm just hypothetically talking about. We will look at.
Got it.
But no plan for diversifying. The hand is so full. We are going to, what we are looking at, $20 billion to invest, looking at $100 billion to raise and bring it here, keeping these companies. Because demand supply is so high. What I'm looking at, India import should come down or remain Atmanirbhar.
Well, that's the big news that we're tracking, and a CNBC TV 18 exclusive as well. For now, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side as well. Stay tuned. Welcome back. You're still tuned to Halftime Report. Well, the crude prices falling is the big story, other than the markets doing really well that we are tracking. But if we talk about oil marketing companies, they are the ones which have been doing well. They did well on Friday as well. And now do remember, because of crude oil prices seeing that dip, their blended margins, after taking into consideration the refinery transfer pricing, they at least broke even for the first time ever since the war started. So that's a positive news for sure. BPCL, HPCL, IOCL, all of them are higher on the back of that. And that is exactly what we are tracking for the markets as well. So they are at 0.4 rupees per litre. This is, of course, blended price after considering the refining transfer price that we are talking about. And other than that, if we strip for all of that, they are still in the negative. So those are things that we need to keep in mind when we are tracking all these oil marketing companies. In the broader markets, we do have a lot of movers on the higher side. HDB Financial Services, that stock is up 10% in trade. IRM Energy is the other one. We do have SP Apparel. So some of these textile companies are doing really well in trade. Orient Pro Solutions is the other one, which is up around 12% in trade. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll talk more about markets, get you some stock-specific action as well on the other side.
Welcome back. And joining us on the show is Iman Nasseri. He's Managing Director, Middle East Research at FGE Nexantica. Iman, hi, thank you so much for joining in. And finally, some news which the markets have reacted to quite strongly, with the crude oil prices trading nearly 4% down. This is on the back of 6% decline that we saw in prices in the previous week as well. Are you calling it a done deal, or would you want to wait till Friday on what really transpires in Switzerland?
I think this is a done deal, but this is not the deal. This is an agreement. This is, as they call it, MOU. This is just basically those items that they have agreement on, those that have been common grounds and been able to put it in this memorandum of understanding. There are so many other misunderstandings and disagreements that have not been listed in this, which is going to be ironed out over the next 60 days for their deal to come out of. And basically, I would mostly call this an extended and expanded ceasefire. So basically what happened just now is that they agreed on certain key elements to, first of all, and most importantly for Trump and the world economy, to get some oil and gas back into the market and open the Strait of Hormuz by removing the blockade on the US side, and Iran agreeing to let vessels go through. Although, again, there are some vague terms there in terms of Iran saying that it has to be under our supervision. No, I would not call it final, but I think for now we have another 60 days of calm situation in the Middle East, and perhaps flows will start to go through within the next few weeks, probably starting slowly from as we expect from next week or so, but majority of the terminology calls within the 30 days of blockade to be lifted.
Iman, the prices have reacted. I mean, from a conflict high of 120, we are trading at 83 right now. Do you see 80 breaching anytime soon within this agreement period?
I think we may see even prices going towards lower 80s or even sub 80 towards $75. That's where the market could potentially get to, especially remember, the market is in balance right now, having found solvers, which is basically some demand destruction and some stock draws and drawing from the inventories. That has brought the market into a new balance, and suddenly there will be new supply coming from the storage tanks within the Middle East, both crude and products, which have not been incorporated into the trading community's calculations. So those barrels which will get released this week and next week were not traded over the last month or two, which is a normal trading window for any loadings at any point in time. So the market will go into a short period of oversupply in that there will be some unaccounted for barrels in the market. And that's why I see prices basically further downward pressure on prices towards perhaps $75 if the ships start to sail rather immediately. And that will then change the equations. That will take care of some of the demand destruction to come back to the market within the next month or so, and perhaps inventory draws to turn back into inventory building when the vessels start to get loading, and basically we build some inventories at sea and on water.
Okay, all right. Manisha, thanks very much for joining in and giving us all of that perspective. So definitely some softness which is coming in for Brent crude, and that's definitely uplifting the market sentiment. In fact, the mid-cap index is now up around 1.54%, and the Bank Nifty a cool 500 points higher. We'll do one thing. We'll take a short break, but up next we'll connect with the management of KIMS Hospital, as the board has approved a preferential issue allotment of around 72.77 lakh warrants to the promoter group, raising around 600 crores. We'll be back with more. Stay tuned. Welcome back. Well, Kim's Hospital has approved a 600 crore fundraise through a preferential issue of warrants to its promoters and promoter group. To discuss this and more, we have with us Sachin Salvi, who's the CFO of Kim's Hospital, joining in. The three key things that we will be discussing this afternoon is the utilization of the funds raised, acquisition plans, and the new unit EBITDA guidance. Mr. Sachin, thank you very much for taking the time out. So just wanted to understand this particular fundraising plan that you have. You're raising 600 crores via an issue of warrants to promoters. Just take us through the reason and the rationale behind that. What are the funds going to be used for? And what is your larger fundraising plan, considering that you did have an approval to raise funds via QIP, which was approved just a couple of months ago?
Sure. So we have an approval for raising funds through QIPO to the extent of about 1,500 crore. But meanwhile, we have sought an approval from the board for raising funds through preferential issue of share warrants to the promoters to the tune of 600 crore. A large part of it, the 600 crore, goes on to retire the existing debts. Almost 75% of this entire proceeds goes on to retire the existing debts of the company. We are retaining 25% for general corporate purposes, which is basically for the loss funding, general capex, maintenance capex, and other infusion which we want to do in certain of our subsidiaries.
Okay. All right. So predominantly, you're going to use the 600 crores to reduce debt. How exactly does your QIP plan tie in now? Are you looking to raise funds via QIP? By when are you planning to do that? And what exactly are you going to use that possible 1,500 crores that you're looking to raise? Is that also going to be used for debt reduction? And if then, what's the ideal level of debt that you're looking at?
The process of filing for the relevant documents before the SEBI for the purpose of launching the QIPO is already on. Already the bankers as well as the lawyers are working on it. I would say we are very close to it. The dates have not been yet finalized, but we will be launching this QIPO process very soon. As far as the objective for utilization of the QIPO process is concerned, we have an approval to raise up to 1,500 crore from the QIPO. 75% of this process will again go to retire the existing debts on the balance sheet of the company. That includes retirement of the debts of the main company as well as of the subsidiaries. 25% of the proceeds we will be retaining for general corporate purposes, which includes, of course, loss funding for our newer assets, capex, maintenance capex in our existing assets, and of course, infusion in some of our subsidiaries.
We do get that. That's what you're going to do with the 400 crore rupees that you're raising as well. But what's the absolute debt that you have? And after this 1,500 crore raise is that you will be doing via QIP, will you be net debt free? What kind of interest cost savings will you be seeing in your P&L? How does that flow to your profits? If you can give us absolute numbers for these three things.
So as on 31st of March 2026, the total net debt on our balance sheet is about 3,100 crore. By doing this QIPO and the equity share warrants which we are issuing, we want to retire almost like 1,000 crore from the consolidated financial debts which we are having on our balance sheet. We intend to keep the net debt to EBITDA within the margin of say 2.5:1. For the foreseeable, at least for next 2 to 3 years, at least. The current rate of interest or the current cost of the debt on our balance sheet is about 7.5%, which is of course healthy, but still we want to reduce the debt level to see to it that our future expansion, the growth capex which we have planned in the near future is filled.
You will be reducing your debt by 1,000 crore rupees, 7.5% interest. So that's the kind of cost savings you will see as well in your books.
Yes.
Okay. All right.
Yes.
Okay. So what also about some of the acquisitions that you had planned, right? I think last time you spoke to us, you mentioned about one or two bolt acquisitions you're looking at. Where does that stand? When could we expect that?
So as of now, we have launched 4 of our newer hospitals in last about 12 months. The focus as of now of the entire management is to ensure that these assets are either reaching to break-even or crossing the break-even level and are becoming profitable. At least this is what our focus is for next 12 to 18 months. Having said that, we have certain acquisitions which we are planning, but these are not big acquisition as such. We are planning something in Kerala, which is a smaller acquisition. We are planning something in our core market of Telangana, which is again a smaller acquisition. So as I said, most part of the proceeds we are intending to utilize for repayment of the debt. But having said that, there will be some acquisition which will be there on the card. But of course, after we ensure that the existing new assets are fully profitable.
Okay. All right. Sachin, just wanted to understand, and I don't know if you would be able to give us more color. The promoters post this warrant allotment and, the conversion to equity, their holding is going to rise to around 35%. What eventually would be a comfortable level for them in terms of promoter holding in the company?
See, currently they are holding about 34.11%. The intent is not to go below this 34.11%, but post QIPO maybe some 0.7% here and there. So on a fully diluted basis, the intention is very clear to maintain at somewhere around 33% at least.
Your new units, so let's talk a little bit about that. The EBITDA loss was around 130 crores in FY26. You're guiding that, this year is going to be better. Nasik could probably see a break even soon enough. And just give us a sense in terms of what the losses would probably come down to in FY27. And hence, what exactly would that do to your consolidated margins as a whole, considering that you did around 19 to 20% in the previous quarter as well as for the year?
Sure. So as far as the EBITDA margin are concerned, from the matured unit, we continue to do about 28.5% EBITDA margin, and that is not going down. That is remaining solid over there. That is what we have done in last 2-3 years, and we will continue to do that even for foreseeable future. As far as the matured units are concerned, as far as the new units are concerned, Nasik unit has achieved break even. By the end of this financial year, we are very comfortable. We are very confident that there will not be any EBITDA erosion from Nasik unit. Thane is ramping up very, very fast. Again, by the end of Q2, we are very positive that this unit would be surpassing the break-even and would be doing some profit or would be contributing to EBITDA. The newer units at Marathali, that is in Bangalore, we have started that unit in the month of September, and in less than 6 months itself, we are seeing good results. We are very confident that the break-even will happen in this month or the next month, and then it will start contributing.
I just want one particular figure, sir. If you could just tell us what you're guiding for. 130 crores was the EBITDA loss in FY26. Tell us what it would probably, what the internal targets are for FY27, and what is the internal target for the margins on a blended basis as well.
Sure. So in the last financial year, the total EBITDA erosion from the newer units was about 130 crore. This year, it would be reduced to about some 50 crore for the entire financial year.
Okay. All right, Sachin, thank you so much for joining us. That's the update as far as KIMS is concerned. That's how they'll be using the proceeds, 75% for debt reduction and 25% for general corporate purposes. However, the stock has come off from the highs of the day at the day's low as we speak. And important comments coming in from Prime Minister Modi as well. It's a post on X where he's welcoming the understanding reached between US and Iran on ending the conflict. Everyone's, of course, happy about that. The markets, though, have come off slightly from the highs.
Absolutely. Markets have seen a bit of a decline from that high level, like you're mentioning as well. But we're still holding on to 23,900. But that's what we'll watch out for, what happens in the second half of the trading session as well. But, with that, we're actually going to wind down this edition of Halftime Report. Up next, Business Sun should take you through all the market action.
Stocks see a broad-based rally on Donald Trump's announcements of a deal with Iran to end the war and open the Strait of Hormuz. Market gurus say that this will lift a big overhang for Indian equities, but the lack of AI plays will remain a dampener.
Vedanta Group Chairman Anil Agarwal says each of the 4 arms of Vedanta listed today, spanning aluminium, power, steel and oil and gas, can be a $100 billion company. He adds that parent Vedanta Resources may consider a US listing at a $100 billion valuation.
Brent crude slides to nearly $83 a barrel after Donald Trump says that the US deal with Iran is complete. Travel and tourism related stocks and those of truck financiers rally on the hope of a drop in fuel prices ahead.
The finance minister highlights the challenge in importing inputs given war-led volatility. She also flags a not-so-good monsoon, but assures that the country has sufficient stocks and faces no food shortage.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormaz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz, and no Monday blues for the markets. You know, this deal between US and Iran, which everyone was waiting for, is almost going to be signed, and that's super positive for the markets. We've got oil prices which are lower, we've got the rupee which is lower, so the market's firing on all fronts.
They are, and they're carrying on from where they left off on Friday. Well, the cynics would say that you're off the highs of the day. We did manage to touch 24,000 on an intraday basis, but we have not managed to sustain above those levels. In fact, now we are trying to hold 23,900 on the downside. Of course, the bulls would hope that even if the index does not touch 24,000 during the course of the remainder of the day, it still closes above 23,800. That's going to be a positive as well. But that's going to be over the next 150 minutes of the trading session that are still left. But the bulls will not be complaining right now. 275 points, and that is in an addition to the near 400 points that the index had already surged last Friday. So from the recent lows of 23,150 odd, the index at one point was up almost 800, 850 points. So there has been a significant recovery from lower levels. So no surprises that there is some profit booking at the higher levels, and leading that profit booking is the Nifty Bank. Again, the index was up 1,500 points on Friday, was up 4% last week. So a significant amount of the up move has already been there, and the index now is down around what, 450, 500 points from the highs of the day. But no complaints as of now. It's still 275 points higher and continue to remain above key levels.
Absolutely. Off the highs, but everything in the green as we speak, right? And if you take a look at the sectors, the Realty Pack is the top gaining index. That index is up 4%. We've got DLF, Prestige Estates and Phoenix Mills, all of them gaining between 4 and 6% as we speak. Now, the Auto Pack also zooming in trade. Maruti, TVS Motor and M&M, all of them, Maruti, TVS, both of them over 4% in the green. And we've got M&M, which is over 3% in the green. We've also got stocks like HPCL, IOC, BPCL also gaining in trade. IOC, BPCL over 2% higher. HPCL 3.5% in the green. Now, some of the few stocks that are in the red is from those pharma and healthcare stocks, right? So Aurobindo Pharma down over 3%, Woca down over 1%, and Ajanta Pharma about 2.5% in the red. That's how the markets are shaping up this afternoon.
Well, pharma itself was a big outperformer during this period, so there is some bit of profit booking. And Aurobindo Pharma, of course, news flow driven move considering the US FDA action at one of its Eugia Pharma facilities. Now, the other big trigger is the fact that oil prices are down to a 2-month low, around $83 a barrel, and that's after the US and Iran agreed on a peace deal aimed at ending the West Asia conflict and reopening the Strait of Hormuz by the end of next week. Now, in a Truth Social post, US President Donald Trump said that the strait would be open toll-free and that the US naval blockade would also end. Now, in a second Truth Social post, he added that the opening of the strait and signing of the peace deal on Friday could bring back oil flows to both ends of the region. CNBC's Dan Murphy is now joining in with all the updates. Dan.
The path from here to Friday still matters. The path beyond that will also be really critical. This all came about after Pakistan's Prime Minister Shehbaz Sharif, who of course mediated the negotiations, announced this agreement on Sunday. President Trump confirming it shortly after, declaring the deal complete and authorizing the reopening of the Strait of Hormuz and the removal of the US naval blockade. An official signing is set for Friday in Switzerland. And Friday's signing is also shaping up to be the moment of truth. truth. Of course, with days to go, we still don't know who will actually be in the room, and the guest list itself will tell us how real and how broad this deal truly is. On the Iran side, so far, the only official that's been publicly linked to the signing is the Deputy Foreign Minister. Iran's Foreign Minister Abbas Araghchi and the Parliamentary Speaker Mohammad Ghalibaf have been kind of the face of these talks and may be the senior signatories if they attend, but again, there's no confirmed list. If Ghalibaf does appear, then it could perhaps signal buy-in from Iran's conservatives and the security establishment. And if the senior security advisor Ali Shamkhani is there, then it would also suggest that perhaps this has sign-off from the Supreme Leader himself. So watch that space. On the US side, it's also unconfirmed who will attend. Iran, of course, right now doesn't have a diplomatic equivalent for President Trump to meet. So the president himself may not actually attend. Of course, stranger things have happened, but it's not quite certain exactly who's going to show up. The White House had reportedly been weighing sending the vice president, J.D. Vance, and the envoy, Steve Witkoff, who, of course, has led the US track. He is a likely participant, but again, we don't know who will be there. I think the real tell is who shows up from the region. Pakistan's Shehbaz Sharif, who brokered this, is expected to attend. Qatar, also deeply involved throughout, is probably the most likely Gulf state to be represented at a senior level. The biggest signal of all is whether Saudi Arabia and the UAE send cabinet-level representatives. If they're physically in the room alongside Qatar and Pakistan and the US and Iran, then this becomes more of a bilateral ceasefire. It becomes a deal with broad regional backing, and that's what we'll be watching for on Friday. So a lot could happen between now and then. And of course, this deal also hangs in the balance because we saw those Israeli strikes on Sunday against Hezbollah inside Lebanon, potentially threatening to upend this from the start. The extent to which the Israelis are going to buy into this agreement also remains to be seen. So far, Netanyahu suggesting that he has distanced himself from this US-Iran negotiation track.
So the deal likely to be signed this Friday. Dan, thank you so much for all those details. Now, the rupee rose by 0.5% today, in sync with most Asian currencies, celebrating the potential opening of the Strait of Hormuz and the fall in crude prices. For the same reasons, Indian bond yields also fell to two-month lows of 6.85% for the benchmark 10-year bond. Lata Venkatesh is here with all of those details. Lata?
Second straight day of rally for the rupee, and by a huge margin. It already saw about a 0.6% rally on Friday and now a 0.5% rally. Indonesia, of course, did better with a 1% rally, but then we've had 2 days of rally. So in comparison, the rupee is still an outperformer. The rally... The rally, it must be noted, is not because FPIs are bringing in dollars just yet, though dealers are guessing that debt FPIs are coming in. They're not very sure of equity FPIs, but it is Indian corporates who are supplying the dollars. They're probably exporters who now see no chance of getting a 96 and are bringing in their dollars, or it is even importers who are overhedged. Incidentally, foreigners were already selling their short rupee positions for the past 2-3 weeks, which means the foreigners had turned positive on the rupee a little earlier, even before the FCNR announcements. But of course, the domestic reaction is entirely to the fact that there'll be a flood of FCNR deposits coming in dollars. As well, exporters now have to bring back their dollars in 9 months. Earlier, they were given 15 months. Now, there is still some confusion in the market as to how RBI might react. There is a small segment of dealers who think that the Reserve Bank may stop the appreciation. That is, come in and buy the dollars that the banks are bringing in. Because if the appreciation is too much, then their hedging cost will rise. But this is being rubbished by another section of dealers who say that the Reserve Bank put everything in its arsenal to ensure that the rupee appreciates, that it stops depreciating. So there's no question of them standing in the way. They may allow it. It can be wild swings. It can go all the way up to 92 and then swing back to 93 or 94. But the rally at the moment is not seeing any impediment till at least 93. That's about the consensus in the market. I need to say a word about bonds as well. That's seen at the moment, the rally may be just about 2 basis, but in the morning, it began with a 5 basis fall in the 10-year yield. But if you looked at the overall rally in the bond market, at one point, the 10-year was at 7.17. Now it is 6.85. That is the level we last saw in April. So that kind of a rally, a 30 basis points fall is very significant, and it is having an impact across the board. Corporate bonds, certificates of deposits, all of them are falling. And the rally obviously is because you're expecting inflation to not be that ugly. Also, when the FCNR deposits come, the 3-year, 5-year deposits, you're not going to be able to find a 3-year, 5-year borrower immediately. So banks are likely to park it in G-Secs. That's another reason why G-Sec prices are rising and yields are falling. You know, they are inversely related. The beneficiaries of all this, anyone related to real estate, anyone related to interest rates. So NBFCs are the top gainers today. Real estate companies are doing well. And banks, of course, have a twofold gain, cost of deposits coming down and mark-to-market gains on their investment book.
Indeed, some improvement in the treasury yields as well today. Lata, thank you for summarizing that. But stay on, because the government today has released a new WPI series with the base year 2022-23, replacing the old one that had a base year of 2011-12. Now, it also released a PPI, or a producer price index, for the first time, and announced that in 5 years, the WPI will be replaced by the PPI. Tell us more on that.
See, that's important. The wholesale price index is about to die in about 5 years. But let me begin at the beginning. The wholesale price index itself is getting a new lease of life for now, a short-term life. Its base year used to be 2011-12. Now the new one has a base year of 22-23. And the government is also going to give us a new series called the PPI, Producer Price Index. You may have heard of this term used in US and other countries. They're going to release an output PPI, so it will be called OPPI. They will also release a PPI for various services, 7 of them. I'll come to that in a bit. But the input PPI is going to be on a trial basis. Output PPI is a final series. Now, why should we have a PPI and not a WPI? It's clear that the government is going to phase out WPI in 5 years and replace it with PPI. What's the difference? The wholesale price index, as we all know, is whatever is the price in the wholesale market. You know, for iron, steel, copper, you have a wholesale price. Now, PPI is what factories pay at their gate. Why is that different? They usually pay a wholesale price, but transportation, insurance, several other transactions have happened. Banking, you would have taken a loan to get that stuff in. All that gets included, so it is a more realistic input price for a factory, and one person's input is one person's output is someone else's input, and that's why they're able to get the output price correctly. Input, they are going to still be at a trial mode. Now, the government is going to release 7 services, as I told you: banking, insurance, transportation, air, railways, all those, telecom, management of pension funds, and securities transaction. All these will be the PPI services that they will release. The WPI is going to continue for 5 years and then get replaced by PPI. Why? Because in many contracts drawn up by industry, the price escalation clauses are linked to WPI. That's why you cannot suddenly remove the WPI. You have to wait for the PPI to stabilize and then only remove it. But all factories now will have to keep an eye on the PPI and eventually move their contracts to PPI. Of course, the bigger one that will change is also the GDP. The GDP has about 60% of its input calculated on the basis of WPI. That will also be done by PPI, a more scientific basis for sure, followed internationally.
All right, Lata, many thanks for taking us through those details. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. India is reeling under a massive shortfall of rain, with monsoon from the 1st of June to the 14th being 28% under normal. The government has also said that it is preparing for a below normal monsoon. Manisha Gupta is here to tell us more on that. Manisha?
Well, there is concerning data when you look at monsoon 2026. We already are looking at a below normal monsoon. IMD has talked about 90% of long period average. And when you look at the latest numbers between 1st to 14th of June, 28% below normal is where the monsoon stands right now. The regional numbers give you a detailed reading therein. Central India is looking at 55% below normal till time, and 40% below normal is what East and Northeast is dealing with. The only plus that I see on my screen is the Northwest, which is 13% above normal. Otherwise, South Peninsular also is 4% less than normal there. The larger deficiency are in 4 or 5 major states. When you look at Maharashtra, between 1 to 14th of June, we are looking at a rain deficiency of around 69% here, and water woes just about continue. Gujarat is looking at 75% below normal, so a large deficiency onto this one. And there is a large deficiency in Meghalaya as well, with 86% below normal of a monsoon. And then there are various cities and states, nearly 200 districts, which are looking at a deficient rainfall. But the major ones that stand out in sense of states is Madhya Pradesh down 23%, Chhattisgarh 53% of a decline here as well. All of this is because this is an El Nino year. A year like this usually has lower rainfall. There have been instances of deficiency or droughts as well. But what the statements are coming in from the major forecasting agencies in sense of weather. To begin with, IMD says that onset of El Nino has happened. They did announce it over the weekend. And then you have World Meteorological Organization saying that chances of El Nino event between June to August now stand at a tall 80%. U.S. National Oceanic Atmospheric Administration has said that there are 53% chances now of a very strong El Nino, and this could happen between November to January. So this is something that we'll have to watch out day-on-day basis. But at this point in time, no rain in most of Maharashtra, Goa, Konkan as well are looking at a deficiency. So concerns building up.
Concerns indeed, and still yet to witness the first rainfall in the city as well. Manisha, thank you for that for us. Now, listening to Finance Minister Nirmala Sitharaman on the delayed monsoon situation and its impact on foodstuff and farmer security.
This year, because of the El Nino, I think we are preparing for not so good a monsoon. Of course, we have enough buffer stocks. Since last year we have maintained, so there shouldn't be a food shortage. But for farmers, it will have an impact because this year his income will be stressed out.
Well, on that note, it is time for another short break. More news and updates on the other side. Stay tuned.
Welcome back. Commercial flights have finally begun from the long-awaited Noida International Airport at Jewar today, marking a major milestone for aviation infrastructure in North India. The airport welcomed its first scheduled commercial flight, an Indigo flight from Lucknow. The airport is expected to ease congestion at Delhi's IGI airport, improve connectivity for Western Uttar Pradesh and the NCR region. Now, while flight operations have begun, connectivity remains a challenge in the near term, with passengers initially relying heavily on cabs and road transport until metro and broader public transit links are completed.
Prime Minister Narendra Modi is on the first leg of his two-nation Europe tour. He wrapped up a visit to Nice in France, where he held wide-ranging talks with French President Emmanuel Macron and jointly inaugurated the Bharat Innovates 2026 Technology Showcase. The two leaders adopted the India-France Innovation Roadmap 2030, agreed to launch a joint AI working group, deepen cooperation in defense, space and civil nuclear energy, and work towards doubling bilateral trade over the next 5 years. PM Modi is now set to depart for Slovenia, the second and final stop of his two-nation European tour.
And with that, we take your leave on this edition of Business Lunch. The market still continues to remain around 300 points higher. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. Joining me today is Ekta Batra. Ekta, good afternoon. Markets are cheerful. They've continued to be cheerful, but have come off from the highs of the day. 100 points on the Nifty, almost a 500-point cut from the highs on the Bank Nifty as well. So yes, they are digesting the fact that the war does not continue. But as our markets experts said as well, that there are no AI plays, and that is something that could be a dampener in sentiment at least.
Hi, Sonal. Yes, absolutely. And, you know, we had 1,000 crore FII sell figure which came in on Friday. So let's see what exactly the FIIs do in terms of trade today, whether or not that lessens or whether or not there would be a red figure from the FIIs on a net basis. But nonetheless, it's going strong for the Bank Nifty, which is up around 460 odd points. We have mid caps, which are up close to around 1,000 odd points. And top gainers include the likes of Trent, Shriram Finance, Eternal, Eicher Motors. But a lot to reckon with in the next 30 minutes. These are top stories. Broad-based gains across indices. Nifty hovers near 24,000. Strong trade in mid and small caps in tandem with the larger peers. Pharma pack bucks the trend.
Aurobindo Pharma shares fall after the US FDA flags its UGR Unit 3 facility with OAI status. The company says the development has no impact on its operations or financials.
Shares of a whole host of jewelry companies surged after a US-Iran peace agreement triggers a sharp rally in global bullion prices. Kalyan Jewelers gains more than 9% as the company has a large regional presence and exposure in West Asia. Phoenix Mills zooms after the brokerage firm Macquarie initiates coverage with an outperformed rating with a price target of 2,100. All right, well, for the markets, the mid-cap index is up around 1.5%. We have the advanced decline ratio, which is holding very steady at around 3,200 stocks, advancing to around 1,100 stocks, which are declining at this point in time. So that ratio has been maintained the entire trading session, as you can see. So there's a huge gap between the green and the red line at this point. A good time then to have a good synopsis in terms of what exactly the markets have done since the conflict. We have Sonal standing by at the wall to tell us more.
Well, you know, the big question is it for real this time? But before we ask that, let's try and understand how markets performed in India and globally, and which are the stocks which have been in focus since then. For Nifty, it has declined 4.9% since the time war started, that is on 28th Feb. Nifty Bank has not participated as well. This index is down 5.2%. Nifty mid-caps, however, are up 4%, and a bigger gain for small-cap index. It has been up 9% since the time war started. A lot of recovery that started in April and May. Which are some of the contributors to the Nifty move? We do have Adani stocks, which have traded on the upside. Adani Enterprises up 37%, Adani Ports up 20%. And crude oil prices, usually we say when crude oil prices go higher, Asian Paints doesn't do well, but that has not been the case. That stock is up 17% since the time war started. Grasim up 12.5%. We have Trent as well, which has done really well in trade this time. Let's talk about some of the losers. Insurance companies have been laggards. HDFC Life, the biggest loser, down 20%. Of course, there will be IT names in this list. We have HCL Tech, which is down 20% since. TCS down 18%. SBI Life is down 15%. And SBI, since the time the bank has reported its results, has been declining. It's down 15% since the time war has started. Let's move to the mid-caps. Big gains here. BSE is up 54%. We have BHEL, which is up 47%. Premium Energies, because a lot of these power equipment companies have done really well, 43% higher on that. There's Adani Total Gas, Vodafone Idea. Since the time there's been restructuring, some fundraising, the stock has done really well, up 42%. The losers include the likes of Ashok Leyland, down 24%. We have RVNL, which has not done so well. SBI Card is the other one. M&M Fin is the other one. And APL Apollo is down 18%. Let's move to the small cap space now. There's a surprise gainer here. Ola Electric, after underperforming last year, has gained nearly 78% since the time war has started. We have Wellspin Corp, Deepak Fertilizers, which is considered as an import play or an import substitution play, has done well. Angel One is up 52%, and so is IFCI. It has seen gains of around 49%. In terms of losers, we do have IDBI Bank, not so good, 34% gone there. Force Motors down 22%. Signature Global has been an underperformer in the realty pack. It is down 22%. We have PG Electroplast. They did give some guidance warning, and that is something which led to this fall in the stock. Ramco Cements is the other one, which is down 20.5%. Now let's compare India with global peers. While Nifty has declined around 5% since the time war has started, Dow Jones has actually seen an uptick of 4.5%, and so has S&P, which is up around 8%. If we compare it with the other Asian peers, and we've been talking about this big AI semiconductor play, Kospi is up 36%. We have Nikkei, which is seeing gains of 17.5%. Taiwanese index is up 28%. So big gains. War, no war, these markets have done really well. Hang Seng, however, has seen declines of around 6.7%. Crude has been the single biggest factor of the volatile market. Since the war has started, crude oil is up 14%. But do remember, point to point, it looks like a meager gain. Prices actually touched as much as $126 per barrel during the war. So there has been a big surge in crude oil prices. Now it has come off. Let's hope that continues. The war, the peace treaty has been signed. The question is it for real this time?
Okay, absolutely, completely. Let's see whether that sustains. So Brent crude prices, however, have softened, and the markets are giving a thumbs up to all of the developments which have taken place. So maybe the worst is already behind us. But let's welcome Richard Jain from Motilal Oswal Financial Services for a technical check on the markets. Richard, hi, welcome to the show. Well, it is turning out to be a session which is showing a lot of momentum on the upside. We've managed to maintain the gains that we've seen since morning in terms of the advanced decline ratio, in terms of the Bank Nifty. Just give us a sense in terms of, how you'd approach today's trade, and would 24,000 be the next pivot point that you're looking at?
Yeah, hi, very good afternoon. Well, if you look at what has happened recently in the markets, it formed a bottom around at 22,200 in the end of March. We witnessed the first impulsive up move from 22,200 to 24,600. Then markets went through a corrective phase, but the good thing was that in spite of all that geopolitical news flows which we had in this corrective phase, the markets managed to form the higher bottom now around the 23,000 mark. So I think the support base for positional traders has shifted now from the 22,200 low to 23,000. And this higher bottom, till it remains intact, I think markets show some further positive momentum on the positive side, mainly because if you look at the participation from the broader markets in the first leg of up move, it was more on the mid caps which participated in the up move. But this time, since last 3 or 4 days, if you see, the buying interest is most seen in the large cap names. Initially from the banking and the NBFC space, we witnessed a good momentum at the end of the last week. Now you can see realty, auto joining the momentum. So I think this up move, since there is a good participation in the large cap stocks, market should do well. 24,500 would be the first level that we would watch out for, where the 200 EMA for the index is placed. If that gets surpassed, I think we are in for a surprised up move in next couple of months.
What would the stock picks be in that case, since you're expecting an up move, anything from mid caps or the banking space?
So I think auto is one space where we believe that the momentum has started after a long consolidation phase. So within the auto space, Eicher Motors is one stock that we like at current levels. An ascending triangle breakout has been seen technically, which hints at the end of the corrective phase for this stock. So Eicher Motors, one can buy at current levels with stop loss below 7,600. We expect targets around 800 immediately. And NBCC is one of the mid-cap names that we like at current levels. A clear high top, high bottom structure has been in place. The stock has managed to take support around its 250 EMA in the recent correction. So keeping stop loss below 100 rupees, one can go long on NBCC for potential targets of 120.
Okay. All right. Thank you, Richard, for joining us. So those are some technical levels to watch out for on the Nifty and some technical bets as well. Let's move on. And this is a special segment, Mid-Cap Movers. We have Upasana to take us through the mid-caps that are moving around in trade. Upasana, take it away.
Well, markets certainly continue to cheer the US-Iran deal. Now, coming to the mid-cap index, it is up over 1.5% as we speak. Now, let us focus on the top gainers first. Oswal Pumps up nearly about 7% as the company backs solar order worth 500 crores. Next up is Affle. It buys mobile ad tech firm in US for nearly about $4.5 million. The stock is up nearly about 4%. Kalyan Jewellers is the next one. It has hit upper circuit more than 10% here, and 5-star Business Finance and even Sundaram Finance is up nearly about 6 to 8%. Now let us look at some of the top volume buzzers in today's trading session. TBO Tech is the one that tops the list with high volumes and up nearly about 8%. SP Apparels is also seeing volumes as high as 98 times its weekly average, up nearly about 14%. Realty stocks also continue to rise higher. Ashoka Bitcoin up nearly about 10%, surging on high volumes. HDB Financial Services is seeing a sharp up move out there, up nearly about 10%. And Sri Renuka Sugar also surging nearly about 8%. Now let us look some of the top losers in today's trading session. There are not much here, but Data Patterns was up down nearly about 2% at a certain point of the time. It has cooled off a bit and recovered. John Cockerill and Nephrocare Health Services is seen a cut off nearly about 6 to 4%.
Okay, all right. Thanks very much for bringing us all of those stocks and focus past now. We'll take a short break, but up next we'll focus on the chemicals industry. Connect with Ranjit Kirumala of IIFL to discuss more on this and his report. Stay tuned.
Welcome back. You're still tuned into Midcap Radar. Well, the spotlight now is on the chemicals industry. Domestic chemical prices, which surged in the aftermath of the West Asia conflict, appear to have largely peaked and now are beginning to ease. This is the word coming in from IIFL. In fact, key fertilizer input prices have also softened. To discuss these trends and what they mean for the sector, we are now joined by Ranjit Surumala, who's the Vice President, Research, Agri-Chemicals and Midcaps at IIFL. Ranjit, good afternoon. Thank you so much for joining us. A lot has happened. You already spoke about it in your report that since the West Asia crisis started, a lot of these chemicals have seen pricing pressure and they've come up from the highs. And now we do have a peace deal in place as well. What are you making of this? Will we see further pressure on prices? And while pricing could be under pressure, what about volumes? Could you see some demand uptick considering that we are also looking at a possibility of El Nino?
Yeah, good afternoon, Sonal. So the expected reopening of Hormuz is primarily a relief on three variables, mainly for the chemical link sectors. The first would be on the energy cost, feedstock availability, and the freight and the logistic cost. If you look at the key takeaway, is the major supply chain risk premium that will get reduced. It's more of that event rather than a demand-led upside. So clearly what we are seeing is that this brings a lot of relief, and fertilizers is the key. We are importing a lot of raw materials, be it urea, be it sulfur, methanol. Most of that was coming from Middle East, and this gives a bit of a breather to at least the availability is kind of an improving. We yet don't see this as a demand trigger, but clearly the supply side risks are coming down.
Okay, the supply side risks are coming down. In that case, what do you make? See, Q1, most of it is done. Do you think we could see an impact in Q2? What would Q1 look like versus what we saw in Q4? What's the outlook now in some of these names?
But if you look at the Q4, what we have seen, most of the companies did benefit from that price hikes that we have been highlighting. So part of that was on part of rupee depreciation, inventory gains. And we did flag that come 1Q, there could be a bit of an input cost pressure that will put margins at risk. Now, as we see the event, hopefully we will see through that pressure coming through in the 1Q. And the event should ease those pressures getting into the 2Q ones. So clearly the market would like to see through it, and come 2Q and towards probably end of 2Q, we should see this pressure easing out.
Okay. From a stock perspective, Ranjit, if you are talking about, say, the entire fertilizer space, which are the stocks that you'd probably look at, both from a complex as well as from a urea manufacturing space, considering the kind of correction that we've seen?
Right. So if you look at from the fertilizers industry perspective, it would be a big beneficiary. But if you divide that into two parts, mainly urea and complex, majority in urea is the government of India, which kind of bites bullets. And we were expecting the fertilizer subsidy, which in the budget was pegged at 1.8 lakh crore, would have gone past 2.5 or would have reached 3 lakh crore if these things kind of persisted for long. Now with the ease, clearly the fertilizer subsidy may likely be contained well below the levels that we have spoken about. So from that perspective, it would be a big relief from the fertilizer industry that the subsidy would be on the lower side. From the company standpoint, the working capital intensity, which was expected to elongate, is what we should see, should shorten now. And while the demand will definitely have a El Nino risk, but what we have seen historically in the first year of deficient rainfall, the fertilizer demand remains a bit inelastic. So from a two headwinds, at least one headwind has now been taken care of. We now look to the rains, and then should be kind of a good event for fertilizer companies if the rains comes on time and then the Kharif sowing remains unhindered.
It all depends on the rainfall intensity this time, which has been deficient so far. Refrigerants, you said, has been an anomaly this time. Ranjit, what do you make of SRF and Navin Fluorine? We did see strong numbers in Q4. Is this a performance which is expected to continue, considering also that they have big capex plan going ahead?
That has been one of the silver lining in the chemical space. The R32 prices have been holding off, and given that the summer season is a bit extended in India, and we have seen the domestic prices have kind of been holding off, and even the export prices are doing well. So that at least in the foreseeable future, for this particular calendar year, we don't see any risk to the realization. But since we know that this is going to be phased down, so 24, 25 and 26 calendar year are the baseline determination period, and come 2027, we will see that influx of more capacities. So eventually there should be a price correction in the calendar year 2027. But as far as the 2026 is concerned, we don't see any risk to the realization.
Okay. All right. Ranjit, we're going to leave it on that note. Thanks very much for joining in and giving us all of that perspective. We need to take a short break with the news that the markets are holding steady at this point in time. We'll get you a lot more in terms of specific stocks on mid-cap radar just after a short break. Stay tuned. Welcome back. Well, for the markets, like we've been pointing out, it's been, quite a steady day for us. Just want to point out specific stocks on the downside. Just watch out for a couple of these rate sensitive. So Bajaj Auto, we have ICICI Bank, which are a little bit under pressure. And the healthcare trade seems to be getting undone now because of the risk on that we're seeing. So Cipla, Apollo Hospitals, Sun Pharma, all of these stocks are seeing a little bit of profit booking. But shifting focus then, fintech company Razorpay has formally begun its IPO journey after confidentially filing its DRHP. The company is looking to raise around 5,000 to 6,000 crores through this route. Ritu is here with more details on this.
That's right. Razorpay, one of India's largest fintech companies, has officially kicked off its IPO journey, just as we reported here on CNBC TV 18. Now, according to a public notice in the papers, the company has confidentially filed its draft red herring prospectus with SEBI. Now, while Razorpay did not offer any comment on our story, our sources do indicate that the IPO could be sized at around $500 to $600 million. The issue is also likely to comprise of a mix of fresh shares and an offer for sale, with the two components expected to be split roughly 50-50. Now, sources also indicate that Razorpay is targeting a market debut in 2026 itself. That is, of course, subject to regulatory approvals. The company could be valued at around $5 to $6 billion at listing, which compares with its last private market valuation of $7.5 billion as of 2021, when it last raised funds. Now, Axis Capital, Kotak, JP Morgan and Citi are among the bankers advising on the issue. Now, the filing also comes after Razorpay completed its reverse flip to India in May last year, shifting its domicile from the US back to India, which cleared a key hurdle for its domestic listing. Financially also, the company enters the market with strong growth momentum. For FY25, its consolidated revenues had jumped 65% to about 3,800 crore rupees, while gross profits had risen 41% to about 1,300 crore rupees. The company, however, did report a net loss of 1,209 crores for the year, largely because of a one-time ESOP expense and tax liabilities linked to the reverse flipping. Now, there's also an interesting competitive backdrop because Razorpay is moving ahead with its listing plans at a time when rival PhonePe has deferred its IPO plans because of the market volatility. So with PhonePe's public offering on the sidelines for now, Razorpay's IPO is shaping up to be one of India's most closely watched fintech listings for 2026, and it could offer investors another major play on India's rapidly growing digital payment ecosystem.
Okay, all right. Thank you, Ritu, for joining us with all those details. For the markets, we've come off below the 23,900 mark, so that'll be important to track whether the greens on the screen sustain or not. But we'll take a leave on this edition of Midcap Radar. Finding Alpha when we return.
Well, hello and welcome to this special edition of Finding Alpha. I'm Nigel D'Souza and we are coming to you live from the Mumbai News Center. Well, today our focus is on the oil and gas space, a space that continues to play a critical role in powering economies and shaping investment opportunities. In this episode, we'll decode the key dynamics driving global as well as domestic energy markets. We'll also examine India's dependence on crude oil as well as natural gas imports and explore the opportunities emerging across the gas utilities as well as the city gas distribution companies. And to help us drill deeper into the sector and get the outlook as well, we're now joined by Amit Murarka, the Executive Director at Axis Capital. Well, Amit, it's been a pleasure being in touch with you for all sorts of commodities. And today we're looking to learn a little bit more on the oil and gas space. Thanks a lot for coming down to the studio.
Yeah, good afternoon, Nigel. Thanks for having me in the studio.
Okay, all right, Amit. So let's get straight to the point then. I think first we'll focus on the oil, then we'll focus on the gas space. So in terms of oil, tell us about the dynamics globally first. What is the total oil supply globally? How much of it is seaborne? Because, that one got hit. And also, how much of that comes through the Strait of Hormuz?
Yeah, sure. Look, the global oil supply is about 107 million barrels a day pre-war.
Okay.
Of this, about close to 40% or 44 million barrels a day is seaborne.
Okay.
And within this, another one-third comes from the Strait of Hormuz, which is 15 million barrels, which got impacted largely because of the war.
Okay, all right. So 107 globally, 45 odd is seaborne, and out of that, a third of it, so around 15. Yeah. Got it. So that's clear. What about India? What is India's current crude oil consumption? If you could tell us what percentage of that is met through imports?
Yeah, India consumes about 5.5 million barrels a day.
Okay.
And of this, nearly 90% is imported. So a key concern actually for India's energy security has been the high dependence on crude imports. Mm-hmm. Unfortunately, we have not been as successful in our exploration program.
Okay.
Most of our production still comes from old, matured fields, which are going through a natural decline. There's roughly a 3.5% CAGR decline in our oil production. Mm-hmm. And that makes us increasingly more dependent on imports. And that's what government has been trying to fix for some time, but it will probably take a bit longer.
Okay, all right. But is there a plan to go ahead and at least increase capacity from our domestic chaps? As you have been saying, that there's been a degrowth of close to around 3%. So there have been various companies that have put up plans to increase capacity?
So these are more exploration efforts. ONGC, Oil India, even private guys like Vedanta, they have a capex budget. So this is called risk capital, right? You have to go find out where the potential is, drill literally a hole in the ground,
yeah.
and then just pray to the God that you get lucky over there. But unfortunately, we have not been as lucky. So, yeah.
So it's a tricky business. As you said, around 5.5 million barrels per day is what our requirement is. And 90% of that comes through imports. That's on the oil side. Let's focus to the gas side of things then. How much is the global LNG supply? And how much of that supply passes through the Strait of Hormuz? Now we're talking about gas.
So, again, the global LNG trade is about 430 million tons.
Okay.
Pre-war, this was. And of this, about 20% or 80 million ton is from the Strait of Hormuz, okay. Mostly Qatar, a bit from UAE, but mostly Qatar.
So that'll be around 80
million tons, yeah. And that has again got, almost the entire trade got disrupted due to the closure of the Hormuz. Mm-hmm. And the key problem that caused in the markets that led to a spike in spot LNG, which has doubled to almost $18, $19 per MMBTU.
Correct.
Additionally, for the local players, it is a major issue because we are, again, heavily dependent on gas.
Okay, interesting. Since there has been a bit of a crunch for LNG supply itself, could you tell us how has India's LNG consumption changed? As you're referring to pre-conflict as well as currently. So how has that changed because of the geopolitical tensions? And also, if you could help us out with what proportion of India's natural gas demand is met through LNG imports? I guess the remaining part would be via domestic gas production.
Yeah, absolutely. So in gas, we are slightly better placed. About 50% is locally produced and another half is imports.
Okay.
But the unfortunate part for us is that imports is largely through the Strait of Hormuz because we are in close proximity to the Middle East and Qatar. Mm-hmm. Most of the imports have been coming from there. So in this whole trade disruption, our gas supplies have actually been impacted more than the rest of the world. So we are down 50% on LNG and about 20-25% in total gas consumption. And that has been hurting India's gas sector in particularly this current quarter, ongoing quarter.
Okay, so 50% of, of gas requirement is via the imported route and 90% via, for oil. And for gas, it's around
90% import oil, 50 gas, but of that 50 largely 50
coming through the Strait.
Coming through the Strait.
So the consumption number was what, around 25 million tons earlier?
Yeah, so in million tons it's 25. In MMSCMD, it was about 95 MMSCMD.
MMSCMD, okay. And that number has come down drastically because of the availability
it's
of
nearly
LNG.
halved.
Okay, all right. Got that. You were briefly mentioning that our players over here are ONGC, Oil India. I guess they'll be the major ones. But if you could put a number to that, what is their respective share? ONGC in particular, I think they would be a large part of it, as well as, Oil India. And I guess the other players will be relatively smaller, Vedanta and the likes.
India's total oil production is about 28 million tons. And natural gas is 1995 MMSCMD, which is 27, 28 million tons. ONGC has the lion's share of this, about 2/3 of oil and 50% of natural gas.
Okay.
Then Oil India is about 10 to 12% on both oil and gas. And then we have private producers, mostly Vedanta Oil, which produces largely oil and some gas.
Okay.
And then Reliance Industries, which also produces some oil and gas. And then there are some smaller players operating marginal fields.
Okay, but ONGC is obviously the major player out there because two-thirds of oil production comes in from them. And in terms of gas, they account for close to around 50% as well. Got that. Since we're talking about both these two, could you tell us the preference between ONGC as well as Oil India at current prices? What would your preference be and why?
Yeah, so we prefer Oil India, actually. We see them having a growth runway of 3 to 3.5% CAGR, which is quite impressive given that what we just discussed, that the discoveries have not been coming through. The benefit which they have is that they are in Northeast, which is a region where government has a very high focus on development of infrastructure, including the city gas infrastructure. They do have some reserves over there which need to find a market. Right. The market is also there. We just need to connect the market from the producers to the consumers, and which is what there's a hydrocarbon vision in Northeast, which is helping to do that.
Okay.
So we think that this will unlock growth potential for Oil India. We see, as I said, 3.5% CAGR growth rate for that. We have a fair value of 477 on that, which gives me a 14-15% upside. For ONGC, unfortunately, and ONGC is mostly an offshore-based production facility. Those facilities are like 50 years old. You know Mumbai High, right? I mean, it was discovered way back in probably 1965 or so. It's now in a phase of natural decline, and that is hurting them and causing this, in our view, 2.5% CAGR decline, which will continue in the near term. And therefore, we don't like it so much. Also, Oil India additionally has nearly 200% growth in refining capacity in the subsidiary NRL, which should happen in the next 6 months or so. And that is another key investment argument to buy that name.
And on Oil India, you're saying what kind of a growth are you factoring in for the next phase?
3.5% CAGR.
Okay, but they have been short of their estimates, I think, in the last few years.
Yeah, of late they have been. There was some recent issue in fertilizer plant which kind of impacted their supplies because, you know, it's a very tight, small market.
Yeah.
If one plant goes down, you don't have any other alternative because you can't go out from Northeast back to mainstream India. That actually is now possible because now GAIL is connecting a pipeline to Northeast.
Okay.
So it might make it possible for Oil India to evacuate to rest of India as well in case some local plant has an issue. So off late they had that issue. And then the gas connectivity grid, which we're discussing in Northeast, is a bit delayed as well.
Got it.
So yeah, I would say that it should come. It's just that this has been a bit of waiting for too.
You know, Amit, we want to know more about GAIL because they are the ones who will be transporting, right? So that's going to be important. So we'll touch that in just a bit. And I think Petronet LNG will be important with regard to these LNG imports as well that come in there. So we'll get to that in just a bit. But before we move on, you know, from the upstream to the downstream companies, I wanted to ask you, what's your estimate with regard to oil? You know, we were sitting pretty at around $60, $65 per barrel. Suddenly, oil spiked up because of this conflict, went to around $120 per barrel. And now it's back down, you know, to more digestible numbers of around $80, $85 per barrel. What are you all working with as a house for oil prices this year and the next year or so? What are you factoring in?
We are at $85 average for FY27, going to 75 and then to 70. See, oil futures has been in backwardation if you look at the forward curve.
Correct.
It just means that the traders are essentially saying that the geopolitical risk is keeping the market tight for now.
Right.
But in the longer term, there is enough and more supply, whereas obviously there's a longer term demand concern coming from electrification and ESG related concerns. So I think longer term, crude doesn't have a great outlook, so it's a short-term disruption.
Well, that's good news then, from an economic perspective as well as from a macro perspective and as well as for our markets. But let's focus now to the downstream. OMCs, let's talk about them. They operate in two verticals broadly. I think refining as well as marketing. So could you tell us which company has the highest marketing volumes if you compare it with the refining capacity? Give us a brief idea.
Yeah, sure. You're right. So OMCs operate two businesses essentially. One, they refine the oil into the products, which is petrol, diesel and all. And then they have a division called marketing.
Right.
So HPCL has the biggest excess. They actually sell nearly double of what they refine on a standalone basis. But they do have equity stakes in some refiners, HMEL and MRPL. So if you take a net basis, they are 40% higher on marketing. Then BPCL is 35% higher and IOC is about 10%.
10%. Okay, all right. So when you're saying that their marketing volumes are higher than the refining volumes, means they are buying it then from third parties, from other private...
From the private refiners.
And they're just marketing it?
Yes, yes.
Got it. All right. Now, given the global shortage of refining capacity, if you could tell us which OMC stands to benefit the most, because refining margins are strong. Will you assume that refining margins stay as strong? The reason I ask this is because there are core refiners, right? Like a CPCL or an MRPL. They have gained because refining capacity globally itself has got hit. And because of that, some of these, refining margins have moved up. So how do you factor that in?
No, again, you're right that global refining margins have moved up. But there are some caveats to it in an Indian context. One, our delivered cost of crude is now $5 to $10 higher than the benchmarks.
Okay.
So again, we are sourcing from longer distances, which increases the cost.
Correct.
Secondly, the yields have changed in the refinery a bit because LPG is now being prioritized, and LPG generally is a lower yielding product.
Correct.
So that again subdues. And then thirdly, actually, there is also refinery inventory losses because crude has come off very sharply, right? If let's say it stays here, I mean, you will see.
Then refining.
Yeah, because March crude was 110, 120, now it's 85. So essentially, these factors will subdue while the GRM should be healthy, but these factors will subdue the near term, let's say Q1 performance for the refiners.
Got it. So for the OMCs, most of their money will be coming in from marketing margins whenever they do make good marketing margins. For the time being, it's been, they've been making losses because of the spike you've seen in crude oil prices. But as you mentioned, crude oil prices have come down, which is good news for these guys. Their losses on the marketing side at least will reduce. So could you tell us, between the three, what is your preference? HPCL, BPCL, IOC? What do you like and why?
See, I mean, typically HPCL is a play on marketing because of the higher marketing volumes, and IOC is a play on refining.
Right.
So now that we are kind of seeing a reverse trade of crude coming off, I would say HPCL stands to gain, and then PPCL, which also has higher marketing to refining, and then IOC comes the last. So our preference is for HP and BP and not so much IOC.
Well, got that, Amit. Thanks for clarifying both on the upstream as well as the downstream companies. But you briefly mentioned some of those gas utilities. So I'll tell you what, we'll slip into a short break. You come back, we'll focus on the other stocks as well in the oil and gas spectrum. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. You're on CNBC TV 18. And we have with us Mr. Amit Murarka, the Executive Director at Axis Capital. Well, Amit, you've given us a fair bit of an idea with regard to the oil and gas space. You know, we have spoken both about upstream as well as downstream. But let's talk a little bit about gas utilities, because you briefly alluded to that. Tell us, basically, first, what does GAIL do? We know it's a transporter, but if you could help us out with that. And Petronet LNG as well. I think that's more like a converter. So if you could explain the business models for us of both these two, gas utilities.
Sure. So Petronet is essentially an infrastructure provider. It has all these terminals. I mean, the Dahej terminal is the biggest in the country. In fact, one of the biggest in terms of volumes globally in terms of regasification. So it just gets, the LNG comes in the liquid form.
Okay.
It needs to be regasified for consumption, which is what Petronet does.
Got it.
And then GAIL essentially lays out all these pipelines cross-country, transmits the regasified gas as well as domestic gas to consumers. And they also have petrochemicals and some other businesses, but the core is this.
Okay, interesting. So this war getting called off, or you know, the peace pipe being smoked is actually good for these guys because they were starved of their gas in the first place.
Yes.
Between the two, what do you like? You know, Petronet LNG as well as GAIL.
So we actually like both, I would say, but maybe as a trade on the resolution of the war, Petronet could see bigger upsides simply because it was beaten down a lot. As you can imagine, like 50% of LNG going down can hurt any company a lot.
Okay.
And along with that, as I said, LNG pricing has doubled. So the volumes essentially got impacted, and those are expected to come back now. So, yeah, and even GAIL should benefit, of course. But then GAIL, as I said, has other businesses as well. So the overall impact on the portfolio gets a bit moderated in that sense.
Interesting. So among the companies that we've just spoken about, Oil India, that's the one that you like more than ONGC. And from the OMCs, you like HPCL. While between these two, Petronet LNG is a stock that, you know...
Yeah, relatively, as a war...
Though you're positive on both of them.
Yeah.
Okay. But so if these concerns over the Strait of Hormuz, they're easing a little bit. LNG prices as well, you know, have cooled off a little bit. Don't you think that the city gas distribution companies actually would be one of your top themes? You know, because they are the ones actually that are supplying it to the end customer.
No, completely. In fact, the city gas space is our absolute top pick in the oil and gas space right now.
Okay.
We think that some of these names are actually ignored because, like, one, they are smaller in size. Secondly, there is a bigger concern around APM volume reduction, which is raising their gas cost, and then the war happened. So essentially, people have practically written off some of these names. And that's where we see value. Like, these stocks are still down 20% on a one-year basis.
So city gas distribution companies would be your top ideas from this sector?
Yes.
From all that we're discussing today? Completely. Okay, tell us a little bit more then, because, you know, these guys, they will be delivering PNG as well as CNG. So between the listed guys that we have, you know, if you could explain to us who has a greater share of them, or is it pretty much even, Steven?
No, so IGL is the biggest in CNG. About 80% is CNG for IGL. And then balance is your household pipe gas and others. For MGL, it's about close to 70%. And then for Gujarat Gas, CNG is only 40%. So it has always been traditionally a big industrial supplier because, as you know, Gujarat is an industrial market. They also cater to Mobi industrial cluster, which is a large cluster. So industrial has always been a big segment for Gujarat Gas.
Okay, all right. So, and just to clear it for our viewers, CNG is the one that you put in your vehicles, while PNG is the one that comes home, you know, for you to cook your food as well. Got that. Now, between these three, IGL, MGL, as well as Gujarat Gas, you have given us the broad dynamics. What would your preference be based on the market dynamics, based on their mix, and based on current valuations as well? What do you like?
So we are most positive on Gujarat Gas right now.
Okay.
So again, it's a name, I think, which people have kind of hammered down a lot in the last 2 years. And that was to do with Morbi, large part of it. Because Morbi was moving from gas to propane.
Okay.
So this war has changed that scenario quite a bit. So just to give you the numbers, Mobi volumes for Gujarat Gas went from like peak of 6.5 MMSCMD to 2 MMSCMD in the recent concluded quarter.
Okay.
But because propane kind of went out of the market, that volume has jumped back to 7.8.
Okay.
So we expect really sharp volume growth in Gujarat Gas. Additionally, they have had this whole merger completion, wherein now they also have a LNG trading business within the portfolio.
Okay.
So earlier they used to buy LNG from the same company, which is GSPC.
And now it's under their fold.
Yeah, so that essentially kind of improves the city gas margin, because some of the margin which was getting captured is LNG trading will gradually get migrated to CNG or the city gas business, and generally this business gets a better valuation.
Okay.
And also there are some tax refunds which will come in as part of the merger process. So all in all, I would see a great outcome for them in the near term, and in the longer term on the margin front, things to look good as well.
So Gujarat Gas would be...
yeah, and then followed by MGL and IGL.
MGL and IGL, so that would be the preference.
Yeah.
Well, final question before we let you go. Amit, you've given us a fair bit of detail on the entire spectrum of the oil and gas space, gas utilities, as well as the city gas distribution companies. What's the feedback you're getting from investors with regard to this space? Because it's always prone to some government intervention. There are so many moving parts out there. What has been the feedback that you've got?
That's the feedback. You summed up the feedback. So the feedback has been that the regulatory, I would say, flip-flops don't help. Recently, we saw a change in royalty rate in May getting reduced and then getting raised again. People, generally investors don't like uncertainty, right? So, therefore, there is generally a preference for the distribution space, which is your OMCs and your city gas companies. City gas companies have fallen out of flavor a bit of late.
Yeah.
But yeah, mostly like people would want to see better stability on the fiscal terms and the taxes.
Well, Amit, you've educated us a fair bit about the oil and gas sector. We thank you for coming down to the studio and helping us out understand the entire sector. And as you've said at the end, the sector, it appears, not the one for the faint-hearted, because it's prone to a lot of changes. Thanks a lot for joining in.
Sure.
Well, on that note, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching. That's it from me and the entire team that put this show together.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Crude prices are down. We're seeing Asian markets have opened up with that sharp cheer as well.
President Trump saying deal with Iran is now complete. Let the oil flow.
For the calendar year 26 will be net positive as far as foreign flows are concerned.
1.6 higher, 1.5 higher, so 23,980. It's almost 24,000 by the way on the Nifty.
6 million will be in 3.5 years time. Okay. And 5 years time, 1 million ton largest producer. And demand is so high.
I think before the war started, weeks preceding that, it was in the high 60s, so it's still 20% higher.
Huge sigh of relief for even policymakers, because where it hurts most in policy making is not the fall in stock markets, but the fall in the currency.
I think a bigger worry for the Reserve Bank is that in spite of the increased fertilizer prices against the background of the Middle East conflict.
Fuel prices was one big reason why you saw that big rise in WPI.
Big outperformers, I have to say, in the Asian market, so to say. Kospi is up 36%, Nikkei is up 17.5%.
Though dealers are guessing that bit FPIs are coming in.
Markets are cheerful, they've continued to be cheerful, but have come off from the highs of the day.
Well, the markets have been cheerful and they continue to be cheerful, notwithstanding the 100-point downtick that we've seen from the day's high. You look at what we've gained, and that's exactly how this trade has been so far. That's the day. It's closing bell. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, joining shortly, will be Nigel D'Souza. But if you look at the frontline indices, no real complaints out there. Again, like I said, notwithstanding the 100-point downtick that we've seen from closer to 24,000, it's a big rally that we've seen from the lows that we saw as early as last week itself, closer to 23,200, 23,300 thereabouts. From there, it's been a near 600-700 point rally, and it's been led higher by the Nifty bank. So, it's only fair that there is some bit of underperformance out there, or so-called profit booking. I mean, you can't even call it underperformance because it's up 0.8% as against the frontline index, which is up about 1.2%. But the real deal is in the broader markets. The mid-cap index up about 1,000 points. We have 1.7% in terms of gains, but nearly 5 stocks advancing for every stock which is declining. The stocks that underperformed because of weaker consumer sentiment, because of the uncertainty around the war, all of them are now coming undone. We are seeing big traction in a bunch of these names. So, look at Aarti Industries, up around 12.5%. Higher gold prices meant jewelers would do better as well. So 11.5% higher for Kalyan Jewelers. Balkrishna Industries, lower crude prices helping the cause of tire makers. That stock up around 9%. Uno Minda up 7%. And the toast of today's trading session have been all the financiers, the non-banking financiers, all of them higher. And then the last few minutes, we've seen, some of these retail plays come to the fore as well. Trent, for one, is the top Nifty gainer right now with a gain of almost 7%. We have, Avenue Supermarts, D-Mart, that too has moved higher, about 3.5%. So currently at the high point of trade for that stock as well. And moments ago, we saw a bit of a spike on Bharti Airtel. So the intraday of that one comes up for you as well. That stock is higher by about 2%. Nigel, it's been a good day so far. No problems, with regards to the sort of profit booking that we've seen at higher levels. The bulls will take that in their stride.
Well, that's right, Mangalam. And I tell you what, Indian bulls are quite smart, right? We saw a 500-point rally getting into the weekend itself. So some part of that trade did take place. But what I like is the pieces that these are coming together, wherein, oil and gas import-dependent country. And, I was just speaking to Amit Murarka of Axis Capital. He was just explaining on Finding Alpha that India imports 90% of our oil requirement, 50% of our gas requirement as well. And, we're seeing a big relief in some of these stocks as well today. Even the gas names, the CGD players, the city gas distribution companies, well, they were starved of gas. Now, at least, that opens up. So that's why you're seeing some of those stocks that are rallying. And remember, they have corrected a good deal. Besides that, the rupee has shown some signs of stability, which is good news. So gradually, the pieces are coming together. Cherry on the cake, Mangalam, will be, you have those FIs that have been selling less. Today, they don't just cover some shorts. If they come back and they put some money, wow, may not be the reason to open the champagne, but it'll at least be good times, right? Because they have been selling lock, stock and barrel. So
Yeah, I take that point. More than opening the champagne, I think the bulls will be more excited about opening the umbrella this time around, because the IMD has said that over the next 4 to 5 days at least, monsoon should reach parts of Mumbai. And it's a funny thing that you don't need monsoons to reach all of the country to actually get the stock market excited. Some showers around the Lal Street and everyone is like, okay, there is monsoon in India right now. But let's get in Mitesh Thakkar, who joins in with some of the closing strategies. Mitesh, this morning you had said that, maybe there could be some bit of profit booking and you should not chase the opening high. That's exactly what's happened. Buying the dips is something that one should look at. We've dipped about 120 points from highs. Is that enough for you to start nibbling in, or maybe a dip towards, say, 23,700, 23,800, those support zones would make you a lot more comfortable buying?
Good afternoon, then. I think it's very difficult to give exact levels, typically when it's just slightly news heavy flow kind of market. But I think I would be agreeing with you by saying that yes, this is the time to slowly start accumulating long positions on the index. The Nifty, the back Nifty, we had already been bullish for 3-4 days back as well. So the Nifty, and in case 23,850 to about 23,800, that's your second entry point. I think I would believe that we should not only once again challenge 24,050, but maybe, try and get past that over the next few days. And once that happens, we might head towards 24,300 odd levels, broadly give or take 50 points. So I think that's the view, and therefore slowly buying into the index might not be a bad idea right now. And eventually, I think, if you get a better entry point about 70 to about 110 points lower, even more welcome buying opportunity.
Right. Has a new trade opened up post today's price move?
On the?
On any sector right now, anything particular, a new trade because of the price action that we've seen?
I think the entire pack, I think barring to a certain extent, I would say that Nifty IT, the rest of them, if not a very long-term trend reversal. So I think barring IT, I would be, fishing for all long opportunities, be it
okay, we have you on a bit of a scratchy line. What we'll do is we'll try and just get your stock picks. Before we get your stock picks, let's perhaps, okay, should we try getting his stock picks? Oh, okay, we'll just try and repatch that connection. But the story of the day has not just been the markets. More importantly, from a macro standpoint, it's been the rupee, which rose by 0.5% today, in sync with most Asian currencies, which are celebrating the potential opening of the Strait of Hormuz and the fall in crude prices. But the Indian bond yields as well fell to near 2-month lows, which explains the up move that we've seen in NBFCs as well. Lata joins in with all that and more. Lata, the rupee, it made a low, and a lot of the street experts believe that, okay, this low is formidable now, and now we are seeing some strengthening.
Well, the rupee is strengthened now for the second straight day. Today, it may look less strong. I mean, the strength is not as much as the Indonesian rupiah, for instance, which is up over 1%. We are up 0.5%. But we must remember that we've been rallying for some time now. And it was a quantum leap on Friday and Monday. So at the moment, the rupee is on a strong wicket. We can first see what are the causes. Immediate causes, of course, we are always a negative algo to crude. Whenever crude falls, the rupee strengthens. That's the natural algo. But more importantly, because of the expected flow of FCNR deposits, and with each passing day, the expected numbers rising in the market, we are seeing a lot of corporate selling, which would be exporters who are sitting on a lot of dollars, expecting 95, 96, 96.96. Now, all of them selling their dollars in a hurry. Even over-hedged importers are in the market. This is not so much of foreign selling, because the foreigners had started cutting their rupee shorts about 2-3 weeks back. There were dealers telling us that in the NDF market, where the FPIs operate, they're already cutting their shorts. And the rupee value on certain days was even higher than the domestic rupee value. I mean, it was stronger. The debate in the market is whether the Reserve Bank will stop the appreciation. There's a small coterie which believes it might, because if this strengthens a bit too much, then their swap rate, because they're going to take the entire hedging cost of FCNR deposits, that cost may go up. But there is an even larger band which thinks that this argument doesn't hold, that the RBI will not stand in the way of the rupee this time because they have thrown everything at the currency. Now it's a matter of credibility to ensure that the rupee strengthens. So they will not stand in the way, and they are expecting more strengthening as the FCNR deposits actually come in. At the moment, these are more announcements from the banks. Must say a word about the bond market because that's going to impact all of us. We're seeing a seminal fall in the yields now at 2-month lows, April 15th lows. And you're seeing all kinds of debt instruments, CPs, CDs, all of them losing, between 25 and 50 basis points since June 5th. As the FCNRB issue started percolating. There's a substantial fall, and this is extremely positive for all interest rate sensitives. As you can see, among the better performing indexes in the month of June have been real estate stocks as well, and of course banks and NBFCs.
Okay, all right. So that explains why, Lata, some of these banks and financials, they are the ones that are actually leading the rally in today's trade itself. Bond yields cooling off by close to around 30 basis points. It helps in terms of cost of borrowing, I think, for those NBFCs. Thanks a lot, Lata, for joining in and filling us in with that quick take. Well, Lata, you want to add a little bit more? You've given us a brief idea.
I just thought if you would give me time, I'll add a little bit more on the banks because there is another big data that came over the weekend on banks. The credit growth is a fiery 17.7% for the fortnight ended May 31. We have not seen this number post-COVID at all. We went to 16. We have not gone to 7. This is nearly 18%. It's a huge rally that we are, a huge surge that we are seeing in credit demand. And that is another factor why banks and NBFCs are rallying. The interest rate cost of funds factor is also there. So now for the banks, it's a double advantage. Both margin per loan they sell and the amount of loans they sell, both are increasing. So they're sitting pretty, you will have to say. The FCNR schemes are expected to lower their overall funding cost by about 3 to 4 basis points. So overall margins can go up by that much. As I told you, the certificates of deposits, that is when banks raise money from the wholesale market. The bank loans are called CDs, the bank debt, and corporate debt is called CPs. In both cases, we're seeing the yields come down. So for the banks, that's a cost of finance coming down. And they're going to get mark-to-market gains. Like I told you, the 10-year bond yield has come down all the way to 6.85. Its high was 7.17. So a 30 basis point fall is a mark-to-market gain on some of their instruments, which means Q1 itself, you might see improved banking performance, definitely in Q2 when, more of the funding cost fall comes in. For NBFCs, obvious advantage because of lower yields in the market, they can borrow. As well, banks will be willing to forego a little and give them cheaper loans. So at the moment, actually, there are, a small tactical trade, which some traders were telling me, is to go from private banks to NBFCs. And of course, the bigger reason why you have to see positive about private banks is most of the FPIs have been treating the Indian banks as their funding sector. You want to buy an Nvidia, sell HDFC Bank. That seemed to be the trade because it's a large liquid stock. And therefore, if the FPIs were to return because of the change in the algo trade in favor of India, you must see some kind of positivity on banking stocks. So overall, the chatter in the market appears to be pro-banks, pro-NBFCs, both for margins and the quantum of loans.
All right. Pro-banks, pro-NBFCs on margins and the quantum of the loans. Rupee doing well, oil is lower, bond yields have come down. All we want, like we said, is the thunderstorms to come by and the monsoons to come. That's something that we want. Early Diwali, if there is a monsoon that comes by already. So let's welcome Dipan Mehta, Director, Elixir Equities. Dipan, Donald Trump said, let the ships rev up their engines and let the oil flow. What we want is for FIIs to rev up their cash registers and let the flows come into the Indian markets. What do you make of the move that has happened so far, and what is it that you like? I notice an Indian flag behind you right now.
Yeah, well, I think it's most appropriate because I think every time we see cessation of fighting in the Gulf or any geopolitical event that gets resolved, and India does well, because I think India does really well in peacetime. and we have certain weaknesses, which of course the government is addressing. But this is certainly great news. And I'm not so much perturbed about FII selling. I think when they come to buy, they will buy. But more importantly, I think that if we have a deal between Iran and US, then the fundamentals of the Indian economy, corporate earnings, which have been deteriorating for the last 3 months or so, we may start to get a reversal over there. Because inflation, wrecking of supply chain, overall, I would say domestic demand being subdued, overall sentiment being down, all of that can get reversed if you know that now the problem in the Gulf is over and that eventually oil will start to flow easily, inflation will come down, and the kind of pressure which is on liquidity will ease. So I think it's more to do with the stoppage of the deterioration of the fundamental, which is more important from our perspective.
Okay, all right, Dipan, just a quick word. That's the flag has just come up, or are you joining us from another location?
No, this is our location and office only.
Okay, it's a different camera angle than I'm thinking.
We're just experimenting with some frames, so I hope you like this frame.
Yeah, absolutely. It's a beautiful one. You know, I'll tell you what, I've had a pretty good day because I've done a couple of big interviews. I had a special show, Finding Alpha, as well. But for me, the high of the day was I was at the BSC earlier today and singing the national anthem out there. You know, a different feeling altogether. Goosebumps, it felt so good. And, you know, seeing that flag as well. Such a good feeling.
Always a good feeling. The only thing is that he was experimenting with the frame. We bring him back. Are you looking to experiment with some of the career switches as well? Because this is something that we typically see, Dipan, on government officials and the people who are looking to get into some sort of political
vote for
Dipan. No such thing. Just my cabin is kind of occupied, so I'm coming from the front.
No, we're just pulling your leg out there. But
I think it's been a while, Dipan, since I've visited your office, you know, so I think I need to come across earlier as to frequent it quite often. But we got that. I wanted your view on the Vedanta group, actually. So let's come back to you in just a bit. For the time being, you know, Vedanta's demerged entities, well, they have listed on the bourses today. So now you have 5 listed entities from the Vedanta group. I caught up with the chairman, Mr. Anil Agarwal, earlier today. He believes that each of these verticals can be $100 billion worth. Let's hear out what he had to say.
Intrinsic value of each company going to beyond $100 billion.
$100 billion every entity.
Company started producing 3 million ton, going to be 6 million ton.
Okay.
And vision is to go for 10 million ton.
By when 6 million ton and by when 10 million ton?
6 million will be in 3.5 years time.
Okay.
And 5 years time, 1 million ton largest producer. And demand is so high, still there will be a gap.
Okay, all right. So 6 million tons in the next 3.5 years, that's going to be an interesting perspective.
And 5 million, 10 million ton in 5 years.
In 5 years.
Not far.
So by 2032, 2031 odd, you will have close to a 10 million ton Vedanta aluminium facility itself. Got that, sir. All right, Dipan, you know, some of those that played this particular demerger purely for the demerger perspective, they are making some good money because towards the record date, the stock price was ballpark around 730 rupees approximately. If we do the sum of all parts, the stock price is already at around 900 rupees, and at the highs of today, it was even higher. What is your view? Any of these businesses you like? Because the feedback that I'm getting is, you know, everyone wanted the aluminium business. And these numbers that Mr. Agarwal put out are looking phenomenal. He's also told me that he'll do $5 billion of EBITDA just from this business, which is almost equivalent to the entire company. Any specific business you like? Do you like the large one? It's listed at 522 rupees, which is the upper end. Or do you like some of these smaller companies, the steel business, the power business, you know, or the oil and gas business?
No, Nigel, I'll go with the majority view. And I think the aluminum business was the most exciting piece. And with aluminum prices gradually moving up and more applications for aluminum in EV, electrification, I think that's one metal which has the best prospects. Although zinc has been a money spinner for the Vedanta group, but zinc is linked to iron and steel production. But aluminum has got many other applications. So very positive on Vedanta aluminum per se. And I think that all the companies should do well. And a lot of the kind of negativity which was there around debt at the holding company level, those are now completely resolved. And there's a great deal of clarity in terms of who wants to invest where. For example, if I like iron and steel, I have a choice. If you like aluminum, you have a choice. And now oil and gas also certainly has come into play because of higher oil prices, and maybe government will do something on energy security. So I think all the companies have got great prospects. And I wouldn't rule out some M&A activity over there where these entities either get acquired or acquire other entities to become big, because Mr. Agarwal's dream has always been to scale up. And now I think each of these companies will be in the right frame of mind, or I would say right management attention to scale up significantly.
You mentioned the aluminium business. It's at around 495 rupees. It's down from 520 bucks approximately. Some of those that are playing the special situation are selling. Where will you be interested in? Closer to 450 rupees? Would that be a level? The calculation goes as such that 32,000 crores is what the street is estimating for FY28. This year is going to be even better. It could be 40,000 crores. But just looking at FY28, then in fact, if you give it a 7 multiple, 6.5 multiple approximately, the value comes to around 450 bucks. So would you be interested closer to there?
See, I haven't gone that deep into it. And for the record, we had invested in Vedanta, the consolidated entity. And now I think we are just remaining invested in the existing entities as well. So I would just remain invested, let 1 or 2 quarters go, and maybe the valuation will kind of improve, or we get a better understanding.
All right, take that point. Dipan, I just wanted your thoughts on the real estate space. As we speak, look at some of these names which are spiking right now. Prestige Estates for one. We had in the morning Irfan Razak, who did say that, there is a fair amount of overhang, sentiment overhang that goes away. That stock is up 6.5%. They have 66,000 crores of unearned revenue, which, is sitting on their books, outside of their books rather. They will earn it. And more importantly, they're saying that they're looking at demerging this business as well over the next few years into a hospitality arm, into an annuity arm, and all those other factors that they're doing. Betting beyond residential, looking at retail assets and looking at commercial assets as well. What are your thoughts on the entire real estate space? It has been compressed because of sentiment weakness during the war. Do you think now it'll be a spring which will come undone?
See, I think that real estate has underperformed the last 12 months or so, probably because we expect a slight soft period for the entire industry, because it's been on the go since COVID. So maybe, a couple of quarters more, one can expect slightly soft performance, although long-term prospects are very good for these companies. And most of the real estate companies now, I think, are very disciplined when it comes to new project launches, debt in their books, collection, cash flow, and also acquiring new land. So broadly, I would be very positive on them on a longer term basis. But I think that the way the kind of fundamentals and the kind of growth which has come in the revenues and the bookings, the base also has gone up. So it would be difficult for them to kind of repeat the same kind of growth rate going forward. So maybe 2-3 quarters, bit cautious, but I'm not selling because of that. I would remain invested. Long-term looks very good for these companies. And I would prefer for companies which have got annuity-based income, because that reduces the volatility in their earnings.
And what names are we talking here when it comes to the ones that you are invested in and you recommend to stay invested in?
See, first of all, with usual disclosure, we're very positive.
Yeah, they're all the disclosures.
Properties. Godrej Properties, I think India's largest real estate company, very, very strong management commentary, superb brand, excellent execution. And what has happened is that the net profit margins have moved up over the last 4 or 5 years, and now are in the kind of mid-20s or so, which is very impressive. And this is one company, I think, which is worth watching. Great compounding story as well. So, but they don't have annuity-based income. The ones which you look at, which have got good annuity income, of course, is DLF and Prestige. And those also, I think, have got great prospects. But, even if you look at some of these co-working spaces, that's an interesting kind of a niche over there within the real estate space. Companies like WeWork, Office, and I think there's one more also. I think all of these companies also are doing exceptionally well. Yes, they're all doing exceptionally well, and they're almost kind of doubling their office space which they have under management for the next 2-3 years or so. And this entire trend of global companies setting up GCCs here certainly benefits them, because they offer flexible office space, and that too not just in one city, across India, wherever they want to set it up. So that's one niche which we are exploring quite closely and looks very interesting to me.
Got it. Dipan, thanks a lot for joining in, giving us, the call on all those stocks. I think time for some more water. Make sure Varun comes and give you a coffee, maybe, a little bit of a niggle in the throat. But always good having you on the show, Dipan, and love the backdrop today as well.
Thank you.
Well, time to slip in a short break. On the other side, our Alpha Manager of the Day will be joining us. Stay tuned. Welcome back. Markets holding with a gain of close to around 275 points, and the Nifty Bank is well up close to 500 points. So let's shift focus back to what's keeping sentiment up. A peace deal between the US as well as Iran. Crude prices are on the downtrend. Gold has picked up momentum, and stocks are moving accordingly. No one better than Sudarshan to join in and tell us the impact of the sharp drop in crude oil prices and gold prices spiking up. Sudarshan, take it away.
We have been focusing on the market because of the sharp up move that we are seeing across the board. But if you take a look in the commodities basket, two major moves that we are seeing. Crude, while it's down, there is an up move that we are seeing gold prices. Gold is back over $4,300 per ounce, while Brent is back below 83 for the first time that we have seen in last 2 months. Now, what's the impact of all this on these stocks? So I'll start with oil and gas. So while it's positive for OMCs of BPCL, IOC and HPCL, it's negative for upstream oil companies of Oil India and ONGC. That's the reason you are seeing a big up move in all the three names of OMCs, while ONGC and Oil India are lower in today's trade. Next comes to aviation companies and paint companies. For both these sectors, crude is one of the important costs. So for paint companies, up to 50% of their input cost is linked to crude. While for aviation companies, everyone knows that ATF is one of the important costs. Now, if there is a fall in the crude, there is in all likelihood ATF prices will come down too, and that's the reason. While Asian Paints in the last few trading sessions, the stock had moved higher. That's the reason. After opening in the green, it has turned red. Currently, it's flat. While Grasim, Pidilite, Indigo, all these stocks are up somewhere in the range of 2 to 5%. Next comes to CVs and CV financials. We did discuss about this on Friday, but the similar kind of move we are seeing today also. Ashok Leyland, one of the important players in the sector, is today also up almost 5%. Last two trading sessions, it's up almost 15%. Similar move is seen in Tata Motors commercial vehicle, Force Motors, Shriram Finance. Shriram Finance is the top Nifty gainer. Similar move is seen in Chola Investment. These stocks, because diesel is one of the important costs for truckers. Now, if the crude prices come down, utilization for all these fleet operators increases, and also demand for MNSCVs and LCVs improved if there is a fall in crude prices. It does happen with a lag of 1 to 2 quarters, but it does improve. That's the reason we are seeing a big up move. Lastly, about the autos, all the other auto companies are sharply higher because there was a concern related to margin, because if the crude remains high, margin will be under pressure for majority of the auto companies, especially four-wheelers like Maruti, M&M, and all the other players, even Tata Motors passenger vehicle. But now with crude falling, margin concerns will go away, and that's the reason. Maruti up more than 3%, M&M up more than 3%, TVS and Hero MotoCorp 2 up more than 3 to 4% each. And lastly, gold price increase and the impact. Gold financiers and gold companies. Amongst gold companies or jewelry companies, Kalyan Jewelers, they have an exposure in the West Asia. That's the reason you are seeing a big up move in that name, up more than 11%. While Muthoot Finance and Manappuram Finance, both these companies do benefit when gold prices increase, because AUM growth does increase and loan ticket size too goes higher. And that's the reason today both these names are up more than 4% each.
Take that point. So thanks a lot for that. So those are some of the gold players, gold financiers, all the ones that get impacted both positively and negatively by this peace deal. But the last few minutes, a lot of these life insurance players have found some buyers. Among the top gainers now is also, HDFC Life, which has moved to the high point of trade with a gain of almost about 4.5% It's been a stock which has been underperforming, down about 25% this year, finding some buyers at lower levels. The other one is SBI Life, a relative outperformer as compared to HDFC Life in the sense that it's positive for the year, but that one too has moved higher. But we do have some of these NBFCs doing a lot better. Fed Bank Fina, or Fed Financial Services, up 7.5%. The other one which is seeing some traction includes the likes of Blue Star or even Timken India, both of them up by about 2 to 3%. And guess who has them in their portfolios? We have Anirudh Naha, who's the CIO alternates, PGIM Asset Management. Anirudh, you might be feeling a lot better, especially the move that we've seen in Fed Fina. It's just about less than 10% away from its 52-week high. It's been one of the outperformers on the entire NBFC space, which is doing well because of this peace deal and lower bond yields. What's your sense? The next leg of rally comes in from NBFCs as against banks, or do you believe that banks continue their outperformance and NBFCs will just follow?
Thank you for this opportunity. We remain extremely convinced on the NBFC side.
Basically, what happens is if inflation comes off, your cost of capital hopefully starts moving south, and NBFCs gain out of that. Clearly, they don't have to manage CASA, etc. So we would play NBFCs as probably one of our top the segments to play out there. And some of the names that you mentioned, probably on the NBFC side, they also benefit from rising gold prices because they have gold as one of the segments that they participate in. So we remain extremely positive on the NBFC segment.
On the gold financer, that's an interesting point. How do you play it? There are the core lenders. The largest one out there has got a little bit expensive, so that's why that's pulled back from 4,000 to around 3,000. There is, a new marriage, so to call it, in the other one. They've got new leadership over there, and the hope is that Manappuram as well does well. And then there are various other pockets to play this gold financer theme. I noticed that you have FedFina, IFL Finance. I'm not sure whether FedFina, how big is the gold exposure, but you have other stocks like IFL Finance and some banking names as well that have a lot of gold. How would you play this theme?
So we generally, while picking up businesses, we look at how they have delivered and what is the quality of management over a period of time. We like to stick to the largest names here, given that the space generally is a small space. And within that, if I get a good business having corrected about 30%, I think so some of these names actually, the cleaner ones, where we have a lot more confidence, is something that we would want to stick to.
Okay, largest name, that would be Manappuram. No, that would be Muthoot. Apologies. That would be Muthoot. Apologies, the one that is corrected 30% from the top and the largest, cleanest name out there. Got it. Aniruddha, I wanted to ask you, what about the metals pack? In this last few months, actually, the pack has done very well because the street was focusing more on supply side restriction. And in the last 10 days, they got a little bit worried about demand destruction. Now things are up and going again. So demand destruction hopefully doesn't take place. And the global growth continues on the path that was earlier set out. How would you approach this pack? And did you play the special situation with regard to the metal conglomerate?
No, we've stayed away from the special situation. Our focus on the alternate side is largely on the mid and small cap space. Because on the alternate side, if a client is coming in, it doesn't make sense for me to go and dish him out some large caps which are easily available. When we look at the metal space generally across ferro and non-ferro, we believe unless the world goes into a real topsy-turvy, we believe the commodity cycle has just started. And generally commodity cycles rally over the next, they usually rally over 3 to 5 years. And in such a scenario, probably I think both ferro and non-ferro will continue to do well. In that, probably, the names that you reflected, there are players who benefit out of the electronic arc furnace route of steel making coming through. So there would be demand for electrodes out there. There are very, very interesting small and mid-cap names in the metal space. We've stuck to some of them. And we believe if someone really takes a 3-year view and if the global cycle doesn't really, tank off, I think some of these names across commodities should do very well over the next 3 to 5 years.
All right. And some of those will be the ancillaries. As you said, electric arc furnace, the shift from BF, blast furnace to electric arc furnace. Two names come to mind, HEG and Graphite India. And you've got, as per your recently disclosed holding, Graphite is a stock that you'll have in your portfolio as well. The play on EAF, electric arc furnace.
All right, let's move away to things that people relate with at an intuitive level that are some of the consumer discretionary and staples names that you have. One is Blue Star. Obviously, it is extremely hot right now. A lot of people believe that maybe this could be a summer which would do well for these guys after a lot of pain that we've seen in the last 3 or 4 quarters for them. Is that your thesis? Was the structural view here? And the second one is United Spirits. It's been a rank underperformer in an otherwise strong, macro top-down approach for the country. If you look at any alcohol analyst, they would obviously bet on the demographic dividend, ease of regulations, and the low per capita income, etc. Rather low per capita consumption. United Spirits had the additional kicker of Royal Challengers Bengaluru as well, where they've unlocked value. But all of that, none of that rather, has caused the stock to move. So on that part and Blue Star, give me your thoughts.
On the, without naming, let's say, an AC company, we believe the underpenetration is actually very visible in India. And if someone really takes a little longer term view, not only the front-ending AC companies out there, even at the back end, there is a lot of value chain who will really benefit out of the underpenetration out there. In this season, of course, there is definitely a tailwind in terms of how temperatures have behaved in the country and how things move ahead. But even in a longer term, 3 to 5 year, or probably even longer, because these being consumer trends, if they can keep evolving in terms of their product, we believe these will not be extremely high growth names, but can they go ahead and deliver a 16-18% kind of growth sustainably over the next 5 years? We believe this segment definitely has the wherewithal to do that. At the back end, it is far more consolidated. It's only about 2-3 players out there, and hence the growth at the back end players could turn out to be even more interesting. So we remain very positive on this theme, the consumption part of it, especially through ACs or coolers or whatever it is, and the full value chain. Coming to spirits, without again talking about a single name, you are absolutely right. The thesis is the longer term play, how it plays out. I think India over the last 1.5 years, we've seen some, because markets haven't done very well also, the premiumization hasn't caught up. But over a period of time, if you look at any of the Western countries, you generally see premiumization catch up. Something which not many people are talking about, the infusion, penetration level of, let's say, even tequila in India has started moving up. Vodka was something people generally talk about, but tequila is the next thing that is. So we believe not only newer varieties of drinks come through, there will be premiumization. And probably the name that you are highlighting is one company which has vacated the full commodity space and focused largely on premiumization. As per capita GDP moves up, we continue to be extremely positive on how some of these premium players play out, along with the fact that you mentioned the cash flow that is coming through from the sale of RCB.
Just to add to that, we take that point entirely that, tequila, and we've been speaking to a lot of experts out here, doing a lot of academic research as well. Me by reading the labels, and my co-anchor by emptying those bottles. But I have to ask you, a lot of the other mid-sized players also have increased their premiumization play. Some of them by either acquiring companies or the others by, increasing their brand presence. And those were available at a far cheaper valuation than the industry leader. Does that put the leader at a bit of a risk and makes the others a lot more attractive as bets?
See, actually, when you're talking about pricing, I'm assuming you're talking about the product price or the stock price. I'm not sure.
The stock price.
Okay. From a valuation perspective, last 2 years, frankly speaking, some of the mid-cap names out there and 2B large caps probably in the next couple of years or 3 years or 5 years are at almost par with where probably the leader is. Having said that, if you go down to small caps, and probably a little smaller than the small caps, also what we call as micro caps, there are very interesting plays out there, companies which are just started the premiumization process. And I had mentioned this earlier also, there are plays where not only is the premiumization happening, there is also an ethanol story which is playing out in some of these companies, because they are producing ethanol also, and it is, they can swap between the Indian liquor part of it and ethanol. So if someone really goes down the value chain, there are very interesting place. And when we go down the value chain, we generally like to see both the segments being present. At least if liquor doesn't sell, you've got ethanol to sell out there.
Gentlemen, it's a Monday afternoon. Please, let's get back to the markets. But thanks a lot for that in-depth explanation. Mangalam, the teetotaler as well, is pretty much cued into all of that. And I'll tell you what, tequila, one thing I know he knows for sure is that it's low in terms of calories. Yeah. So if he does, I'll let you know. Thanks a lot for joining in. Wishing you a good remainder of the day.
Thank you.
Well, time to slip into a short break. As always, we'll get you some trades, buy-sell trades from a technical expert. Stay tuned. Welcome back. You're tuned in to Closing Bell. Well, our markets have come off a smidge from the high point of the day, actually. The Nifty is now up only around 200 points, so it's a bit of a slippy slide in the last few minutes. HUL has moved to the low point of the day. That has a decent weightage. You have Adani Ports as well. That slipped a little bit in the last few minutes, so we should get both those two up. I think Hindalco has come in for some profit taking. So a few of these frontline names have come in for profit taking. However, from the broader markets, Yes Bank is a stock that I'm looking at. Massive large trade actually took place around 15 minutes ago, and that one in fact spiked up and now it's cooled off a little bit. So Yes Bank, I'll be interested to see at the end of today's trading session who were the parties to that trade, because clearly there's a large bit of equity that changed hands over there. And also Lotus Developers, one of those stocks that listed with a lot of excitement, I think from 150 it went to 220. That one corrected big time, I think at half from the top, and now we're seeing a bit of a volume spike on that one. So we'll keep an eye out on that one as well. But let's get in Mitesh Thakkar. He's got a couple of buy and sell recommendations for us. Mitesh, fill us in.
Am I audible?
Yes, you are. We want to hear your trades.
Sure. Shriram Finance is something, which is come on my radar. I think, Nigel, that's, you were talking about NBFCs which are into commercial vehicle financing as well as automobile stocks. They've all done well. So Shriram Finance is a BTST stop at about 988 for targets of, let's say, 1020, 1025. And the other one is REC, which is a BTST with a stop at 348.5 for targets of 356.
All right. So those are a couple of these calls that Mitesh has. Let's talk about something that everyone's waiting for: monsoon. Everyone's waiting for monsoon to gather pace, and they may need some patience. The IMD indicates that the rain activity over Mumbai and adjoining regions is likely only in the latter part of June. Our colleague Santya spoke with Bikram Singh, who's the head West Zone at Mumbai, at West Zone at IMD, and this is what he had to say about monsoons in Mumbai.
Monsoon surge, which was there, with which it reached up to Goa and adjoining area, till up to that area, and that has also weakened. So at present, even if we see for around the next 5 to 6 days, so I will say there won't be much progress in the monsoon activity. At present, some clouds over the equatorial region has developed, so they will move northward. So that cloud only when progresses further, so it will take at least around a week to reach over Goa or southern Maharashtra. So you can say till 20th, I will say till 20th June, over Maharashtra, some parts, southern Maharashtra, it may start.
If the monsoon starts progressing on the western front by 20th, how long will it take the monsoon to reach Mumbai? How many days?
Yes, that is what I mentioned, 4 to 5 days. There will be after 5 days or 4 days, some progress over southern parts of the Maharashtra. But when we talk of reaching the monsoon over Mumbai, so it will be after 22nd or 23rd only. That means 22nd, 23rd I mentioned is for the rainfall activity. Around 22nd or so, some rainfall activity should start so that some relief will be there. But declaring the monsoon, vol flow, etc. reaches and its distribution, intensity also, those things also to be seen. So then I will say that after 22nd or so, thereafter they may declare. But a rainfall activity as such from 21st, 22nd onward over Mumbai region or surrounding region also, you will start getting.
Hoping to see some rains here in Mumbai as well, and hopefully that's sooner rather than later, because that's a bit of a niggling worry. It will cause inflationary pressure yet again. By the way, the markets saw an intraday dip, but that's got bought into as well, so that's pretty good news. I think another stock that's spiked up is Sterling Tools. Last few minutes, good amount of volume. Sterling Tools has moved to the high point of the day. Let's get in Amrish Balika. Hi Amrish, good to see you win. We're not going to let you go. We want you to give us that one stock that you believe is well placed, which probably would have corrected in this weak phase that we have seen for the last few months.
Exactly. That's Varun Beverages, second largest franchisee of PepsiCo globally outside US. The India footprint is across 26 states and 6 union territories. Around 90% of PepsiCo's India volume comes from Varun Beverages. I mean, they have franchisee operations in about 10 countries and distribution rights in 4 countries in the Indian subcontinent as well as the African region. That is via Bevco, which they acquired in 2024. And they've been on an acquisition spree The latest two are Cricklade Dairy and Visa in South Africa. And they also now have an exclusive distribution agreement with Carlsberg to market and distribute their alcoholic beverages. As far as India is concerned, Varun has about 40 lakh retail touchpoints in India, growing at about 10%, 12% per annum. Whereas the Indian universe is about 1.2 crore retail touchpoints. So there's enough headroom for expansion. And despite the fear of Campa eating into their market share, the volumes grew about 16% last quarter. They've been able to increase their gross margins also by 62 bips in Q1 because they follow their calendar year. So looking at about 25% CAGR for revenue over the next 2 years, and now monsoons also getting delayed will actually extend the season, which is a short-term positive. So expecting EPS of about 16 for calendar year 2027 with a target price of 680.
All right, take that point. Thanks a lot, Amrish, for that. Another of those summer plays which was impacted over the last 3 or 4 quarters because of one, competition and adverse weather, and now having its time in the sun, literally and figuratively. We'll just monitor a bunch of stocks which are doing well right now. We have, again, HDFC Life, which has moved to the high point of trade. When we started the show, it was up 4%, now extended its up move. Yes Bank, Nigel did point out that large trade, there was an initial spike. Thereafter, there was a decline from the lows, a decline from those highs, but now it's spiked once again, moved towards the higher end of today's trading range. Amrish, I wanted your thoughts in particular on a couple of these tire plays. Balakrishna for one, because crude is an important raw material for them. Nearly, between 20 to 30% of their raw material basket does come in from crude-related plays. Do you think with the decline that we've seen in crude, some of these names with export exposure can do better from here on?
Mangalam, in fact, I had a hypothesis that the US-Iran deal would happen possibly on President Trump's birthday, and somehow that's worked out well. And since that is happening, we would have the crude still coming down further, which should be beneficial for all these sectors which use crude or crude derivatives as a raw material. And clearly, tires is one of them. And because of which I had recommended CEAT last week. And I think from the levels I've recommended, it's already up, I think, about 10-12%. And still, I think there's a decently long way to go. So stocks like CEAT, Balakrishna, Apollo, JK, I think all these can be bought even at the current levels.
Got it. Okay, Amrish, thanks a lot for that. Well, stay with us. For the time being, we slip into a snappy break. Come back. We'll get a couple of calls from Amrish and we'll also wind down the markets. Stay tuned. Okay, all right. Welcome back. A few minutes to go before we wind down the markets. Let's get in Amrish back on the show. Amrish, Kalyan Jewellers, a stock that is less than half of what it was at its peak. Would you bet on it at around 380 rupees?
No, even at the current levels, I'll not really bet on it, looking at the sort of controversies which surround that stock. And at the same time, I do believe that gold prices should in fact correct further, which means there would be, there could be inventory losses. So from that point of view, surely at these levels, I'll not touch Kalyan.
Okay, you'll not touch Kalyan. You have, I think in the middle, you were quite positive on Vedanta Group, right? Now the demerger has played out. It has been a good move actually from the time I think you were initially talking about it. But bulk of the value in the price or more to follow?
There could be some more because in fact...
On which vertical?
Clearly, I think as far as the holding company goes, I think we could see a further move there. In fact, before the demerger, I was talking of at least about 25% sort of a increase in wealth for the shareholders post the demerger. I think we are clearly moving towards that.
Got it. I think that's taken place actually, that 25% move, because I think we were talking about it around 700 rupees. Today, effectively, what you're getting is around 900 rupees. So
920 or so, yes.
So that one basically has more or less played out. Any other name that you have been tracking? Gabriel India, that stock's up close to around 10%. Good move is what we're seeing out there. Electroclass, Cast as well, that's up close to around 10%. Any other new ideas? What about something like a Lotus? If you track any of these names, just throwing it.
In fact, Lotus is one which could be looked at. Especially the way it has cracked post the listing. Because that's one of the major, premium housing plays, and it's in a niche sort of an area, so it should not really get affected. Even if there's a slowdown in the real estate sector, I really don't see Lotus getting affected as such, because they have those premium clients, niche locations. So I think after this sort of a correction, this could be bought from a short to medium term perspective for a decent bounce back.
Got it. Okay, Amrish, thanks a lot for joining in. We'll let you go at that. Have a good remainder of Monday. And hopefully this week is better times for the Indian markets, because otherwise we've been a little short, in terms of global market performance as well. Thanks for joining in. Well, time to wind down the markets. We go home with gains of around 230 points. Though we have come off. At one point of time, we were up close to 350 points. So 100 points off the high point of the day. The Nifty Bank continued to do well. That was up close to 350 points, but it was up 600 points at the highs of the day. What did well? Some of the stocks that have actually got beaten down, they bounced back. Trent was up 5.5%. Life insurance company HDFC Life, that was up and about. NBFCs, finance companies, they did well. The bond yields have cooled off. Probably we may not see a rate hike as soon as we were expecting. So, a couple of other names like Shriram did pretty well. Bajaj Finserv as well was up and about in today's trading session. Crude oil prices corrected. So you had Interglobe Aviation that was up and about. Hopefully travel picks up, and also the ATF prices may not balloon up. So that stock did well. Crude oil prices corrected. So you had OMCs that did well. HPCL, BPCL, IOC, all of them did well in trade today. I think you had Asian Paints as well that had done well, in Friday's trading session. So today, it didn't participate on the upside. What didn't do well then? From the Nifty pack itself, there were a few stocks actually that were under pressure. NTPC was down 1.5%. Bajaj Auto as well did see some selling pressure. But from the broader markets, there were plenty of stocks that did a thing of its own. So let's get a few of them up in the screen. Sterling Tools, that stock was up and about in today's trading session. Equus, AEQUS, that stock was up more than 10%. Kalyan Jewellers was up close to around 10%. MSTC was up close to around 10%. Orient Pro, another stock that's fallen down big time, that as well was up close to around 10%. But there were some losers as well, Mangalam, in today's trading session. You had Oro Pharma, that was under pressure, down 5%. Godfrey Phillips, not smoking hot, that was down actually 3%. And NMDC as well was down close to around 3% in today's trading session, while you had Vedanta Limited that came in for some profit taking, down 3% or thereabouts.
Indeed, Nigel. Portfolios by and large looking very good today. Speaking about some of the losers, we also had Ola Electric, which was down about 3.5% when there was, this higher crude prices trade which was going on. The electric vehicles trade was also underway. So now with lower crude prices, do we see this trade come undone or not? Is something that we will monitor, but by and large it was a great trading session if you were a bull and hoping for some sort of relief coming in when it came to the tensions around peace, and peace is what has prevailed. With that, we'll wrap up on this edition of Closing Bell, but you don't go anywhere, because Markets Forward, our special edition on how to prepare for trade tomorrow, comes up right after this short break.
Markets end higher after the US and Iran confirmed a framework deal. The Nifty ends above 23,800. Mid-caps outperform while the rupee strengthened to a one-month high.
Financial stocks up anywhere between 5 to 7% among the top gainers as crude oil prices cool sharply and lending activity picks up. RBI data shows credit growth accelerated to near 18% in May, which is the fastest pace since the pandemic. With the strength in the rupee and weakness in the bond yields, it means it's good times for NBFCs.
Vedanta chairman Anil Agrawal says each of the group's 4 proposed listed businesses spanning aluminium, power, steel and oil and gas has the potential to become a $100 billion company. He also indicated that parent Vedanta Resources could explore a US listing at a $100 billion valuation. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to get up for the next trading day. I'm Sonal Bhutra and with me is my colleague Mangalam Malu. Mangalam, good afternoon. Well, the day is here. Finally, what Indian markets and global markets have been waiting for a long time. The question is it for real this time? The markets reacted positively but came off sharply from the highs. Not sharply, but yes, they did come off from the highs. Market participants, they've been quite cheerful, but the lack of AI trade is something which is worrying them.
Lack of AI trade is worrying them, but for now, the fact that we've been underperforming for so long and that the peace has prevailed and favorable macros have come by has led a lot of these stocks to move higher in today's trading session. And alongside that, maybe the ones who went long at lower levels could not be faulted for taking some profit off the table as well. The strength in the rupee doing extremely well and the broader markets as well. Let's tell you what we have lined up for you on the show today. We start with some of the key stocks that gain on the back of Iran-US deal with Sudarshan. We also unpack Vedanta's big ambitious plans for its 4 listed arms. And last but not the least, we delve into the key market events to watch out for in tomorrow's trading session. So with that, let's go across to Sudarshan first, who is joining in from the big wall, the top movers and shakers of the day. Sir.
So majority of the stocks reaction that you have seen today was linked to crude. That's the reason we have decided to take, instead of all the buzzers, the stocks that have reacted on the back of sharp downtick we have seen in crude prices. Crude is now back to, Brent is now back to the levels below 83, and that's the lowest levels that we have seen in last 3 months. One of the other commodities that has seen an increase was gold price. International gold price is back above $4,300 per ounce, and that's the highest levels that we have seen in last few weeks, and that's reflecting positively on some of the stock. So first, oil marketing companies, or say oil and gas companies. So fall in the crude price has a positive impact on OMCs. 3 names, IOC, BPCL and HPCL, while it's negative for upstream oil companies of ONGC and Oil India. That's the reason you can see IOC, BPCL and HPCL are up somewhere in the range of 2 to 3%, while ONGC and Oil India slipped in today's trade. Next comes to paint companies, aviation companies. These 2 sectors get impacted positively because for paint companies, up to 50% of their input costs are crude linked, and for aviation companies, ATF is one of the important costs, forming almost 40 to 50% of their total cost. That's the reason Indigo has extended Friday's gains. Asian Paints has seen profit booking after a sharp uptick that stock had seen in the last few trading sessions. All the other names were higher in trades. Grasim, Pidilite, even both the names were up 2%, and Indigo ended the session with a gain of more than 1%. Next is CV and CV Financial. Ashok Leyland in the last 2 trading sessions up more than 15%. Similar move was seen in Tata Motors commercial vehicle. Even both the CV Financials, Cholamandalam Investment and Shriram Finance. Shriram Finance was the top Nifty gainer, up almost 5%. Even Chola was up almost 5%. Why? Because diesel forms one of the major operating costs for these CV companies. Now, if there is a fall in crude prices, fleet utilization improved, and diesel forms major cost for all these truckers, and that's the reason fall in crude impacts positively to CV Financials. Next is all the other auto names were higher in today's trade too. Maruti was up almost 5%. Hero, Eicher, TVS, all these stocks were up somewhere in the range of 3 to 4%. Why? There was a concern related to margin for all these auto companies. But if there is a fall in the crude price and this fall sustains, then the margin concerns will go away. That's the reason we have seen a big uptick in all the names. Lastly, gold price increase and the impact on jewelry companies and gold financials. For jewelry company, it's a mixed impact. Kalyan Jewelers, you have seen a big up move because they have an exposure to West Asia. That's the reason we have seen a big uptick of more than 11%, while Muthoot Finance and Manappuram Finance, for them, loan ticket sizes improve, AUM growth expands. That's the reason both these names closed with a gain of almost 4%.
Okay, all right. Thank you so much, Sudarshan, for that. So those are some names which are impacted by the crude oil price fall that we've been seeing and the increase in gold prices as well. With that, let's move on. What does the Iran-US peace deal mean for Indian markets? We put that question to some of the street's top voices. Here's what Sunil Singhania, Prashant Jain, Nilesh Shah and Prashant Khemka are betting on. Let's listen in.
I would stick my neck out and say that for the calendar year 26 will be net positive as far as foreign flows are concerned. I think there is no reason for them not to look at India. One of the largest economy, one of the most diverse economy. If you look at some of the other markets, one stock is 30, 40, 50% of the index. In India, the largest stock is like 7% of the index. Very diversified, growing at 7% even in the midst of the conflict. And I think if they ignore India, then it would be at their own cost.
I think we are seeing greater value in large caps as a category clearly. Small mid caps, I think the fall has been very significant over the last 2 years from the peaks. I do feel that banks appear to be a little more undervalued than the rest of the markets. We are seeing innovation in the pharma space, in the NC space, gain traction in India for the first time. And there are at least 3 companies that I am aware of which have one, Wockhardt has already seen success. I mean, it's a historic moment for the country, for the company, of course. I think we are also seeing similar progress in few other companies.
One of the key negatives in recent months since the start of the war was the big surge in oil prices and India's dependence on oil imports, and as a result, the impact on current account and the fiscal and the currency. Yeah, so this particular worry does get ameliorated because of the now receding oil prices. Other significant worry that investors have had and have talked about at length with us is the relative non-participation of India in what is currently the flavor of the global investing sentiment, which is AI.
In our economic Kundli, Rahu Kal starts when oil prices go up. With the peacekeeping deal, it is likely that Hormuz opens up over next 30 days. Oil starts flowing, and undoubtedly oil futures and oil markets are discounting that. So one big macro overhang goes from India's balance sheet. FPIs were sellers because we had high oil vulnerability. To that extent, oil prices come down. It helps us across current account deficit, which supports rupee, reduces fiscal deficit pressure, which will help interest rate and inflation, and hopefully even FPI outflows. So net very positive for India.
All right, this is very positive for India. That's a view coming in from our market experts. To take this discussion forward, we do have with us our experts right now, Amrish Baliga and Jay Thakkar of ICICI Securities joining in. Amrish, we spoke about fundamental stock ideas and the beneficiaries just moments ago on closing bell, but welcome back to the show. Jay, I want to understand the chart pattern from you today. We saw a recovery, we did extremely well, but at higher levels, there is still some bit of profit booking. Are there any important levels that we need to cross before we see a further up move? Jay? All right, let's try and repatch that connection with Jay. But Amrish, you want to speak about some of the stocks that you liked in today's trading session after today's development in particular, and something that should be added to one's purchase list?
I think one of the sectors or the stock which can be added to the purchase list clearly is in aviation, and that the best stock is Indigo. Because one of the major worries was the way the crude prices had shot up. And now with this accord being done, we should see crude again back closer to about 70 or maybe below that. So from that point of view, I think Indigo should benefit. And I think even at the current levels could be bought for a decent upside. When I say a decent upside, I think it could be anything between 15 to 18% from here.
Okay, all right. Amrish, what about Bank Nifty? We'll discuss that in greater detail as well. What did you make of it earlier? We did see that rally as well. Anything that you like from that space? Is it the PSU side or private banking make more sense now?
See, right now, I think the private banks will make more sense. I mean, we have seen a huge amount of underperformance from most of the private banks if you see the last 18 to 24 months. And that's the time we had PSUs actually outperforming. So now I believe stocks like HDFC Bank, ICICI, Kotak, Axis, I think these are the ones, some of the, the larger private sector banks which can be bought. And among the smaller ones, I think one should look at IDFC first. Where I think we had seen a very decent correction post the issues which we saw in Punjab, Haryana, as far as this bank was concerned. So I think at the current levels, it makes sense buying, but one should have at least some amount of patience, maybe the next 9 to 12 months.
All right. And do you have any pick in the real estate space? That was doing a lot better in today's trading session. It was suppressed during the war because of sentiment issues. People thought maybe raw material prices would be lower, higher, and demand would be lower. So is there something that you like right now?
Yeah, in fact, we discussed on Lotus during the last show. The other stocks which one should be looking at would be Oberoi Realty, Godrej Properties, as well as among the slightly smaller ones, which is more in affordable as well as premium housing, is Aryan Superstructures, which is based in Navi Mumbai. So I think these are the ones which should be looked at.
Take that point, Amrish. We'll get to Jay in just a bit. But since I spoke about banks and Amrish said that private banking names make more sense, they are on a strong run. Even NBFCs, for that matter, this month, falling oil prices, easing yields and robust credit growth, which are improving the outlook for the financial sector. Here's why the street is turning bullish on these stocks. Lata breaks down why financial stocks are emerging as one of the biggest beneficiaries of the current macro setup. Lata?
There is another big data that came over the weekend on banks. The credit growth is a fiery 17.7% for the fortnight ended May 31. We have not seen this number post-COVID at all. We went to 16. We have not gone to 7. This is nearly 18%. It's a huge rally that we are, a huge surge that we are seeing in credit demand. And that is another factor why banks and NBFCs are rallying. The interest rate cost of funds factor is also there. So now for the banks, it's a double advantage. Both margin per loan they sell and the amount of loans they sell, both are increasing. So they're sitting pretty, you will have to say. The FCNR schemes are expected to lower their overall funding cost by about 3 to 4 basis points. So overall margins can go up by that much. As I told you, the certificates of deposits, that is when banks raise money from the wholesale market. The bank loans are called CDs, the bank debt, and corporate debt is called CPs. In both cases, we're seeing the yields come down. So for the banks, that's a cost of finance coming down. And they're going to get mark-to-market gains. Like I told you, the 10-year bond yield has come down all the way to 6.85. Its high was 7.17. So a 30 basis point fall is a mark-to-market gain on some of their instruments, which means Q1 itself, you might see improved banking performance, definitely in Q2, when more of the funding cost fall comes in. For NBFCs, obvious advantage because of lower yields in the market, they can borrow. As well, banks will be willing to forego a little and give them cheaper loans. So at the moment, actually, there are, a small tactical trade, which some traders were telling me, is to go from private banks to NBFCs. And of course, the bigger reason why you have to see positive about private banks is most of the FPIs have been treating the Indian banks as their funding sector. You want to buy an NVIDIA, sell HDFC Bank. That seemed to be the trade because it's a large liquid stock. And therefore, if the FPIs were to return because of the change in the algo trade in favor of India, you must see some kind of positivity on banking stocks. So overall, the chatter in the market appears to be pro-banks, pro NBFCs, both for margins and the quantum of loans.
Lata, thank you so much for explaining that to us. It's time to go across to our guests again. Jay, tell us more about the banking index. What do you make of the charts? Has been doing well. A lot of macro indicators suggesting there could be further positive move. Are the charts suggesting the same?
Good afternoon to you, Sonal and Mangalam. Yes, of course, banking index is looking definitely positive. In fact, it is the first one this time around. If you see, Sonal, that had given a breakout on the upside, and that was trading with quite a positive divergence. In fact, when the Nifty had made a fresh lows in the previous fall, we saw that Nifty was not doing that because Bank Nifty had earlier filled that gap, and we had seen that short covering happening in most of the private sector banks. In fact, the PSU banks this time around bounced back lately. The private sector banks was showing clear strength, and because of which Bank Nifty was not trading or breaking 53,000 levels. In fact, we had seen that good amount of put OI or put base that got built up 54,000 strike as well. And now I think going forward, 55,000 levels Sonal will act as a very, very critical support, which is although 3.5% approximately lower, but that's a positional level. I think that till 55,000 levels are held probably this week or next, this month, this series or next series, we'll be seeing Bank Nifty inching towards the levels of 60,000, 61,000 levels as well. So I'm looking out for those levels going forward. I mean, it will be testing around those previous highs of 60, 61,000 until 55,000 levels are held. And I think that selective private banks like Kotak Bank will do well, and PSU banks also from here on should bounce back a bit.
All right, with that, let's go across to the big corporate development that happened today, which was the relisting of the 4 demerged businesses of Vedanta, making it a milestone in the group's restructuring journey. Chairman Anil Agarwal said that each of the 4 businesses that listed today, spanning aluminum, power, steel and oil and gas as well, all of them have a potential to become a $100 billion company. Let's hear him out.
Intrinsic value of each company going to beyond $100 billion.
$100 billion every
each
entity.
Company started producing 3 million ton, going to be 6 million ton.
Okay.
And vision is to go for 10 million ton.
By when 6 million ton and by when 10 million ton?
6 million will be in 3.5 years time.
Okay.
And 5 years time, 1 million ton largest producer. And demand is so high, still there will be a gap.
Okay, all right. So 6 million tons in the next 3.5 years, that's going to be an interesting perspective.
And 5 million, 10 million ton in 5 years.
In 5 years.
It's not far.
So by 2032, 2031 odd, you will have close to a 10 million ton Vedanta aluminium facility itself. Got that, sir?
Okay, that's the word coming in from Vedanta. Ambrish, what do you make of it? The relisting of these 4 demerged businesses, anything you like, particularly out of the 4? Generally, what's your take on the metal space?
Metal space overall, I've been quite positive. And in fact, even before the demerger, I had suggested buying Vedanta because post-demerger, we were looking at least about 20-25% sort of a increase in wealth. And that seemed to have already happened. But even now, I would say that one could still look to buy the holding company, the listed holding company Vedanta, where I still see a decent upside because that's still quoting at a discount to its intrinsic value.
Okay. Jay, what do you make of the metal index? Jay, can you hear me?
Well, recently, if you see, Sonal, that we had seen some correction coming in the metal stocks. Although, the prior to that, there was a good rally and there was good long build-up. In fact, in the May series, if you see that it was power, metal, pharma in April and May, which were actually trading quite well. Lately, we saw, in the later half of the May to June that, metal stocks saw some, profit booking. But that was because of long unwinding. I would say, so there was not much of short build-up out there. Otherwise, I would say this sector has been overall seen a good long cycle on the derivatives front. So I would say that this dip, which was almost about 10% from the top, from the recent top, should be utilized as a buying opportunity. And if you ask me that which are the stocks within the metal pack, then I would say from the ferrous names, I will be looking out at JSW Steel and Tata Steel. I mean, these are the 2 stocks which I like. And from the non-ferrous, I'll be looking definitely at NMDC and probably Vedanta, yes. So this would be a couple of stocks which I think one can look out from the long build-up.
All right, take that point. Thanks a lot, gentlemen, for joining in and giving us your views on a whole host of stock sectors. Wish you happy remaining of the evening, and then we'll speak to you soon through the weeks as well. With that, we take a short break, come back, get you more on who are the top corporate voices who joined us on the channel today, and more importantly, the key market events that you need to track as we prepare for trade tomorrow. Welcome back. You're watching us here on Markets Forward. A good day of trade indeed. We had a bunch of corporate voices who joined us on the channel today as well. Let's start with Kim's Health. They're looking to strengthen their balance sheet after their latest fundraise. In fact, management joined us today and said that 75% of their QIP proceeds will go towards debt repayment, while the remaining 25% will be used for general corporate purposes. They expect their EBITDA losses from the new units to fall to about 50 crore rupees in FY27, indicating operational strength.
Prestige Estates is projecting 20% growth in residential bookings for FY27. Speaking to the channel, company's management said demand has remained strong despite fears of higher costs. 66,000 crore of the revenues of the unrecognized revenues have already been contracted from the project sold.
Then we had G&D Electronics as well. G&G saw a big move over the last 3 trading sessions. They say that the growth runway for the company remains strong, supported by favorable industry tailwinds. Though they managed to have a conservative outlook on the revenue growth of 25%, they are hopeful of margins to expand by about 100 basis points. They highlighted significant price increases in computers, which actually means that their business would do a lot better. Volume growth for this year been seen around 22%, with pricing growth of about 3%, leading to that conservative 25% revenue growth guidance.
And before we wrap, we'll bring you some key market events to watch out for. Our colleague Ria standing by the big ball with the key events to focus for tomorrow's trading session.
Well, yes, starting off with Asia first, China will be releasing its industrial production data along with fresh house price numbers. From Japan, all eyes will be on the Bank of Japan interest rate decision. And back home in India, we will be releasing the trade balance data as well. And meanwhile, in the US, the housing starts data will be closely tracked. And also from Washington, the Federal Open Market Committee will begin its 2-day monetary policy meeting.
All right, Ria, thanks a lot for that. So those are a bunch of events that we will be tracking, but more importantly, we'll be tracking Donald Trump's, Truth Social posts as well for any sort of confirmation of around whether this piece is for real or not. But for now, prices say they are for real. And that's how we end this edition of Markets Forward. Don't go anywhere. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Crude oil prices dropped below $80 after United States and Iran reach a deal to end the war. Key terms of the agreement remain unclear. Iranian state media claims $300 billion compensation fund for Tehran. Israel's security minister slams the deal, which reports say includes a Lebanon ceasefire, says Tel Aviv is not bound by it. Stock markets rally across the world. Sensex and Nifty gain 1%. Mid-caps outperform. Rupee gains 40 paisa against the dollar to hit a one-month high. India's wholesale price inflation accelerates more than 9% in May. Fuel prices rise 30%. This is the first set of data under a revamped series with FY23 as the base year. India's monthly exports hit a record high of more than $45 billion, defying tariffs and the war, but trade deficit also expands by 25% as the import bill remains high at over $73 billion. Finance Minister Nirmala Sitharaman says government is preparing for a not-so-good monsoon. Agriculture Ministry identifies nearly 200 vulnerable districts where the department pegs rainfall deficit in June at 28%. Vedanta's 4 demerged entities mark their stock market debut. Group Chairman Anil Agarwal says each demerged business can become a $100 billion company. That's an exclusive. CNBC TV 18 Newsbreak confirmed Razorpay confidentially files papers to go public. Sources say the fintech is likely to raise around $500 to $600 million at a valuation of more than $5 billion. Get ready for a $10 trillion company, says former Cisco chairman John Chambers, as SpaceX goes public with a valuation of nearly $2 trillion. Chambers also plays down fears of an AI bubble, even as he expects majority of the AI startups to fail. Noida Airport begins commercial operations. An Indigo flight from Lucknow touches down around 8 this morning. In a symbolic gesture, around 170 farmers who had voluntarily contributed their ancestral land for the project flew to Lucknow to meet Uttar Pradesh Chief Minister Yogi Adityanath. Prime Minister Modi in Slovakia for the second leg of his European tour. After meeting French President Macron in Nice, PM Modi pitched India as an innovation hub and called for technology that serves humanity, not just markets. Prime Minister Modi will return to France later this week to attend the G7 summit. Germany and Sweden opened their Football World Cup campaign with decisive wins. Japan holds Netherlands to a draw in nail-biting match. Spain faces debutant Cape Verde in its opening match, while Iran takes on New Zealand. All right, the top story this evening, crude oil prices dropped below the $80 a barrel mark as US and Iran reach a deal to end the war. Here are the latest updates. President Trump has said that the deal will be signed on Friday. Pakistan's Prime Minister Shehbaz Sharif has said that the agreement will be inked in Switzerland. Trump has said, and I quote, "I hereby fully authorize a toll-free opening of the Strait of Hormuz." He also added that the U.S. naval blockade on the waterway will be removed. The Wall Street Journal has reported that the agreement may pave the way for a 60-day period of negotiations over Tehran's nuclear program. Iran's Supreme National Security Council said the deal with the U.S. includes the immediate suspension of hostilities on all fronts, including Lebanon. Tehran claimed its threats of attacks on Israel had put pressure on the U.S. to reach a deal. The country also maintained that Trump's call for Israel to stop attacks inside Lebanon was key to its acceptance. However, Israel's ministers have slammed Lebanon's inclusion in the deal. They have asserted that Tel Aviv is not bound by the agreement and will not withdraw from territory it has seized in Lebanon. President Trump is on his way to the G7 meet in France. CNBC's Megan Casella has more.
We are just over the border here from Evian, France, where those G7 leaders are starting to meet and where President Trump will be later this morning. It was just around 3 a.m. Eastern that he boarded Air Force One, so he is on his way here now for those meetings that will continue through Wednesday. But before he left, he did confirm some of the details of that U.S.-Iran deal that is moving markets this morning, a framework deal, I should emphasize. He said on Truth Social that he authorizes with this deal the toll-free opening of the Strait of Hormuz, and simultaneously he's authorizing the immediate removal of the United States naval blockade. He wrote, "Ships of the world, start your engines, let the oil flow." And then in a subsequent post, Morgan, he crucially gave some details on the timing, saying with the opening of the strait upon the signing of the deal on Friday, for purposes of mine removal, oil will flow on both ends again. And for the region, and the world. So, Morgan, a couple of things to note on all of this. One, as he says in that second post, we are expecting tentatively, as of now, a signing ceremony possibly here in Geneva on Friday. But none of this will take effect until then. It is still a long way between now and Friday. There's also not been any text yet released of this framework agreement, so it's hard to know exactly what's in it. It is being described, though, as a memorandum of understanding that would reopen the strait while pushing the discussions on the thornier issues, on the nuclear program, for example, and in exchange, the lifting of sanctions and the unfreezing of some financial assets. All of that would be pushed until later, and there are already some disagreements between the two sides on how exactly all of that will work. So emphasizing again, nothing in effect just yet.
ईरान, अमेरिका ने लुबनान से समेत तमाम महाजों पर फौजी कार्रवाई के फौरी और मुस्तकिल खात्मे का ऐलान कर दिया है। जनाब स्पीकर, इस तारीखी मुआहदे की बाज़ाब्ता तकरीब इंशाअल्लाह जुमातुल मुबारक 19 जून को जनीवा में होगी और इस तकरीब की मेज़बानी अल्लाह के फजल करम से पाकिस्तान की होगी।
All right, on to the day's market action now. The markets ended higher after US and Iran confirmed a truce deal, closing in the green for a second straight session. Nifty ended above the 23,850 mark with 14 Nifty stocks surging over 2%. Mid-cap index also outperformed and Nifty IT snapped an 8-day losing streak. Mangala Malu joins us with the day's market action. Mangala.
Well, the peace deal is finally done, or that's what it seems like, and that's what's reflecting in the, notwithstanding the 100-point, 150-point decline that we saw from the highs, understandably, because of the rally that we've put behind already, the market still ended higher. The Nifty did well, the mid-caps did well, and the Nifty Bank as well, which has been leading the market forward, did well in today's trading session too. The macros are now turning favorable. Brent is now moved towards that $83 per barrel mark, reflected in the weakness that we saw in, the bond yields, which have cooled off, and also the strength that we've seen in the Indian rupee too. All of that coupled with risk coming off, which was again reflected in the volatility index, played well for the bulls. Your portfolios would feel a lot better in today's trading session, as the advanced decline ratio tells you that there were five stocks which advanced for every stock which was in the red. The top gainers, the top honors went to all these NBFCs, which because of the improving macros would perhaps get better access to lower cost funds and perhaps better credit growth as well. So Shriram Finance, Bajaj Finserv did well. Lower crude oil prices and better sentiment in general meant that Interglobe Aviation did well in today's trading session as well. What did not do well was understandably the upstream oil players. So we had the likes of ONGC and Oil India, which did not do well. Higher gold prices meant that some of these jewelers also gained. So we had Kalyan Jewelers, and then lower crude beneficiaries. Balkrishna Industries was up around 10%. HDFC, AMC, HDFC Life, and the other financial players as well did well too. The other stocks which were under pressure included the likes of Aurobindo Pharma. Remember, the pharmaceutical pack has been doing extremely well, so understandably some profit booking out there. Z and Indus Towers were the ones which were notably on the downside.
All right, thank you, Bangram, for that. Shifting focus now, the rally in the stock market rubbed off in the money market as well. The Indian rupee gained 40 paisa against the US dollar, hitting the highest level in a month. The currency is now below the 95 mark. 10-year bond yields also softened in trade, with bond prices clocking some healthy gains. India's monthly exports hit a record high of more than $45 billion, defying tariffs and the war. But the trade deficit also expanded by 25% as the import bill remains high at over $73 billion. Lata Venkatesh is here with the trade data. Lata, what do you make of this?
Well, outstanding export numbers, you will have to say. Considering the uncertainties in external trade, the goods exports in May coming at an all-time monthly high, month-wise high of $45.2 billion. Last month, it was $43.5 billion. So it was already good, even in April, but $2 billion more in May. And a year ago, it was $38.3 billion. Substantial jump, you will have to say, I think 18% or something. May goods imports were also high. It came in at $73.4 billion. I mean, it would be. After all, we have paid more for crude. So that didn't come as a shock. It's $73 billion compared to $60.86 billion a year ago. obviously higher crude prices. And even last month, it was 71.9 billion. So we've not risen much month on month in terms of import bill either. The import bill was obviously pushed up by crude and other industrial goods. But exports, a range of exports have done well. Petroleum products, we import crude and export petrol, diesel and other specialty products. That's done very well, obviously, because the prices have gone up. Engineering goods have done exceptionally well, as have electronics and specialty chemicals, indicating that when the major economies in the world do well, like the US, China, Japan, Korea, Taiwan, then Indian exports generally do well, a rising tide lifting all boats. The goods deficit, only if you take goods, it's 28 billion. Not alarming, we have done even 30 billion in the past. But if you add the services surplus, which is about 17.7 billion, the overall deficit for the month at about $10 billion is not alarming. It's on the higher side, but we have done that in the past as well. The important point to note among imports is gold imports has fallen. It's just about $1.9 billion. And this could be due to the government imposing that import tariff, but also because we already learned from the mutual fund guys that gold ETFs are actually seeing outflows, people booking profit. So it's another reason why gold imports have fallen.
All right. Thank you, Lata, for that update. Moving on, the Commerce Ministry has said a team from the Office of the U.S. Trade Representative is scheduled to visit India on 23rd and 24th of June for trade talks. Speaking at a press conference, Commerce Secretary Rajesh Agrawal said the discussions were expected to focus on giving final touches to the first tranche of the proposed trade deal between the two countries. Now, these statements come after American Ambassador to India, Sergio Gore, said that the trade deal is 99% done with 1% pending. India's wholesale inflation rose to nearly 10% in May, but the reading was below CNBC TV 18's poll. The rise was driven by a 30% surge in fuel and power inflation. The May print is the first to be released under the revised wholesale price index series with 2022-2023 as the base year. The government also released a producer price index for the first time and announced that it will replace the WPI in 5 years. The PPI will reflect input prices for companies at the factory gate and includes charges for services like insurance, banking and transportation. The Indian Met Department has said that monsoon between the 1st or 14th of June has been 28% below normal, with central India and northeast India receiving the least amount of rain. However, the Met Department has said monsoons could fully set in by the second half of June, with some areas receiving moderate to heavy rainfall. Finance Minister Nirmala Sitharaman has said that the government is preparing for all scenarios and has maintained adequate buffer stocks.
This year, because of the El Nino, I think we are preparing for not so good a monsoon. Of course, we have enough buffer stocks. Since last year we have maintained, so there shouldn't be a food shortage. But for farmers, it will have an impact because this year his income will be stressed out.
All right, on to a CNBC TV 18 exclusive. Vedanta's 4 demerged entities mark their stock market debut. Speaking to CNBC TV 18, Group Chairman Anil Agarwal says each demerged business can become a $100 billion company.
Intrinsic value of each company going to beyond $100 billion.
$100 billion every
each company started producing 3 million ton. Going to be 6 million ton.
Okay.
And vision is to go for 10 million ton.
By when 6 million ton and by when 10 million ton?
6 million will be in 3.5 years time.
Okay.
And 5 years time, 1 million ton largest producer. And demand is so high, still there will be a gap.
Okay, all right. So 6 million tons in the next 3.5 years, that's going to be an interesting perspective.
And 5 million, 10 million ton in 5 years.
In 5 years.
Not far.
So by 2032, 2031 odd, you will have close to a 10 million ton Vedanta aluminium facility itself. Got that, sir.
We told you first, and it's now official. Fintech major Razorpay has filed a confidential draft prospectus with SEBI, setting the stage for a potential initial public offering. Sources have told CNBC TV 18 that the issue size is likely to be around $500 to $600 million. Ritu Singh joins us now with more. Ritu, please take us through the company's listing plans.
That's right. Razorpay, one of India's largest fintech companies, has officially kicked off its IPO journey, just as we reported here on CNBC TV 18. Now, according to a public notice in the papers, the company has confidentially filed its draft red herring prospectus with SEBI. Now, while Razorpay did not offer any comment on our story, our sources do indicate that the IPO could be sized at around $500 to $600 million. The issue is also likely to comprise of a mix of fresh shares and an offer for sale, with the two components expected to be split roughly 50-50. Now, sources also indicate that Razorpay is targeting a market debut in 2026 itself. That is, of course, subject to regulatory approvals. The company could be valued at around $5 to $6 billion at listing, which compares with its last private market valuation of $7.5 billion as of 2021, when it last raised funds. Now, Axis Capital, Kotak, JP Morgan and Citi are among the bankers advising on the issue. Now, the filing also comes after Razorpay completed its reverse flip to India in May last year, shifting its domicile from the US back to India, which cleared a key hurdle for its domestic listing. Financially also, the company enters the market with strong growth momentum. For FY25, its consolidated revenues had jumped 65% to about 3,800 crore rupees, while gross profits had risen 41% to about 1,300 crore rupees. The company, however, did report a net loss of 1,209 crores for the year, largely because of a one-time ESOP expense and tax liabilities linked to the reverse flipping. Now, there's also an interesting competitive backdrop because Razorpay is moving ahead with its listing plans at a time when rival PhonePe has deferred its IPO plans because of the market volatility. So with PhonePe's public offering on the sidelines for now, Razorpay's IPO is shaping up to be one of India's most closely watched fintech listings for 2026, and it could offer investors another major play on India's rapidly growing digital payment ecosystem.
All right, thank you, Ritu, for that. We'll take a short break. Coming up next, Elon Musk becomes world's first trillionaire after a blockbuster SpaceX IPO. The stock lists at a 19% premium. That and much more on the other side. Welcome back. Elon Musk-backed SpaceX listed at a 19% premium to its IPO price on Friday. This skyrocketed his net worth to beyond $1 trillion, making him the first person to hit the milestone. Rashna Dhanrajani joins us now with more. Rashna.
Well, for more than 100 years, the world's biggest fortunes were measured in billions. As of June 12th, that ceiling broke. Elon Musk is the world's first trillionaire. It happened the day SpaceX began trading on the Nasdaq, the largest IPO in history. That deal plus Tesla holdings pushed Musk's net worth past $1.05 trillion. Forbes puts it closer to $1.2 trillion. So what exactly is a trillionaire? Well, a trillionaire is 1 followed by 12 zeros, 1,000 billion, a million. His fortune is nearly 4 times the next richest person, that's Larry Page. Every pro sports team on earth put together is now worth less than Musk. There was a first billionaire too. John D. Rockefeller crossed $1 billion in 1916 on Standard Oil. Rockefeller's fortune came from oil. Musk's came from technology, and he's not alone. Of the 10 richest people today, 8 built their fortunes in tech, and the newest surge among them is artificial intelligence. But that same AI wave is meeting a backlash. This spring, tech leaders were booed at university graduations the moment they raised AI and the jobs it could replace. When Sundar Pichai took the stage at Stanford on Sunday, the head of Google dodged the word AI entirely. And here's the catch. This is not cash that we're saying Musk's net worth in. Musk says less than 0.1% of his wealth is cash, which means none of it is real or tangible or touchable. Critics say fortunes like this are built on unrealized stock gains, which go largely untaxed until the shares are sold. Which leaves the real question. If artificial intelligence drives the next wave of wealth, does it concentrate at the very top, the way this trillion just did, or does it pay an AI dividend out to everyone? That is the $1 trillion question for now, so we'll keep an eye out for how it rolls out and pans out and who will be the next one. Back to you.
And that's a lot of money. Thank you, Rashna, for that. Moving on, the big newsmaker tonight, former Cisco CEO John Chambers is not too worried about AI and the current valuations. When asked about the nearly $2 trillion valuation for SpaceX, Chambers said a $10 trillion company may not be far away. He spoke exclusively with Shriram Finance and dismissed fears of an AI bubble, even as he expects most of the AI startups to fail. Take a look.
A $2 trillion market cap company at the end of day one for SpaceX. John, what do you make of it?
I think it is great. And I mean that way beyond just the transaction. The speed of innovation has never been faster. And with that innovation, the areas that cover not satellites, but strategic infrastructure for the future are where investments are going to occur. And if you watch how quickly companies become $1 trillion today, it's like the unicorns of old. And out of that group, you're going to see $10 trillion companies, in my opinion. The challenge will be that these companies with $1 trillion valuations have to move from being leading on technology to leading on execution, implementation, and the efficient use of capital, which is why you see them going public, and to be able to use that in terms of their approach. So on the one hand, this AI issue is not a bubble at all, Shireen. It is the future. It will get valuations that we were the most valuable company in the world, Cisco, at only $500 billion at a point in time, that are very large. However, the majority of AI startups will fail. And out of the magnificent, let's say, 10 today that are $1 trillion companies, a fair amount of those companies will not be in that mode at all 3 to 5 years from now. So the speed of change, the differentiation is there. Will the total portfolio of those top companies play out for good investors? Yes. Betting on one by itself is different. But I could not have been more excited about today. Elon Musk, he's clearly brilliant. First be on technology, then it will be about execution and implementation, then it will be about how well their competitors do. And no sooner are you going to get excited about 2 great companies, Anthropic and OpenAI, than they're going to be competed very aggressively with new startups, open models, et cetera, and it's going to put huge pressure on their margins and what will their core business be. I think that's extremely healthy. But the changes, when I talk about the AI, not bubble, but the AI generation that's going on, what you did with the internet in 1 year in 5 years. Now the AI companies do it in 1. That speed is perhaps the major difference, and then the ability to really tie it to outcomes and results. So I'm a portfolio player. I wish I could tell you all 26 of my companies are going to be successful. I know today, unfortunately, 2 aren't going to make it on it. And very often the ones that I think could be successful end up missing. But you are seeing speed of change like I've never seen before. It used to be, how many of you are in startups in the room? How many in venture capital? How many angel investors? So it used to be when we'd look at this, if you picked a company, you would have a period of time that you could ride out the differentiation on it. Right now, I think you really have to do a portfolio play. With the internet, the rising tide raised all boats. And while Cisco broke away as the tide was rising, our top 100 competitors also did well for almost 10 years. Now, if you believe 5-to-1 ratios in speed, it says 2 years. People can cycle in or cycle out. And what was the best of the capabilities just 2.5 years ago? OpenAI. Yeah, and basically what ChatGPT did. Then Google was in trouble.
Yep.
What, 2 years later?
Yep.
Gemini was the lead.
Yep.
A year later, Claude. And I used all 3 today, and it depends on which vertical you're in. So I think you are going to see tremendous valuations and returns, but I believe it's now about strategy, execution, efficient use of capital, and you're going to see some train wreck.
And you can catch the entire interview with John Chambers at 6:30 p.m. in a freewheeling conversation. Chambers opens up on the SpaceX listing and what it means for AI companies and Wall Street at large. He also has some advice for budding entrepreneurs. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Hello and welcome. You're watching a special edition of Market Masters. The US and Iran have reached a deal to end their 3.5-month-long war. US President Donald Trump said on social media that he's ordered the reopening of the Strait of Hormuz by authorizing for the end of the US naval blockade of the strait. Global equities, including India, cheered the peace deal, which is to be signed in Geneva, as of now at least, later this week on Friday. Oil prices, of course, over last Friday and today are down about 7 to 8%. These are big numbers. We actually had a slew of top opinion from market experts in terms of what this would mean for India. Remember, Indian equities, especially large caps, have done poorly as compared to some of our North Asian markets and, of course, the big US market as well. Will this deal and the macro sentiment positive that this implies for India turn the sentiment around for equities here? That's the question. Well, we started by talking to 3P investment managers, Prashant Jain. I began by asking him about how constructive he is now as far as the market goes, the economy goes. Listen in.
We have been constructive for a while. In fact, we even wrote a note on 22nd May that this will also pass. This is a great investing opportunity. And clearly now things will improve, I think, for India. I mean, oil will improve, and I think even the FPI selling will taper down sharply. RBI has taken very constructive steps, and markets are, I would say, undervalued. So I would be quite constructive, both on the markets and, of course, on the economy. There are reasons to be constructive as well.
Yeah. You think the FPI selling will taper down? Because, and that's an important one, right? Already 45,000 crores in June. So you think this will help take some of that pressure off?
I feel, and I've been saying this for a while, that it makes sense to look at FPI selling along with primary market capital raising. And secondary market flows in India are quite steady, quite significant. So as long as primary market activity is down, I don't think it will impact markets too much, because the selling can easily get absorbed. But I do feel that with one of the negatives on India out of the way on the currency and on the oil, I think the pace of FPI selling should reduce sharply. I mean, the move into AI, it still remains. I think over time, even that should unwind, yes.
The flows into equity mutual funds for the first time in the month of May, the data that we have, saw a sharp dip, right? And that at the margin, at least I was thinking, if this pace of FPI selling, so far it was matched dollar by dollar, right? By a local buying. But if the numbers are so large remain so large on the other side, and here it becomes, the numbers don't add up, then something's got to give. Hopefully, we will not come to that, Prashant, right?
I think, that was also a sign of, some concern in the domestic investors. The SIPs held, but the non-SIP flows fell off very sharply. And because clearly people were concerned about the war, and this is not unusual. It always happens in crisis periods because fear becomes the dominant emotion at times like these. And that is why equities are a very simple asset class, but it's not easy to invest in sharply down markets. But I think even domestic flows should now come back pretty strongly, yes.
Okay.
The non-SIP flows, I meant.
Okay, fair enough. So sorry that, I just want to go back to that one point you made about primary, look at a foreign selling with in conjunction with primary issuances, you meant, right? You meant the IPO market, etc.?
The IPO markets or the sell downs by PE or the MNCs, all of that put together. Because both are sources of supply. One is the FPI selling and one is the primary capital raise or the blocks, OFSs by whosoever.
How are you positioned? Because with the benefit of hindsight, Prashant, what is done well is the non-FII parts of the market, right? Which basically, we've got a bull market going, no other way to put it, in many of those areas. So how are you positioned and how would you look at it?
I think we are seeing greater value in large caps as a category, clearly. Small mid caps, I think the fall has been very significant over the last 2 years from the peaks. And therefore, there is isolated value emerging It is a stock. I mean, you'll have to be very selective about what you buy in that space, but there is some value in 1 in 10, 1 in 20 stocks. As far as large caps are concerned, I feel that probably all the sectors are either undervalued. I mean, the extent would vary, but I do feel that banks appear to be a little more undervalued than the rest of the markets.
Right. Banks are a little more undervalued than all the other themes. And in banks, is there a particular preference that you have for a kind of banks? Because you've earlier liked PSUs as a theme, but now is it private banks that you like or public sector banks, or you're agnostic?
So I think the divide has vanished. Actually, the divide was between corporate and retail banks. And since all public banks are very old banks, bulk of their books was in corporate loans. And that's why market started looking at private versus public. I have actually looked at, I mean, in the earlier phase, corporate versus retail banks. Now I think it's mainly a case of large versus mid or small sized banks. So while with a long-term point of view, my preference continues to be the large banks for very simple reasons. But if liquidity improves, which it is likely to, as even if CNRB deposits come in, liquidity in the local economy should improve. I think it would be favorable even for the small and mid-sized banks.
So banks clearly, I mean, you think there's value across the board in large caps, but banks clearly are the one pocket where there is more value than others. And mid and small caps, just to paraphrase you, I want to get that right. You said that they may be value, but it's kind of rare now, 1 out of 10 kind of situations. That's what you said, Prashant?
Yes, see the fall in small mid caps. If you look at the fall from peaks in the non-NSE 100 stocks, if you look at the next 400 stocks, for example, in NSE 500, the fall has been very sharp. Almost 2 out of 3 stocks are down 30% or more than 30% of their peak levels. So what I am saying is that while small mid caps as a category, to my mind, are still less attractive than large caps, but given the very large number of companies in that space and the sharp falls that we have seen, there is value emerging in 1 out of 10, 1 out of 20 companies, in my opinion. Of course, when you talk about stock picking, everyone will have a different opinion, yes.
I see. Because the way I read what you said is because I mean, mid and small cap indices are pretty much back at new highs, right? So I thought what you were saying is after the run-up, because of the run-up, I mean, there is only value now left in, I mean, it's kind of fully valued in many cases. I thought that's what you meant.
See, the small mid-cap indices are not always representative of the entire small mid-cap space because the number of companies is so large.
Sure.
And these indices would also move based on a smaller subset of these the indices. So I think the large caps have borne bulk of the selling pressure from foreigners. And that's why they have underperformed more. So whichever way you look at it, I think the large caps, in my opinion, appear to be relatively better valued than small and mid caps.
Right. Is there any new investment that you've made in the very recent past, or is it more of the same?
No, I don't think there is. I mean, we are a medium to long-term investor, so I don't think there is much churn in the portfolios. We disclose our portfolios once a quarter. We continue to remain fully invested. We continue to have a predominantly large cap portfolio. But as I said earlier, there are few opportunities emerging in the small mid cap space also on a very bottom-up basis.
Time for a quick commercial break here. We will bring you views from Abacus Asset Managers' Sunil Singhania on the other side. Stay tuned. Welcome back. You're watching Market Masters. Sunil Singhania of Abacus has always maintained his stance that the peace deal was only a matter of time. I started by asking him earlier today about how this deal will ease the negative macro sentiment around India and, of course, his views on various sectoral bets as well. Listen in.
No wars last forever, and obviously this war, I think both the parties also did not know what they were fighting for, so it was a matter of time. For India, it was very important because unlike some of the other conflicts, I think this was one which was impacting India a lot. It was closer home, big, I would say, region for India's exports. Obviously, oil got impacted, currency got impacted. So I think it's a good relief that this has finally happened. But Prashant, actually, if you see the last 15-20 days, I think the markets had already started taking cognizance of the fact oil was not moving up despite all the negative news flow, and now obviously oil has come decisively down. We continue to believe that oil will be more like 70, 80, and I think we're almost there. We were 15 days early. Our view was that by 31st May it would be there, but it's 15 June, it's fine. I think from an India perspective, things are falling in place. The global AI trade obviously looks like peaking out. I don't know whether there will be a sharp correction there or not. But investors are looking at alternatives. The underweight India is now at the highest level ever. Technical positions point to shorts. Earnings have been good. Government has acted, whether it is a FCNR, deposit thing or some of the other smaller, I would say reforms they've introduced. So all in all, I think looks to be now back to normal. Hopefully, currency will also appreciate to maybe 94.
You spoke about the currency.
Right. Sunil, just one point. Would you say, if you look back, right, foreigners have been big sellers. This month itself, they have sold some 45,000 crores in equity. You think that, because that is a problem area, otherwise, the non-FI names of all, there's a bull market going on there. And you're well aware of that. You've participated in many of those themes. But will this foreign selling, which is a capital problem, you think this can change that sentiment around?
And I would stick my neck out and say that for the calendar year 26 will be net positive as far as foreign flows are concerned. I think there is no reason for them not to look at India. One of the largest economy, one of the most diverse economy. If you look at some of the other markets, one stock is 30, 40, 50% of the index. In India, the largest stock is like 7% of the index. Very diversified, growing at 7% even in the midst of the conflict. And I think if they ignore India, then it would be at their own cost. So I don't think that this selling is going to continue forever. And I would stick my neck out and say calendar year 26, we will end the year with a net FII inflow.
Well, that will be quite a call. We'll keep this for the keeps as we speak at the end of this year and, hope for the FII to return. You spoke about the currency and as, luck would have it. In fact, we opened at the highest level for the rupee since May 8, 2026. So it's been a near to 3-month high that we're seeing on the rupee, 94.71. Just last week, we were at 95.71. So there has been a near 1 rupee appreciation on the rupee from, as against the dollar. But Sunil, on the mid and small cap themes, is there anything that you believe was lacking conviction on the upside because of this war? And now that this war is perhaps for the near term, a peace deal is signed, people would rush to that trade. Is there something that stands out?
No, very surprisingly, normally when there are external headwinds, the mid and small cap tend to underperform the large cap. But this time we have seen the reverse. In fact, year to date, the mid and small caps have outperformed the Nifty despite the conflict going on. So I think it's a reflection also of the significant earnings, I would say, outperformance of the mid and small cap vis-a-vis the large cap. Mid and small cap have to be stock specific. So I would again, reiterate that we don't have to track the indices per se, but more stock specific. But I would continue to believe that there are so many stocks which are smaller and which are doing, significantly well despite all the headwinds. Also, a lot of sectors, if you see, like renewables or even, engineering or niche engineering, I think those companies are largely in the small and mid-cap space, and which is where the growth has been, manufacturing or engineering and all. So I think, obviously, immediately you will have a big bump up in the banking side because of the huge uptick which the markets would see. But I would say that mid and small caps, generally, if you are a little bit focused more on stock picking, should do well in the next year or so.
Sunil, just so areas to so you're saying banking, just by the nature of the ownership, etc., should start to do well if some of what you're saying plays out, right? That foreigners start to buy. I mean, that's where they own most, that's where they sold most. So that should do well.
So I think this is a sector which was the favorite punching bag. Foreign investors, whenever they wanted to sell India, for them 40% weightage was in banking, so they would just come and dump it. And I would say that some of the private banks, the largest private bank now trades at 11 times PE if you strip out their subsidiaries. And obviously, if big money has to come in back, and that is what our view is, that foreign investors will become net buyers in India. I think you'll start to see correction in this valuation, which is the lowest which we have seen for the last 10, 15 years in some of these companies. So the immediate uptick would be in banks, NBFCs, obviously high beta trades like capex, infra. But banking will stand out because it can absorb huge amounts of capital pretty quickly.
What about, one is this broad sentiment turning around macro relief. What about earnings, underlying earnings? They've been, just your assessment, Sunil, as we look ahead?
So Nifty earnings were, I would say, muted March quarter. But if you see the broader market earnings were like 15 to 20%. In fact, I was reading a report by a leading brokerage, which says that the corporate profit to GDP ratio is one of the highest in the last 10 years. So corporate profit has held up pretty well despite all the headwinds. Even when we look at the current year, obviously, April, May, some of the companies, some of the sectors would have had some pain because of higher fuel cost or logistics issue and so on and so forth. But we have 10 months now. We are very confident that companies and sectors would recover whatever they would have lost a little bit in the first 2 months. So we continue to believe that 26 and 27 finally will have earnings which will trend up.
Would you have a view on the metal space and the other commodity space? Today we have Vedanta's demerged entities listing as well. How would you play that and the other commodities which may now begin to come off given this piece?
So metals, we have been quite positive, and I think it's worked out well. We are among the very few houses who doesn't mind investing in commodities as long as the ROC, ROEs are above 14, 15%. And I think it's played out well. We do have, risk matrices in place. We don't go beyond 9-10% as far as commodity stocks are concerned. I think even now, I don't know how the commodities globally will play out. But our view would be that commodities generally should be pretty stable and firm. There will be a lot of reconstruction which will happen. I think the trade towards electrification is going to continue. Companies have got the shock of their life when the Iran thing happened. And including India, I think most countries would want to move from fossil fuel-based energy to electrical energy, and their metals would definitely be needed. So we continue to be quite optimistic. And the good thing about Indian metal companies is that they are fully integrated. So they are the lowest cost producer and the last man standing. So we would be optimistic on this sector.
Hello and welcome. You're watching News Center. I am Ashmit Kumar. Now, after months of negotiations and uncertainty, the United States and Iran have reached deal to end the war in West Asia. In a social media post, U.S. President Donald Trump said that he authorized the toll-free opening of the Strait of Hormuz and the removal of the U.S. naval blockade of Iran's ports. In a separate post, he wrote, and I quote, "The leaders of the region have for the first time found a president who can help them achieve real peace with the opening of the strait upon the signing of the deal on Friday. For purposes of mine removal, oil will flow on both ends again for the region and the world." End of quote. Shehbaz Sharif, the Prime Minister of Pakistan, which acted as a mediator alongside Qatar, has said that both sides have declared the immediate and permanent termination of military operations on all fronts, including Lebanon. He added that mediators will facilitate a series of meetings this week, which will lay the foundation for technical talks and the official signing ceremony. Iranian leadership also confirmed the deal. The Deputy Foreign Minister, Kazem Garibabadi, told the media that Qatari mediators held 14 to 15 hours of talks in Tehran on Sunday to finalize the text of the Islamabad Memorandum of Understanding. He said that talks on a final deal will happen over a 60-day period after verifying that the U.S. implemented its commitments under this deal, including releasing of frozen assets. The key terms of the agreement remain unclear. However, Iranian state media claimed that uranium and Iran's nuclear facilities will remain in Iran and that a compensation fund of $300 billion will be established for Tehran. Meanwhile, crude oil prices dropped below the $80 a barrel mark after the Iran-US agreement was announced. However, there are already signs of friction. Israel's National Security Minister, Ben-Gvir, has slammed this deal, saying that Israel is not party to this agreement and that it does not safeguard Israeli security. Defense Minister Israel Katz also asserted that Israel will not withdraw from territory it seized in Lebanon. Israel had launched an attack on Beirut on Sunday, despite the ongoing negotiations. Meanwhile, world leaders welcomed the Iran-US truce. European nations stressed that Iran must never acquire a nuclear weapon. The deal is set to be signed in Switzerland on Friday.
ईरान, अमेरिका ने लुबनान से समेत तमाम महाजों पर फौजी कार्रवाई के फौरी और मुस्तकिल खात्मे का ऐलान कर दिया है। जनाब स्पीकर, इस तारीखी मुआहदे की बाज़ाब्ता तकरीब इंशाअल्लाह जुमातुल मुबारक 19 जून को जनीवा में होगी और इस तकरीब की मेज़बानी अल्लाह के फजल करम से पाकिस्तान की होगी।
I congratulate President Trump, the mediators from Pakistan and Qatar, and all those involved. This is a hugely significant moment. We have long called for de-escalation, and it is vital that all parties seize this opportunity to secure stability in the region and restore freedom of navigation in the Strait of Hormuz, which in turn will ease the economic pressures felt by people here in the United Kingdom and around the world. We will now work closely with our partners to support this agreement and to ensure it turns into a durable, lasting peace.
Well, joining us now to discuss this is with us Professor Adam Dixon, Adam Smith Chair at the Panmure House and Professor at the Edinburgh Business School. Also with us is Hassan Hashmi Pirzada, geopolitical expert. And joining us in a bit will be Dr. Wael Awad, senior journalist. He'll be joining us shortly. Let's begin this conversation. Professor Dixon, let me come to you first. We've seen a number of occasions where a deal has been alluded to. Now we have a rare situation, rare consensus where both sides appear to be on the same page. That's Iran and the US. The question is, will it hold till Friday when the signing is due?
Well, I hope it does, right? I mean, I think everyone would like peace in the region, around the world. We'd like the economic conditions to improve globally. Will it hold? as you mentioned, we've seen this before, right? Where when we think we have a deal, it turns out that, we weren't sure, at least the U.S. wasn't sure who it was negotiating with. But it seems that this case is where there's much more agreement behind it, or at least it feels real. Like, and if we can go by feeling, I think it looks like it will hold. Now, what's going to happen in the interim, though, from today until Friday, is the media, from the Iranian state media to the media here in the West, in the UK and in America, is going to be spending most of their time talking about, well, who won this conflict? And you're going to have that's going to sort of sully the waters, if you like, because the Iranians will claim they won, some will claim that the U.S. lost. And it will just create conditions where everyone is just waiting to see what happens, when actually we don't really know until the details come out. And I think that's the difficulty here, is that we just don't know what the details are to say, will this hold? But from what we're hearing, it seems that we're at that position where peace will hold. And I think it's partly because the economic blockade of Iran, let's just say that's what's happened. We've not had a kinetic war for weeks now. The economic blockade of Iran, I think, is starting to push the Iranians, despite the propaganda about them winning, it's pushing them into a deal. And I think that's what we're seeing, is that the Iranians, that's why they're talking about the 24 billion plus this 300 billion compensation fund, because their economy is hurting and they have a big population they need to manage. And I think that's what's pushing them to the negotiating table to come to an end to this war. And finally, we have to remember that Donald Trump just celebrated his 80th birthday. The U.S. In July, in less than a few weeks' time, will be celebrating the 250th anniversary of the Declaration of Independence. And so I think for Trump, as we know, he's been looking for a way out. But I think now it's with his birthday, with the 250 coming up, it's time to call this a day.
But Professor, let me just revisit that question again. The reason I asked that is because Ben-Gvir has said it in as many words that this deal, we're not partners to this agreement. It does not ensure our security. It does not bind us in any way. That was Ben-Gvir. Meanwhile, we've heard Israel Katz very clearly say that Israeli forces will not be withdrawing from Lebanon. Now, when the Pakistani leader, Shehbaz Sharif, when he announced this deal, he very clearly said that it will ensure the termination of all military operations in Lebanon. That's clearly not happening. Israel is saying it on the face of things. Again, I ask this question in light of this dynamic between Washington and Prime Minister Benjamin Netanyahu. Will this truce survive?
So I think you understand this being in a liberal democracy in India, right? That there's multiple opinions. And we have to remember that Israel is also a liberal democracy that has various opinions, even within the Israeli cabinet. So Ben-Gvir, who is quite radical, of course, he's going to say this deal does not include Israel. But does he actually speak for the Israeli government? And of course, I think what will likely happen, in my view, is that that conditions for a kinetic battle between Hezbollah and Israeli forces may settle down, but that doesn't mean Israel will leave southern Lebanon. I think that's what will happen, is that there'll be a cease of activity. And what it comes down to then is Hezbollah and Israel not as Trump has kind of criticized, is launching missiles on each other. But I think, Israel is not calling the shots here. It's despite what media says around, and Benjamin Netanyahu having some kind of control over Donald Trump. That's not the case. And so I think Israel doesn't have leverage in this particular with this particular deal. But again, I think if we look at the broader piece, if it is the case that Hezbollah will cease launching missiles into northern Israel, then that gives Israel cover to stop some of the escalation that we've seen in Lebanon, and then perhaps the Lebanon issue can resolve itself separately from this conflict with Iran and the United States.
Sure. Mr. Pirzada, let's bring you in on this conversation again. Pakistan playing a role as far as mediations are concerned. Not a lot of details are available publicly as to what constitutes this deal. We have One news report by the Mehr news agency, which again is an Iranian news agency, it's listed out 14 points. Amongst them, issues like a $300 billion fund, the frozen assets to be returned back to Iran. There's also talk now, another Iranian news agency saying that some kind of service fee will perhaps be levied as far as Hormuz is concerned. Any indication? You have your ears close to the ground. Any indication on what constitutes this truce?
Thanks a lot for having me, Ashmit. I think so. The truce, which is broken by Pakistan with the pivotal mediation, it represents a very fragile but a very historic step towards the de-escalation. While we are still awaiting, the official text is still undisclosed. As you rightly pointed out, Mehr News Agency and just the sources pointing out that there are elements of some sort of a fee, a service fee instead of a toll fee, which will be getting done by the Iranians for the state of Hormuz in cooperation with the Omanians. And there's also talks of a 300 billion reconstruction fund as well. But we don't have any confirmation yet. There are, different news coming out from Islamabad as well. It's very hush-hush. There is, as with the whole negotiation cycle for the last few months as well, when it has remained in a very tight circle in Islamabad as well, and nothing has been leaked towards Pakistani journalists. Usually in Pakistan, when such kind of high intensity activity happening, there are some leaks, few leaks get, done to the journalist, and journalists are able to create the picture of it. But in this circumstance, there is no news coming out. Whether the framework, this obviously the truce is called for an immediate ceasefire on all fronts, including Lebanon and the reopening of the Strait of Hormuz commercial shipping. What I have heard is that the US will lift its naval blockade on all the Iranian ports, and Iran will receive the partial access to the frozen assets to support its reconstruction. And the fee also, I forgot about it. The fee also been inserted apparently at the very last minute. It has been Iranian insertion into that agreement, and that's what we heard from Iran as well, and from some sources in Pakistan as well. But the ceasefire is extremely fragile, as you rightly pointed out in your intro as well, in your question with the professor. Israel is spectacle on that, and they have continued with their limited operation against Hezbollah. Iran has very clearly pointed out that they won't end on all fronts as well. And I'm hoping that as soon as June 19 come and this agreement is signed, US will be able to enforce that on Israel as well, and we can come out of this 108 days of war between US, Israel, and Iran.
Correct, Mr. Pirzada. It's been over 100 days as far as this conflict is concerned. June 19th, I beg your pardon, if this truce holds, the signing will, of course, be due in Geneva. Professor Dixon, let me come back to you. The elephant in the room here, the nuclear question. We've arrived at some kind of interim framework. If we go by the Iranian media, they seem to suggest that there's been absolutely no issue, no mention of the uranium, the enriched uranium, enriched up to 60%. There's been no mention of that in this deal. Again, how easy or difficult will it be for Donald Trump to sell this deal back home in Washington, not having addressed the big nuclear question?
Well, see, what I'm hearing is, though, that why we're getting to an agreement is that Iran has moved on the nuclear issue. That if it's going to be successful, and that's what Donald Trump has really emphasized. If we go back when the war started, yes, there was some discussion around regime change, and because of the decapitation of Khomeini, you could assume that was part of the at least desire, but it wasn't the only part. But it was ultimately about, does Iran have the capability to get a nuclear weapon? And that has been Trump's, the one point that has been emphasized by the Trump administration over and over again, is that no deal is possible until there's movement on Iran's commitment to not have a nuclear weapon, which for the region is quite important. And I think, again, going back to your question earlier about, is this fragile? if Iran is not going to agree to not produce or at least enrich uranium and remove its existing stockpile, then that's where this will fall down. And I think that's ultimately what's going to happen, and how that gets out. I think that is that's the red line for Trump, and I think he will continue to stick to that, because if it doesn't become better than the JCPO, then the politics for Trump will look bad in the U.S. What he wants to do is best the Obama administration and say that, you had this poor deal. I went in, had to use military force, but at the end we got Iran to commit to 100% no nuclear weapons. And I think that's what he's trying to achieve.
Well, that's what many experts are saying, that the details will lie somewhere between these tough positions taken by either of two sides. Iran has said previously they don't want a nuclear weapon, but again, insisting on control of the enriched uranium, ensuring, rather seeking for that uranium to continue to be with Tehran. On that note, Professor Dixon, Mr. Pirzada, let's head into a very short break. We'll come back and we'll continue this conversation on the West Asia truce on the other side. Welcome back to News Center. I have with me Professor Adam Dixon as well as Mr. Hassan Hashmi Pirzada. Mr. Pirzada, coming to you. Pakistan again playing a key role as far as these negotiations are concerned. But there's also the involvement of Qatar as far as the final few days of these negotiations are concerned. The signing, of course, will be in Geneva. Is there a sentiment that perhaps the work that was done, was put in by Pakistan, perhaps could have been recognized with an Islamabad signing? Or are the leaders still happy, still content with the signing being hosted in Geneva?
I think so. Pakistani has played a very indispensable and central role as the primary diplomatic bridge between Washington and Tehran. And we have facilitated these back channel delivering the key proposals and maintaining the communication, under these intense pressure time. Pakistan brokered the first, the ceasefire as well. And now, Pakistani Prime Minister was the one who announced this a memorandum of understanding on a tweet. So I think so. Pakistan standing as a interlocutor and as a master mediator has been, around the world, has been widely praised internationally by all the world leaders as well. Pakistan is okay being at Geneva or anywhere as well. Main concern was for this war to be finished. At the end of the day, whether it's going to be signed in Geneva or it is going to sign in Vienna, the memorandum will be called Islamabad Declaration, and the history will remember that Pakistan has played a very key role, the main role in bringing these two countries together on the table and getting a memorandum of understanding signed. And I think so. What I have heard, Pakistani leadership has expressed their satisfaction with their role as the behind the scene facilitator and mediator. And it carries more strategic weight than hosting a public signing event as well. We have done the Islamabad talks before as well. Second time it was ready as well. So Pakistanis are more than happy for it to be signed in Geneva. Pakistan's role has been appraised by all the world leaders around the world.
Right. Mr. Pirzada, again, we're looking at this tentative truce between the two sides until that signing takes place in Geneva. Professor Dixon, let me come to you on the question of toll. Now, the post that had been put out by Donald Trump very clearly said there'll be a toll-free Hormuz. Now, that is what is being celebrated by the oil markets, by the commodity markets as well. Brent crude down below 80. The question I want to ask is that so? Because the language that appears to be coming from Tehran is that, fine, let's not call it a toll, let's call it some kind of service or administrative levy, but that there will be some kind of levy, some fee as far as the oil tankers are concerned. Is that something that the US will have to make peace with?
I wonder how the Iranians over time, will enforce it. Because let's think about, you can imagine in the current situation, it's easily enforced because it's a hot conflict. But how would they enforce this in 1 year, 2 years, 3 years? Are they always going to pick up the radio and tell the ship's captain, you've not paid your fee, and if you don't pay your fee, I'm going to shoot you, right? I mean, is that where else in the world is that going to be allowed? And I just don't see how in a legal agreement will be allowed and that the Omanis will actually play into this. It just doesn't seem to me to be a really viable strategy on the part of the Iranians to expect some kind of toll, or they've said an environmental levy. I mean, call it what it is. It's a tax. It's some kind of fee. It's a transaction cost. Whatever you name it, the semantic differences don't matter. But what it comes down to is it enforceable? And I'm skeptical that it's over time enforceable. I think there's some that will pay readily now, but will they pay in 6 months' time? Will the insurance companies, how would this be figured into the price? And so I think it's not a tenable, given the context of that geography, where it's something that they would be able to enforce, because it requires too many other players ultimately to be part of this. And I think if I may, you've got that $300 billion compensation fund they're calling, and we should also look at that in the context of some of these other deals that Trump has tried to make around the world. Let's look at the rebuilding of Gaza. I think that, if I can speculate, that $300 billion is not let's pay the Iranian regime. I think what it'll be is, as Trump has done in many different parts of the world, is to come up with a reconstruction fund where he gets private capital, at least governments coming in to go and invest in Iran, right? Because ultimately Trump is a deal maker. He's a property developer, right? And so he wants to see a flourishing Iran that's peaceful and not fighting Israel and not causing problems in the region. And in that context, if Iran is going to be kind of welcomed back into the international fold, to then charge some kind of a tax that is ultimately a transaction cost on the global economy, on its Arab neighbors, I don't think that's viable.
Let me then ask you another question. We've addressed questions of how there will be, of course, 60 days now. Conversations will begin as far as the nuclear question is concerned. Whether or not a toll is to be levied, we're yet to see that in the language of the truce itself. It's not been made public yet. And of course, the question of that $300 billion fund. Someone like Donald Trump, who is extremely sharp with his fingers in terms of putting out what he's thinking, for these reports to have been doing the rounds, which have not yet been denied by the White House or by Donald Trump, does that then begin to get perhaps some form of validation that there is some truth to it as far as all these aspects are concerned, a service levy, the nuclear question, as well as a $300 billion fund?
I think you have to just look at the news cycle, right? I mean, Trump has just celebrated his 80th birthday with a UFC mixed martial arts on the White House lawn fight. And we've got the World Cup happening right now, right? So you have these things where people's attention, and in the West, it's summer, right? So people's attention is not to what's happening in Iran. And also, just the last few days, we had the IPO of SpaceX, right? So when we think of Iran's $24 billion it's going to get when Elon Musk is a trillionaire and, SpaceX is going to put data centers in space, I think the attention is elsewhere. And because if the Trump administration hasn't put out statements about, to address the noise that we're hearing, I speculate it's because they're focused on other things, because there's other things happening in America, in the world, that are just probably a bit more interesting for certain people. Now, that's not to say that the Iran conflict is not very serious. It's just to say that I think people's attention is elsewhere. And the Trump administration, they're focused on, not the people directly related, but I think Trump is probably focused on his birthday and other things. And that's why we're not hearing answers on it. And I think until Friday, adding more noise just creates more opportunities for speculation, more opportunities for Trump's opponents to criticize. I think he's not going to feed that. And again, I think this is the trouble with analyzing this conflict, is that it's and this being in a democracy, is when you're in a democracy, it's hard to have a unified voice, because there's always going to be sides that disagree, and they're always going to use whatever is happening to criticize the person that is in office. And that's just the nature of a democracy. And that's why it's really difficult to pinpoint what is exactly happening. You don't get that in authoritarian countries. And even in Iran, we've seen it's difficult to know what is actually the line of what the government's line is, because you have the IRGC, the clerics, and the government, and they're not always aligned.
Right, Professor. I'd like to thank you for all those insights. But as you correctly pointed out, again, a tentative truce is what we have. We'll, of course, circle back, check on Friday if it's held, if the two leaders of the two countries will sign it in Geneva. Mr. Pirzada, Professor Dixon, thank you so much for joining us. With that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Well, hello and welcome to this special edition of Finding Alpha. I'm Nigel D'Souza and we are coming to you live from the Mumbai News Center. Well, today our focus is on the oil and gas space, a space that continues to play a critical role in powering economies and shaping investment opportunities. In this episode, we'll decode the key dynamics driving global as well as domestic energy markets. We'll also examine India's dependence on crude oil as well as natural gas imports and explore the opportunities emerging across the gas utilities as well as the city gas distribution companies. And to help us drill deeper into the sector and get the outlook as well, we are now joined by Amit Murarka, the Executive Director at Axis Capital. Well, Amit, it's been a pleasure being in touch with you for all sorts of commodities. And today we're looking to learn a little bit more on the oil and gas space. Thanks a lot for coming down to the studio.
Yeah, good afternoon, Nigel. Thanks for having me in the studio.
Okay, all right, Amit. So let's get straight to the point then. I think first we'll focus on the oil, then we'll focus on the gas space. So in terms of oil, tell us about the dynamics globally first. What is the total oil supply globally? How much of it is seaborne? Because, that one got hit. And also, how much of that comes through the Strait of Hormuz?
Yeah, sure. Look, the global oil supply is about 107 million barrels a day pre-war.
Okay.
Of this, about close to 40% or 44 million barrels a day is seaborne.
Okay.
And within this, another one-third comes from the Strait of Hormuz, which is 15 million barrels, which got impacted largely because of the war.
Okay, all right. So 107 globally, 45 odd is seaborne, and out of that, a third of it, so around 15. Yeah. Got it. So that's clear. What about India? What is India's current crude oil consumption? If you could tell us what percentage of that is met through imports?
Yeah, India consumes about 5.5 million barrels a day.
Okay.
And of this, nearly 90% is imported. So a key concern actually for India's energy security has been the high dependence on crude imports. Mm-hmm. Unfortunately, we have not been as successful in our exploration program.
Okay.
Most of our production still comes from old, matured fields, which are going through a natural decline. There's roughly a 3.5% CAGR decline in our oil production. Mm-hmm. And that makes us increasingly more dependent on imports. And that's what government has been trying to fix for some time, but it will probably take a bit longer.
Okay, all right. But is there a plan to go ahead and at least increase capacity from our domestic chaps? As you have been saying, that there's been a degrowth of close to around 3%. So there have been various companies that have put up plans to increase capacity?
So these are more exploration efforts. So you do ONGC, Oil India, even private guys like Vedanta, like they have a capex budget. So these are all. This is called risk capital, right? Like you have to go find out where the potential is, drill literally a hole in the ground,
yeah.
and then just pray to the God that you get lucky over there. But unfortunately, we have not been as lucky. So, yeah.
So it's a tricky business. As you said, around 5.5 million barrels per day is what our requirement is. And 90% of that comes through imports. That's on the oil side. Let's focus to the gas side of things then. How much is the global LNG supply? And how much of that supply passes through the Strait of Hormuz? Now we're talking about gas.
So, again, the global LNG trade is about 430 million tons.
Okay.
Pre-war, this was. And of this, about 20% or 80 million ton is from the Strait of Hormuz, okay. Mostly Qatar, a bit from UAE, but mostly Qatar.
So that'll be around 80
million tons, yeah. And that has again got, almost the entire trade got disrupted due to the closure of the Hormuz. Mm-hmm. And the key problem that caused in the markets that led to a spike in spot LNG, which has doubled to almost $18-19 per MMBTU. Correct. Additionally, for the local players, it is a major issue because we are, again, heavily dependent on gas.
Okay, interesting. Since there has been a bit of a crunch for LNG supply itself, could you tell us how has India's LNG consumption changed? As you're referring to pre-conflict as well as currently. So how has that changed because of the geopolitical tensions? And also, if you could help us out with what proportion of India's natural gas demand is met through LNG imports? I guess the remaining part would be via domestic gas production.
Yeah, absolutely. Also, in gas, we are slightly better placed. About 50% is locally produced and another half is imports.
Okay.
But the unfortunate part for us is that imports is largely through the Strait of Hormuz because we are in close proximity to the Middle East and Qatar. Mm-hmm. Most of the imports have been coming from there. So okay. In this whole trade disruption, our gas supplies have actually been impacted more than the rest of the world. So we are down 50% on LNG and about 20-25% in total gas consumption. And that has been hurting India's gas sector in particularly this current quarter, ongoing quarter.
Okay, so 50% of gas requirement is via the imported route and 90% for oil. And for gas, it's around
90% import oil, 50 gas, but of that 50 largely 50
coming through the strait. So the consumption number was what, around 25 million tons earlier?
Yeah, so in million tons it's 25. In MMSCMD, it was about 95 MMSCMD.
MMSCMD. Okay, and that number has come down drastically because of the availability of
nearly
LNG.
halved.
Okay, all right. Got that. You were briefly mentioning that our players over here are ONGC, Oil India. I guess they'll be the major ones. But if you could put a number to that, what is their respective share? ONGC in particular, I think they would be a large part of it, as well as Oil India, and I guess the other players will be relatively smaller, Vedanta and the likes.
India's total oil production is about 28 million tons, and natural gas is 1995 MMSCMD, which is 27, 28 million tons. ONGC has the lion's share of this, about 2/3 of oil and 50% of natural gas.
Okay.
Then Oil India is about 10 to 12% on both oil and gas. And then we have private producers, mostly Vedanta Oil, which produces largely oil and some gas.
Okay.
And then Reliance Industries, which also produces some oil and gas. And then there are some smaller players operating marginal fields.
Okay, but ONGC is obviously the major player out there because two-thirds of oil production comes in from them. And in terms of gas, they account for close to around 50% as well. Got that. Since we're talking about both these two, could you tell us the preference between ONGC as well as Oil India at current prices? What would your preference be and why?
Yeah, so we prefer Oil India, actually. We see them having a growth runway of 3 to 3.5% CAGR, which is quite impressive given that what we just discussed, that the discoveries have not been coming through. The benefit which they have is that they are in Northeast, which is a region where government has a very high focus on development of infrastructure, including the city gas infrastructure. They do have some reserves over there which need to find a market. Right. The market is also there. We just need to connect the market from the producers to the consumers, and which is what there's a hydrocarbon vision in Northeast, which is helping to do that.
Okay.
So we think that this will unlock growth potential for Oil India. We see, as I said, 3.5% CAGR growth rate for that. We have a fair value of 477 on that, which gives me a 14-15% upside. For ONGC, unfortunately, and ONGC is mostly an offshore-based production facility. Those facilities are like 50 years old. You know Mumbai High, right? I mean, it was discovered way back in probably 1965 or so. It's now in a phase of natural decline, and that is hurting them and causing this, in our view, 2.5% CAGR decline, which will continue in the near term. And therefore, we don't like it so much. Also, Oil India additionally has nearly 200% growth in refining capacity in the subsidiary NRL, which should happen in the next 6 months or so. And that is another key investment argument to buy that name.
And on Oil India, you're saying what kind of a growth are you factoring in for the next phase?
3.5% CAGR.
Okay, but they have been short of their estimates, I think, in the last few years.
Yeah, of late they have been. There was some recent issue in fertilizer plant which kind of impacted their supplies because, you know, it's a very tight, small market.
Yeah.
If one plant goes down, you don't have any other alternative because you can't go out from Northeast back to mainstream India. That actually is now possible because now GAIL is connecting a pipeline to Northeast.
Okay.
So it might make it possible for Oil India to evacuate to rest of India as well in case some local plant has an issue. So off late they had that issue. And then the gas connectivity grid, which we're discussing in Northeast, is a bit delayed as well.
Got it.
So yeah, I would say that it should come. It's just that this has been a bit of waiting for too.
You know, Amit, we want to know more about GAIL because they are the ones who will be transporting, right? So that's going to be important. So we'll touch that in just a bit. And I think Petronet LNG will be important with regard to these LNG imports as well that come in there. So we'll get to that in just a bit. But before we move on, you know, from the upstream to the downstream companies, I wanted to ask you, what's your estimate with regard to oil? You know, we were sitting pretty at around $60, $65 per barrel. Suddenly, oil spiked up because of this conflict, went to around $120 per barrel. And now it's back down, you know, to more digestible numbers of around $80, $85 per barrel. What are you all working with as a house for oil prices this year and the next year or so? What are you factoring in?
We are at $85 average for FY27, going to 75 and then to 70. See, oil futures has been in backwardation if you look at the forward curve.
Correct.
It just means that the traders are essentially saying that the geopolitical risk is keeping the market tight for now.
Right.
But in the longer term, there is enough and more supply, whereas obviously there's a longer term demand concern coming from electrification and ESG related concerns. So I think longer term, crude doesn't have a great outlook, so it's a short-term disruption.
Well, that's good news then, from an economic perspective as well as from a macro perspective and as well as for our markets. But let's focus now to the downstream. OMCs, let's talk about them. They operate in two verticals broadly. I think refining as well as marketing. So could you tell us which company has the highest marketing volumes if you compare it with the refining capacity? Give us a brief idea.
Yeah, sure. You're right. So OMCs operate two businesses essentially. One, they refine the oil into the products, which is petrol, diesel and all. And then they have a division called marketing.
Right.
So HPCL has the biggest excess. They actually sell nearly double of what they refine on a standalone basis. But they do have equity stakes in some refiners, HMEL and MRPL. So if you take a net basis, they are 40% higher on marketing. Then BPCL is 35% higher and IOC is about 10%.
10%. Okay, all right. So when you're saying that their marketing volumes are higher than the refining volumes, means they are buying it then from third parties, from other private...
From the private refiners.
And they're just marketing it.
Yes, yes.
Got it. All right. Now, given the global shortage of refining capacity, if you could tell us which OMC stands to benefit the most, because refining margins are strong. Will you assume that refining margins stay as strong? The reason I ask this is because there are core refiners, right? Like a CPCL or an MRPL. They have gained because refining capacity globally itself has got hit. And because of that, some of these refining margins have moved up. So how do you factor that in?
No, again, you're right that the global refining margins have moved up. But there are some caveats to it in an Indian context. One, our delivered cost of crude is now $5 to $10 higher than the benchmarks.
Okay.
So again, we are sourcing from longer distances, which increases the cost.
Correct.
Secondly, the yields have changed in the refinery a bit because LPG is now being prioritized, and LPG generally is a lower yielding product.
Correct.
So that again subdues. And then thirdly, actually, there is also refinery inventory losses because crude has come off very sharply, right? If let's say it stays here, I mean, you will see.
Then refining.
Yeah, because March crude was 110, 120, now it's 85. So essentially, these factors will subdue while the GRM should be healthy, but these factors will subdue the near term, let's say Q1 performance for the refiners.
Got it. So for the OMCs, most of their money will be coming in from marketing margins whenever they do make good marketing margins. For the time being, it's been, they've been making losses because of the spike you've seen in crude oil prices. But as you mentioned, crude oil prices have come down, which is good news for these guys. Their losses on the marketing side at least will reduce. So could you tell us, between the three, what is your preference? HPCL, BPCL, IOC? What do you like and why?
See, I mean, typically HPCL is a play on marketing because of the higher marketing volumes, and IOC is a play on refining.
Right.
So now that we are kind of seeing a reverse trade of crude coming off, I would say HPCL stands to gain, and then PPCL, which also has higher marketing to refining, and then IOC comes the last. So our preference is for HP and BP and not so much IOC.
Well, got that, Amit. Thanks for clarifying both on the upstream as well as the downstream companies. But you briefly mentioned some of those gas utilities. So I'll tell you what, we'll slip into a short break. You come back, we'll focus on the other stocks as well in the oil and gas spectrum. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. You're on CNBC TV 18. And we have with us Mr. Amit Murarka, the Executive Director at Axis Capital. Well, Amit, you've given us a fair bit of an idea with regard to the oil and gas space. You know, we have spoken both about upstream as well as downstream. But let's talk a little bit about gas utilities, because you briefly alluded to that. Tell us, basically, first, what does GAIL do? We know it's a transporter, but if you could help us out with that. And Petronet LNG as well. I think that's more like a converter. So if you could explain the business models for us of both these two, gas utilities.
Sure. So Petronet is essentially an infrastructure provider. It has all these terminals. I mean, the Dahej terminal is the biggest in the country. In fact, one of the biggest in terms of volumes globally in terms of regasification. So it just gets, the LNG comes in the liquid form.
Okay.
It needs to be regasified for consumption, which is what Petronet does.
Got it.
And then GAIL essentially lays out all these pipelines cross-country, transmits the regasified gas as well as domestic gas to consumers. And they also have petrochemicals and some other businesses, but the core is this.
Okay, interesting. So this war getting called off, or the peace pipe being smoked, is actually good for these guys because they were starved of their gas in the first place.
Yes.
Between the two, what do you like? Petronet LNG as well as GAIL.
So we actually like both, I would say, but maybe as a trade on the resolution of the war, Petronet could see bigger upsides simply because it was beaten down a lot. As you can imagine, like 50% of LNG going down can hurt any company a lot.
Okay.
And along with that, as I said, LNG pricing has doubled. So the volumes essentially got impacted, and those are expected to come back now. So yeah, and even GAIL should benefit, of course, but then GAIL, as I said, has other businesses as well. So the overall impact on the portfolio gets a bit moderated in that sense.
To the world economy, and they don't give up that ambition, they're never going to have the resources to rebuild it from where it is today. So it's a big win for the American people, and I think the Iranians fundamentally have a good choice here in front of them, whether to be a normal country or whether...
Hello and welcome to the Global Dialogue. I'm Shriram Finance. The government has long focused on the idea of Make in India, and many global companies are hoping to ride that wave. A company that's been in India for almost a century is one that is betting now on the Make in India fervor with renewed enthusiasm. We're talking about Rolls-Royce, but no, not the luxury car maker, but the engine maker, and they have interests on both the defense as well as the civil side here in India. A large vendor base, a global capability center, and the aspiration to do a lot more. Joining us now here on the Global Dialogue to talk to us about Rolls-Royce's plans for India is Shashi Mukundan, the man who is steering its transformation. Shashi, always a pleasure. Many thanks.
Thank you.
And it's great to see you in your new avatar.
Thank you. Thank you, Shireen, and I'm really, excited to be here with you. It's been a while since, we last met. And again, that was on the energy side, and now this is on national security.
Yes,
and
energy and
well.
national security
Both,
at the same time. So let's double down on that. As I mentioned, Rolls-Royce has had a long-standing commitment and shared history with India going back almost a century. What's different as you look at the India opportunity? What's different about your appetite and your ambition for the Indian market?
So it's interesting you say that, because we just are celebrating 70 years with Hindustan Aeronautics, right? It's the 70th year. We started in 1956 with them. And what has changed is basically we are now in a place saying we want to be a strategic partner to India. I mean, obviously that sounds very cliche, but if you think about it, what we're saying is we want to go from just selling products to start making solutions for India, right? And in doing that, what we're saying is we are unique because we are across many vectors of the Indian economic growth area, whether it's transport, civil aviation, in terms of energy security, across all three, armed forces. It's also in terms of power, providing power. So we are changing our narrative, and what we're saying is that what we want to do is we want to build capability in India to provide, the ability to design, develop, manufacture, and take care of propulsion systems and power systems. And what I mean by propulsion system, it's basically engines,
yes,
for aircrafts. It could be engines for Navy, Coast Guard, and your land vehicles, whether it's tanks or your other armed vehicles that they use in battle. So that's where we're coming. And on the power systems, with the huge growth in the data centers and AI centers coming on, there's a huge need for energy. And we're looking at two things. One is backup energy, which would be our power systems that we already manufacture in India, and we can do that for India.
Like you are at the T3 in Delhi at the airport.
Exactly, yeah. And most people don't know that, right? If something goes wrong, it's our system that can actually backs up. And the other thing which is exciting is the new civil nuclear program. And what we want to do is we want to explore the possibility of bringing in small modular reactors, and whether we can do that in India to again augment the energy requirement. And it's a great area, right? Because India today, we need as much energy as possible, on the ground, made in India. And so this could be another area to do that.
So there's plenty that you, unpacked there for us. Let me double down on each of those sectors. And I'll start with HAL because, as you said, it's your 70th year. That's one of the two joint ventures that you have in India, the other being with Force Motors. Correct. Now, what is the plan as far as the JV with HAL is concerned? What can we now expect?
So HAL, there's two parts to it, right? One is we have licensed manufacturing of engines and the maintenance of those engines. A lot of people don't know we've got 6 different types of engines that are being manufactured and maintained by HAL. The other bit is a joint venture which is called IAMPL, or International Aerospace Manufacturing Private Limited. There we manufacture components for our global operations. So we're already making in India for the global part of it. There are about 200 plus precision parts which are being manufactured there. We just expanded our second factory. So our first factory is in Bangalore, second one is in Hosur, and we have just expanded the Hosur plant to a larger capacity. And now we're thinking about plant 3 and 4 and 5. So it's
where will these plants come up? In the area, or
it'll be in the area, in the area where it is already right now. But the idea is that this will play very well with our whole vision of being a strategic partner to India, right? As we start being that, we will be manufacturing in India, and for that we will require supply chain. IAMPL can play a key part of that.
So when we talk about making in India, and you give me an example of how you are doing 200 precision parts that are being made here in India as part of your global supply chain. Now, what's the sourcing aspiration? What do you intend to do as far as expanding the vendor ecosystem is concerned? You've got about 100 odd vendors here. What can we expect on those fronts in terms of investments and in terms of expansion?
So when we think about supply chain, I think of it in 3 different buckets. There's a set of vendors today or suppliers today who are supplying us. Those are easy to lift and shift into our new programs as we start doing it. There's a second set of supply chain people that are there who potentially will need a little bit of tweaking. We may need to support them. We may need to help them get to that capability to do it. And then the third one will be absolutely brand new areas which we will need to cultivate and build. So our whole idea is that our supply chain strategy is going to be, we're going to look at all these 3 areas and see how we can build it. And our aspiration is, we want to get to upwards of $1 billion of supply from India.
Upwards of $1 billion by when, and where are you currently?
So I would say it's probably by probably in the next 5 years. Is the goal.
In the next 5 years. Let's talk about the one piece of news that is much awaited at this point in time, and of course we are still waiting to hear from the Indian government on the decision as far as the AMCA program is concerned. You have of course submitted your proposal and that involves complete transfer of technology as well as making in India. How confident do you feel about your proposal as far as the advanced medium combat aircraft is concerned?
So Shriram, what we have done is we've thought a bit more broader. What we have done is we have not just looked at the AMCA engine. Obviously, AMCA engine will be the heart of our process. But what we're thinking is we want to set up a whole, what we call an aero gas turbine complex in India.
Okay.
What that means is basically we'll have a design center, we'll have a development center, we'll have a manufacturing center, and then we'll have an aftercare. So the whole series will be in one complex, plus we will add to it the supply chain ecosystem. So we will have suppliers that will also come into it. And the intent is we will do this with an Indian partner. So we will jointly with the government, which is GTRA, and an Indian partner, do the design, look at the production. We will, we have full support of the UK government, unwavering support for doing this. We have said we will full transfer of technology, and we will develop IP for that whole thing in India. So we will continue to use the work that we have done with GTRA together to kind of take it to the next level. So we feel pretty confident we can do this. And what we have said is that we will be ready with an engine to fly by 2034.
By 2034. But this plan that you laid out for us, which, as you said, will not be just dependent on the AMCA engine, but it will create an ecosystem around the AMCA engine. But are these plans contingent on the fact that you actually get your proposal through and the government gives the green light? So, if it doesn't, what happens?
So that helps us to speed up in terms of how we want to go about this. If not, then we got to think of another program, right, which will happen. But the idea is that we will have Indian capability there ready to not only just work AMCA, but also work other things down the road. And this could also end up being dual use at some point. You could use it for military and you can also use it for civilian.
Right.
And once we develop an AMCA engine, what we have said is we can use components of that to create a naval electric propulsion, which is very
Well, it's the start of a new era for Vedanta Group. The mining conglomerate has split itself into 5 distinct listed entities. In fact, 4 new companies started trading on the Lal Street effective today. And over the next 30 minutes, we'll speak to Vedanta's chairman, Mr. Anil Agarwal. We'll also get in a renowned analyst who tracks the sector as well as the company very closely. I'm Nigel D'Souza, and before I bring you the conversation with Mr. Anil Agarwal himself, here are the mechanics of the demerger that have played out. Well, we have 4 newly listed Vedanta entities that listed today on the bourses. Well, we'll have a separate aluminium vertical, iron and steel vertical, oil and gas, as well as power. Well, and there's been a massive value unlocking exercise. I say this because in the run-up to the record date, well, the stock price was hovering around 720 to around 730 rupees per share. And if you look at the sum of all the 5 listed entities right now, it's close to around 900 rupees, which effectively means if you bought it even a day or two before the record date, well, you'll be sitting on a handsome 25% return. But what's the street factoring in terms of FY28 numbers? Well, Kotak as well as Nuvama, they have put out notes and they value the aluminium business as the highest value. They've given it a value of close to around 475 rupees, followed by the other smaller verticals as stated for you on the screen. But you'll be asking why the aluminium business is the crown jewel? Well, it has higher capacities. So you'll have aluminium capacities that will ramp up towards 3 million tons odd, which will support volumes, and that will be backed by firm aluminium prices as well. So there'll be good growth on the top line for the coming years. And their cost of production has been moving down, which is heartening to see when a company does what's in their own hands to reduce the cost of production. That's because they've been focusing on backward integration, on bauxite, on alumina, as well as coal. And in the coming years as well, their focus is going to be on backward integration, which will keep the cost of production at lower levels. In addition to that, aluminium prices that most brokerages are factoring in is around $3,000 to around $3,250 per ton. Remember, even post the recent pullback, the prices are still hovering around $3,500 per ton. So if the prices remain at these levels, it could be reason to go ahead and upgrade their estimates as well. But we need to tell you some risks. In the past, there has been these intercorporate loans that have hampered the company. You have some hikes in terms of royalty rates as well. And they have pared stake occasionally at the promoter level. However, these kind of risks are not likely to reoccur
at least going by the financials of Vedanta Resources. Because Vedanta Resources, that's the parent, the deleveraging exercise has been absolutely brilliant. From close to $10 billion, that's down to around $5.1 billion. So that's how the entire mathematics works with regard to the demerged entities. But let's go across to the man himself, Mr. Anil Agarwal. I spoke to him earlier today.
Mr. Agarwal, congratulations. This has been in the works of the last few years, and now we don't have just one listed entity from the Vedanta Group. We'll have 5 entities as well. So congratulations on this feat. Well, since you now have 4 listed entities separately that will be listing today, among all 4 of them, which one are you most bullish on, if I were to tell you to pick one?
First of all, thank you very much. It is the support. This is the company. This is a company for India. This is a company हमारे भारत के लिए, and for the every citizen going to be benefit. This is what we talk about, the development of the country. So we started, a boy from Bihar came to Bombay with a big dream, and how Bombay city has given me everything, to all of us. I really thanks. Bombay has something, uska pani hai. So we created, and one company has everything. I didn't find enough resources and credibility. I don't have a godfather. So I have to move to overseas, went to America, London, and could raise $35 billion. I had a dream because always wanted to be in this non-ferrous metal, because that's what we were dealing with. My parents, everybody was dealing with. So aluminum, zinc, copper, oil and gas was top of my radar.
Right.
You know, $14.5 billion I paid to Kane Energy to buy that company.
Right.
And to have a vision to have a $100 billion company of oil and gas, because that's the potential. And then the power, I'm very, very bullish, including the renewable or anything. Power is very, very important. And the iron and steel.
Right.
Iron and steel is amazing, and you don't know each. And Hindustan Zinc.
Yes.
I'm so excited. Each company, I'm saying potentially can be again demerged. Maybe after so many years. Because if you look at the iron and steel, it has the only producer of nickel. Nickel is great in demand.
Right.
We have a production nickel. You talk about iron ore. We are the only company with a full backup of iron ore.
Right.
So each company has a huge potential power. As I talk about steel, iron ore, and the Hindustan Zinc.
Yeah.
Hindustan Zinc has a huge, when you talk about, is opening like silver.
Right.
You talk about fertilizer.
Right.
You talk about recycling. Critical metal. All the critical metal going to come from the Hindustan Zinc.
Right. So, Mr. Agarwal, you know, you're so bullish on all your businesses. If you were to put a number, the analysts are going to be putting out their own valuation. But if you were to put a value to these businesses, what would it be? People are most excited about aluminium. You know, do you have a number in mind?
Intrinsic value of each company going to beyond $100 billion.
$100 billion every
each
entity.
company.
Okay.
All 5 company intrinsic value, because the demand supply difficulty to produce this metal is take huge gestation period and huge capital. Why I'm successful today? The whole world backed me up.
Right. Right. All right. Got that, sir. Let's talk about the biggest part, you know, and everyone's excited about the aluminium business. And you have been ahead of time because you created capacity, you focused on backward integration as well. Now, from around 3 million tons, how large can the aluminium business be? And also, if you have to look at it in terms of aluminium prices, now there's a peace deal that's been announced, so prices have come down a little bit. What are you factoring in terms of pricing on the aluminium side?
Price will go up, price will go down. I'm the lowest cost of producer in the world, fully integrated. I started producing 3 million ton, going to be 6 million ton.
Okay.
And vision is to go for 10 million ton.
By when 6 million ton and by when 10 million ton?
6 million will be in 3.5 years time.
Okay.
And 5 years time, 1 million ton largest producer. And demand is so high, still there will be a gap.
Okay, all right. So 6 million tons in the next 3.5 years, that's going to be an interesting perspective.
And 5 million, 10 million ton in 5 years.
In 5 years.
It's not far.
So by 2032, 2031 odd, you will have close to a 10 million ton Vedanta aluminium facility itself. Got that, sir. Quick question. You know, last year you did around 25,000 crores of EBITDA for aluminium. And in the past, you've said that the aluminium EBITDA can scale up maybe to around $4.5 billion odd. Is that on the cards?
$5 billion. $5 billion EBITDA will be for aluminium.
Okay. All right. $5 billion.
Yes.
In the next 3 years or so?
Yes. With this production.
Correct.
After that, new production will come. I'm talking about this production.
So, all right. Interesting. So at around 3 million tons, you're saying you can also scale to $5 billion. Got that. Let's focus on a couple of other verticals then. The steel and iron ore, you briefly spoke about that. Some believe that Mr. Agarwal may sell this business at some point of time. It's around 1.5 million with a roadmap to around 3.5 million tons odd. Will you be looking to divest any of these businesses if the check is big enough?
See, we are in that business. At the moment, my focus is to create, because steel is amazing business, we need 300 million ton by 2030.
Right.
No matter everybody produce, it will not be there.
Right.
I have to produce 50 million ton of steel.
Right.
Time to come. And we have infrastructure. We have a Bellary Steel, Karnataka, beautiful plant. We have the complete backup of coke and the iron ore. Okay. We are the largest producer of iron ore. And we have a complete gas availability. With this, the whole world is with me. That how you can come in, and because this is the demand supply huge gap. So this is what's going to happen. My vision is 50 million ton. I'm going to start at the 4 million to 15 million ton. But if you talk about vision, it should be 50 million ton.
50 million ton. But
special steel.
Okay.
All special steel.
So as of now, you're saying you rather grow the business than sell the business.
Yeah.
You like to focus on adding capacity.
I'm selling business to my shareholder. No, they are there. Institution buying. Everybody is buying. Everybody is, Vedanta Resources itself.
Right.
I delisted.
Right.
Everybody is looking at me. Why don't you relist?
Is there something you would look at? Would you look at relisting Vedanta Resources? And also, you could briefly tell us about the debt in the books, because Vedanta Resources debt went to $10 billion. You have halved it.
$12 billion.
$12 billion. It's less than half now, at around $5 billion odd. So what is the debt outlook on Vedanta Resources? And by when will you be looking at this relisting of Vedanta Resources?
See, debt is always a part of business. It's nice to have some debt.
Okay.
And we are very comfortable with that debt. It will be in 2 years' time, maybe $2 to $3 billion is fine. But the potential of Vedanta Resources, if we relist $100 billion, this is all money, $100 billion will come to India. That's what we are looking. It is amazing, and it is not debt. It is coming in the form of equity. We are the ambassador of India in the world, because last 25 years we paid the dividend, we made the value tremendous. Everybody in the world who invested, a man on the street to the largest fund, everybody has made money from us and believe in us, and we always sell India. India is the best.
Okay, interesting. $100 billion of listing value, and that will be the United States, I'm guessing. You'll be eyeing a listing in the United States.
If that happens.
If that happens. But that's probably on the cards.
Yeah, this is already there on the card. We'll see how strategically it will work.
Okay, all right. Now, just a few risks, which sometimes shareholders are a little worried about. Intercorporate loans, you've said you won't do it. Is there any risk on that front? And also, what is your targeted holding, Mr. Agarwal, in each of the companies? Currently, you hold around 56% stake.
Yes.
Do you see that number hovering around 50, 51%? Would that be an option?
I will only look in growth.
Okay.
For me, मालिक बन के रहना वो जरूरी नहीं है. हमारे प्रोडक्शन बढ़े, जितनी डिमांड सप्लाई बढ़े, हमारे कंपनी आगे बढ़े, उसके लिए मैं किसी भी चीज में we will never have a stop, whether I have to address the equity, whether I have to restructure, go to abroad to because the potential. I have understood.
Correct.
I have understood India. I am a person who can take the beating. I can understand whatever. I know that what are the headwinds. and I've come out of it. And the biggest thing, the tremendous support of everybody, because I come from that part. I come from Bihar, a small boy who come in to here, so everybody relate with me. So that is the biggest support I have. Today, if you say one support I have, is a public support.
Okay, so no intercorporate loans is what we should be looking at from the Vedanta group, right? In the time
Never be corporate loan, but we will have a debt if it is required.
Okay.
And there's a lot of ways to raise the bond, do whatever you want. There's a tremendous money available.
And royalty rates will be kept steady?
Royalty, we have about around 2 to 3%. And that is the biggest selling factor in the world. Because when we listed our company in London, they are not charitable institution.
Correct.
So they say we'll give a dividend. And then we'll have a brand fee, because you created a brand. And that's how you're getting the money.
But this fee will not be hiked, sir?
No, not at all. It's going to be reduced.
Okay.
It's going to be reduced to 1 to 2%. Against that, the kind of money comes in is 100 times. So we give this at 2%. Against that, the kind of money we bring in.
So you're looking at basically the royalty rate could potentially come down, is what you're telling me?
Should be.
Should be come down. That'll be interesting, Mr. Agarwal. But you know, you're going to be having 5 listed entities, but ye dil mange more, right? The street will be waiting by now. Hindustan Zinc, when is that demerger going to take place? Because you briefly alluded to the fact that silver has huge potential as well. So could we be looking at a restructuring at Hindustan Zinc as well, say in the next 6 to 12 months from here on, a demerger in Hindustan Zinc?
Each of our company has a potential to be demerged, to create amazing time to come. Because talk about your Hindustan Zinc. Silver, we have been through technology, never ever thought India will produce silver. We produce silver. Then we are going to produce largest fertilizer in the country.
Right.
The critical metal, palladium, rare earth. These all will be Hindustan Zinc going to be one of the largest company in the mineral sector.
Okay.
So that's what we are looking at. Hindustan Zinc can be a couple of companies.
Potentially. Okay. And you have told us about all these pieces of the Vedanta group that we know, with regard to metals, mining, the other verticals as well that you've spoken about in this interview. Is there any other new ambitious target that you have, or some unrelated business that you're looking to get into as of now? Or you're happy with what you have and you want to grow all these businesses?
Hands are so full. But my shop I'm sitting in the shop. I'm not going to hunt. But somebody comes, I have to fulfill my shareholder desire. They know me. If some aluminum company in India comes or anything, I'm just hypothetically talking about. We will look at.
Got it.
But no plan for diversifying. The head is so full. We are going to, what we are looking at, $20 billion to invest, looking at $100 billion to raise and bring it here, keeping these companies. Because demand supply is so high. What I'm looking at, India import should come down or remain Atmanirbhar.
Got it. All right, Mr. Agarwal, final question before we let you go. You have some personal aspirations as well. Is an IPL team on your radar? Would you like to be an owner of an IPL team, or that's not part of your ambition?
No, like I have a I have a Nandighar. I don't want any child to be deprived of food and education. 15,000 Nandighars running, but I'm going to create 10 lakh Nandighar. The hospital, cancer eradication. I'm very, very keen. Higher education. These are my IPL. Sure, my young people in my company. I have average age of 30, and 35% is a woman. All are very excited to go in a sports. We have a small sports team. My daughter look after and everything. If any opportunity comes, we'll see. If they create a brand for us.
Okay, all right, Mr. Agarwal. Final question before we let you go. What keeps you going? There have been so many challenges professionally, personally as well, that has hit Mr. Agarwal in the last few years. But you rise up and you take the challenge again. What keeps Mr. Agarwal going? Because a lot of youngsters out there
will be looking for those words of inspiration.
Never give up. I'm like a Dara Singh. I used to go for the kind of beating he used to get initially. And we used to thought he finished. And then he used to get up. And I've never seen him losing. So I'll always relate with him. The people, because I have no background, people beat, because we never did this, have this kind of imagination that India, this kind of production can come in, we can be self-sufficient. So people have a doubt because I don't have a background. I'm very successful outside India because nobody knows my background. So for me, I will keep going. I'll keep going, make one of the finest institutions.
Right.
These companies going to be for the 500 years.
Got it.
Run by the people, for the people.
Okay. Always a pleasure talking to you, sir. Thanks a lot for speaking to us here on CNBC TV 18.
Welcome back to this special broadcast on the Vedanta demerger. Well, earlier today, we spoke to Mr. Rakesh Arora of Go India Stocks, who has been a close watcher of the Vedanta Group and the mining industry at large. Let's listen in to what he had to say.
So I think, see, aluminum prices have kind of peaked out, and if Anil Agrawalji is talking about 10 million ton capacity from 3 million ton, that itself tells a story that there's a lot of capacity which is going to come in. And we are expecting 10 to 15 million ton of capacity coming up in Indonesia. So while China has had a cap since 2017, they are stuck at 45 million ton, but other countries are increasing, and there's no shortage of bauxite, which is the raw material for aluminum. So I think $3,600 is kind of peak for aluminum, and a fair range would be more like $2,600 to $2,700. So 532 is an excellent price if investors want to book some profits here. Let's see, oil and gas would be under pressure because of the Iran deal, and so our fair value was around 39 rupees, probably opening around that only. So there's not much in oil and gas, maybe on dips. If things if it goes to 23 is our bear case value. Steel, our valuation is around 27, and bear case is 15. So there will be a lot of selling in these, segments, because people don't view them as, industry leader or something like that, which is the case for Vedanta Aluminium. So I think, these segments will trade much lower than the fair value.
Well, on that note, it's a wrap on this special broadcast. Thanks a lot for watching. The news continues on CNBC TV 18.
have some wonderful speakers here with us today. To kick things off is somebody that has been an old India friend, John Chambers. Thank you so much for being here with us. He needs no introduction, but has seen many, many market transitions as the man who steered Cisco from $1 billion to $50 billion, 180 plus acquisitions, and of course has been a big believer in the India story. He was the man who actually did the first GCC before it was even called a GCC in India, in Bengaluru. So thank you, John, as always, for being a big supporter of India and for being a big supporter of Young Turks. We truly appreciate your time, your friendship. Ladies and gentlemen, a big round of applause for John Chambers. May I request you to join me up on stage? What's happened as far as SpaceX is concerned? Is this a tectonic shift, especially as far as the public markets are concerned? Are they pricing in risk differently? A $2 trillion market cap company at the end of day one for SpaceX, John. What do you make of it?
I think it is great. And I mean that way beyond just the transaction. The speed of innovation has never been faster. And with that innovation, the areas that cover not satellites, but strategic infrastructure for the future are where investments are going to occur. And if you watch how quickly companies become $1 trillion today, it's like the unicorns of old. And out of that group, you're going to see $10 trillion companies, in my opinion. The challenge will be that these companies with trillion-dollar valuations have to move from being leading on technology to leading on execution, implementation, and the efficient use of capital, which is why you see them going public, and to be able to use that in terms of their approach. So on the one hand, this AI issue is not a bubble at all, Shireen. It is the future. It will get valuations that we were the most valuable company in the world, Cisco, at only $500 billion at a point in time, that are very large. However, the majority of AI startups will fail. And out of the magnificent, let's say, 10 today that are trillion-dollar companies, a fair amount of those companies will not be in that mode at all 3 to 5 years from now. So the speed of change, the differentiation is there. Will the total portfolio of those top companies play out for good investors? Yes. Betting on one by itself is different. But I could not have been more excited about today. Elon Musk, he's clearly brilliant in terms of the number of things he's able to do.
You know, the freshly minted trillionaire, the world's first trillionaire. But John, you know, let's address the valuation question. And a lot of debate has happened on whether these valuations are, of course, they're awe-inspiring and jaw-dropping, but are these valuations real? Do they really tell you the story? And what does this then set up for the likes of Anthropic and OpenAI as they head to the public markets? Does this now open the doors and the windows for them to be able to extract these kind of valuations as well?
Well, I always start at the big picture, taking a step back. At 25 and 26, 2025 and 2026, you and I talked about our predictions. We said year 2025 would be the era when all enterprise companies and all businesses started to move to AI. Most people did not agree with that in December 2024. And we said this last year, by the end of this calendar year, most companies would, across all industries, be well into the implementation at their employee level. It was going to drive the stock market, productivity, and the returns at a pace we've never seen before. And that's what AI does so well. Productivity of a nation, probably 3 to 5% in the U.S. Nobody's talking about that. A great productivity of the internet was 2%, up from 1.4. So what you're going to see is a series of major IPOs, followed by a series of other companies going IPO, followed by a lot of M&A activity. Because if you're not breaking away and you're a larger company and you don't have a real crisp AI strategy and differentiation, you better acquire quickly. And so you're going to see a series of things occur. Will all of them be successful? No. Will the ones that are successful do it at tremendous returns? Yes. What's going to happen, Shireen? Somebody is going to spin out. We've never had this amount of money at this speed. It's like a racetrack that was designed for 120 miles an hour. The cars are going 240 miles an hour, and all it takes is a slight miscalculation, then they're off the track. And when that happens, the market's going to panic. Their ecosystem they build is going to be challenged. But I think it's inevitable in terms of AI, the leverage that it will have for the next 5 to 10 years. All 26 of my startups are AI startups. So I focused on this 8 or 9 years ago when people couldn't spell it.
You did a good job of that, John.
I listened well.
But, you know, let's address the concerns. And you said that you don't believe that this is a bubble. And many question the fact that we are probably heading into bubble territory if we're not there already. Why do you think this is not a bubble?
Well, when you really look at what a bubble is, it's when a period of time when people had huge growth expectations and the market couldn't even begin to meet those. And the internet, it was talked about a bubble on the internet from 1995 all the way to 2000. 2001 had happened. But what caused the bubble there is the implementation of the infrastructure for the internet, which was primarily service providers and then enterprise. It didn't need as much capacity. And so evaluations had gotten high on multiples. Did the companies in that group continue to produce good profits, Cisco included? Did we produce more profits and more growth than before? Yes, but the PE ratio wasn't as there. If you believe we're in the second inning, not of a 9-inning baseball game, but in a 100-inning baseball game, the companies that come through this are going to do remarkably well. But it would first be on technology. Then it will be about execution and implementation. Then it will be about how well their competitors do. And no sooner are you going to get excited about two great companies, Anthropic and OpenAI, than they're going to be competed very aggressively with new startups, open models, et cetera, and it's going to put huge pressure on their margins and what will their core business be. I think that's extremely healthy. But the changes, when I talk about the AI, not bubble, but the AI generation that's going on, what you did with the internet in 1 year, in 5 years, now the AI companies do it in 1. That speed is perhaps the major difference, and then the ability to really tie it to outcomes and results. So I'm a portfolio player. I wish I could tell you all 26 of my companies are going to be successful. I know today, unfortunately, 2 aren't going to make it on it. And very often the ones that I think could be successful end up missing. But you are seeing speed of change like I've never seen before. It used to be, how many of you are in startups in the room? How many in venture capital? How many angel investors? So it used to be when we'd look at this, if you picked a company, you would have a period of time that you could ride out the differentiation on it. Right now, I think you really have to do a portfolio play. With the internet, the rising tide raised all boats. And while Cisco broke away as the tide was rising, our top 100 competitors also did well for almost 10 years. Now, if you believe 5-to-1 ratios in speed, it says 2 years. People can cycle in or cycle out. And what was the best of the capabilities just 2.5 years ago? OpenAI. Yeah, and basically what ChatGPT did. Then Google was in trouble.
Yep.
What, 2 years later?
Yep.
Gemini was the lead.
Yep.
A year later, Claude. And I used all 3 today, and it depends on which vertical you're in. So I think you are going to see tremendous valuations and returns, but I believe it's now about strategy, execution, efficient use of capital, and you're going to see some train wrecks.
You know, we'll have to wait to see the train wrecks and where they're going to come from and what will potentially trigger a train wreck. But let's talk about the infrastructure build-out. And that super cycle is charging on. I mean, hundreds and hundreds of billions of dollars individually by each company being spent on this infrastructure build-out at this point in time. Do you still believe that demand is outstripping supply?
Yes, I do. And there's no better example of that than merely on, if you think about the stages of infrastructure, you see the huge pressure on the semiconductors, you see the huge pressure on the data centers, you see the huge pressure on the power generation. Bloom Opportunity, and KR is one of my companies. I have a lot of faith in the job that he's doing very well. And if you look at this, in the average enterprise, remember there was an active discussion just 6 months ago about would most employees be using AI by the end of the year. If you're not already got your employees being trained on AI and say, how do you differentiate your behind? And they're just taking baby steps with it. So very early in the demand opportunity, and I have seen this movie before. Many people say, John, you've been front row seats for the changes. I said, no, I wasn't. I was in the middle of the playing field. I was there with mainframes with IBM, mini computers with Wang, internet with Cisco, the cloud with Cisco, and now the AI implementation in the middle of the playing field. The two big transitions were the internet, and then it was AI. Everything we do will be tied to AI 3 years from now. Every employee will begin using it almost without exceptions by the end of this year. The leadership on nation states will be based upon how well they do their AI implementation. And that's one of the many reasons I believe that the U.S. and India will inevitably come very tightly together, although we occasionally hit little bumps along the way. So it's early stage, and I have seen this movie a number of times, and I'm betting more and more how it evolves through. How many people would agree with that? How many people would disagree? Now that I'll worry about, because if some of us don't disagree, we're probably not got enough balance, because you can fix almost anything if you have the money, the talent, etc., except what you don't see coming at you or what you waited too long to change. You want me to address that?
Sure. I was gonna put that to you, but since he's brought it up, let's go straight into the data center. You've got the real Erin Brockovich leading the charge here in the US against data centers. India is hoping to be a big beneficiary of the data center story. We've rolled out a 20-year tax holiday. You know, how significant is that going to be?
I think your question was simpler for me to ask. And the answer is, it's inevitable. If you're going to play in AI, you got to play in data centers. But what you have to do is address the legitimate concerns of the market. The legitimate concerns of the market is you can't power these data centers on the back of the consumers and expect them to pay increased rates. Yeah. It's not fair. And by the way, the grid will not handle it. The winner on power for data centers will be, in my opinion, and obviously I'm very biased toward Bloom's and what KR's position is, power generation on site. Now, power generation on site, what is the pollution implications for a product like Bloom? Almost nothing. What is the effect on noise and effect for the community? Zero. We could have, in fact, we will be having, I might even give you a special discount on a Bloom system here at the house. And so you've got to address the legitimate needs and say, how do we navigate through together? The industry's done a terrible job of dealing with this. So you've got to have the big semiconductor companies come together, the model companies coming together, the power companies, and say, how do we educate people on this and address their legitimate concerns? But the answer is, it will happen. We just have to put, if you will, rules and guidelines in place as we're flying this airplane or rocket ship at a tremendous speed.
You know, speaking
do you buy that?
Yeah, I do buy that. But speaking of legitimate concerns, let's address the big concern around what happens to jobs. And I'll talk to you about this in the context of India and the fear that we are going to see the Indian IT services sector being disrupted like we've never seen before. That's been the big job creator. It's been the big job generator. We're now talking about, even here in the US, you know, Dario and Anthropic saying, look, you need to put binding agreements in place, you need to put guardrails in place. CEOs are now starting to walk back on how catastrophic this is going to be as far as the jobs market is concerned. But till 3 months ago, everyone was talking about a white-collar catastrophe. So legitimate concerns of the jobs front. Can the government do anything? Can regulators step in? What should industry do?
So about 5 questions. I'm going to break into pieces of it. And we've been friends for so long. I think she is the best in the industry, not just in India, the U.S., but in the world.
Thank you.
And she makes me sweat with the toughness of her questions. So I was so glad to hear that we would have shade, because I've got enough heat on me for the questions. Now, here's the classic. How many of you in startups? What do you do, Bhakti, when you get a very emotional question like I just got? So when you get an emotional question, you answer it with facts. So I'm going to answer this with facts. When you get a factual question, do you realize what the price of this was at $2.1 trillion? Does that make sense? How do you answer the question? Emotion. So the way that I deal with the question at hand on jobs is facts. Remember the internet. And this is why being in the middle of that playing field is so key. Do you know what the #1 concern was about the internet?
Yeah.
How many jobs it was going to destroy versus it created. Could we describe what those new jobs were? No, because they enabled new areas of movement that we never did. Did it destroy some jobs? And did it change each of us in the way we work, live, learn, and play? When I said that, they said, you move around zeros and ones, John. It did entirely. So I think you are going to see a major productivity increase first, And that's so important to stocks and the balance and standard of living and even inflation. But you are going to see a lag in the job creation side. And this is where, to your questions. First, companies should be doing more. Companies can move at a pace that government cannot and education cannot. Then within that, we've got to also say, how do we do this in a way that is very fair in terms of the creation? And let's begin to train people in how you do it and how you use the resources on it. How do we create an environment where we refund and encourage the startups that do AI? How do you allow each of the companies to have programs for the development of their own people and taking care? And then it's being responsible. It does no good to say, hey, it's going to destroy all the jobs and we need guaranteed payroll.
Do you think industry has done a bad job on this front?
Well, I think it's done a terrible job. But we actually led with the negative, which you never do. People have legitimate concerns. Many of the graduates, if you were a speaker on campus this time and you mentioned AI, you got booed.
Yes.
And so we have not positioned what does this really mean to each of us. And even though I'm from a different political party than President Clinton was, he taught me with the internet, he said, John, you in Silicon Valley, you argue emotion. He said, realize your opposition has valid points and you address them one at a time. So the model is already there with the internet. The difference is the speed of implementation is 5 times the speed, which means both the positive results will be 3 times more, but also the challenges to jobs. So we've got to accelerate that. Each of the companies have to say, what does this mean to their employees? Be honest with them. The well-run companies have already trained their employees on AI. They've already enabled them. They're looking at first, how do you get productivity? Raj from Federal Express is an example, or what Walmart is doing. All of their employees use AI already, and they say, this is the facts we're dealing with, and then they educate them about what does this mean for their future. Then they look at creating new revenues. So this is what I think people are underestimating on both sides. How the jobs that people will be in 10 years from now, the majority of them, and maybe as much as 70 to 80% of them, don't exist today. And you could say, well, John, does that make sense? Think back to the internet jobs. That's absolutely true. And then as you think through this, you realize we can address it, but you do need a national program. Regardless of your political views, if your country is not focused on AI, you're already in trouble. If you just started focusing on AI this year, you're probably left behind. And that's where Prime Minister Modi's done an amazing job. President Trump, I agree with him on some things, not on others. He's done a good job on focus on AI. And you find some of the players in Europe have said they were focused on it, but it's relatively recent. And that's why Europe's behind. Innovation wins here, period. You either disrupt or you get disrupted. And it's going to be brutal.
We're living in a world where we don't know who your friends are, or the good thing is you don't probably have permanent enemies either, and you certainly don't have permanent friends at this point in time. What does that mean as a CEO who's weighing decisions on where you should invest, how you should invest, how much you should invest? I mean, at the end of the day, capital goes where it feels safe. How much is geopolitics going to weigh on investment decisions specifically related to AI?
So anytime you invest, the more predictable the environment you're in, the more comfort your investment opportunities are. But of even more importance is the larger the opportunity, the more likely you are to invest. Now, here's where I transition from the emotional question back to the factual question. There are 480 companies in the U.S.-India Strategic Partnership Forum. You know many of them. You've interviewed us. The majority of them are large companies. Out of the 480 companies, how many are not continuing to increase and actually accelerate their investment in India? All of them. Are they saying that out loud? Is it the right time to probably be a little bit low profile? Yes. But in the end, logic always wins. Economic logic, the businesses have already voted. The businesses want this on India, startups, big companies, back and forth. Citizens want a higher standard of living, but they don't want it at the expense of losing their jobs. And so as you begin to show the generation of jobs for each company that works together in India, their jobs generated in the U.S. and vice versa, then they begin to get it and see the outcomes that go with it. And then if you look at it, what you really need is innovation at scale, i.e. 1.4 billion people, 360 billion people with capital. Nobody's richer than the U.S. by far on it, with democracies that really believe in countries that believe in technology. With the internet, 92% of Americans believed that was in their best interest and the country's best interest. We've done a terrible job of not just positioning, because it can't be marketing, but actually saying, here's how we're going to address AI, and why is it important to people that are in the central part of the nation where I lived the majority of my life.
But, you know, just going back to the US-India question, and, yes, you know, as you rightly pointed out, companies continue to invest, companies continue to be invested in the India story. But to your point about if you don't make the investments in AI today, you're going to be left behind. Now, yes, India is making its play, whether it's data centers, it's a semiconductor mission, and so on and so forth. But the fear is that you're not really creating IP at this point in time. Yes, you're the largest consumer base. Yes. Enterprise adoption is still lagging behind. What are your concerns, if any, on AI specifically and the role that India is likely to play?
So on the positive concerns and then the issues that we have to address in India, and I love the Prime Minister, you know that. I think he's one of the top 3 leaders of my lifetime. And he understood when he first came in about a digital India and the 11 planks that he would drive through it. And then he understood when AI came on, India had to be an AI country in terms of direction and implementation. In terms of where we can work together, there's no bigger data than 1.4 billion people. And there's no bigger source of capital and how do you grow and scale companies than here. And so you just have to say, how do we work through these issues together? And there are going to be setbacks. It's like a relationship. Yeah, and I don't know, how many of you are married? Is your relationship always straight up and to the right, no bumps? Anybody want to raise their hand that they're going well on that? It sets back. And by the way, what people miss, the setbacks, if you survive them, make you stronger. My best relationships with customers weren't the ones that took them straight up and to the right. It was when we had setbacks, sometimes our fault, sometimes my customer's fault, we worked through together and the relationship was stronger. This relationship with India, and I'll do another bet, will take 3 or 5 years, and maybe give me into that window, will be dramatically stronger than it's ever been 3 to 5 years from now. It is in both countries' government leaders, business leaders, citizens to do it. But we've got to do a much better job of educating people for why it is. We aren't going to take jobs from one country to another. We're going to increase the standard of living together, and we can do it dramatically more. Probably add 2 percentage points to India's GDP, 1 to the U.S. So we'll navigate through it. Will there be bumps along the way? Oh, yeah.
Well,
but I love disruption. I apologize. I wish I could tell you this makes me uncomfortable. This is my world.
Disruption is clearly your world. You're comfortable in it. Would you have liked to be back in the playing field? I mean, you're doing it through your startups. Would you have actively liked to be in the CEO's chair today?
No. But not for the reason you may think. We all have different chapters in our lives. You live multiple chapters of your life. At this time, I have been in the most exciting company in the world and changed the world. Most people give us credit for it. And we did things in innovation and culture and caring that no one has even come close to. There's not hardly a day that goes by that one or two people haven't come up and said, you made such a difference in our lives and our country and the acceptance. And it was a rush. But I did that for 25 years. And I'm ready now to do what I really enjoy every bit or more, which is buying and growing and scaling companies, which we did an amazing job. 40% of Cisco's growth was tied directly to the acquisitions we did, including spin-ins, which I think some peers are talking about in terms of the direction. But now, to be not a VC, and I'm not a VC, they can find a lot more money somewhere else at better terms, because I expect advisory shares and I expect very good financial shares. But I am their strategic partner. How do you navigate through the growth, the challenges which all will face, almost inevitable problems? And by the way, I've messed everything up at least once, so I can usually help them very well. And I get very tight with this team. In fact, two of the CEOs have asked me to marry them. And when I said that to my grandkids, they went, huh? What about mama? I said, no. They asked me to be the official at their wedding. Now, where I'm going with that is what? Trust. What is a leader's currency? Track record, the relationships you form, and trust. And that's how you pull it together. And so, you know I'm not dodging your question. We have built 2 decades of great outcomes and results together, U.S. and India. The relationships are strong at most all business levels and most government levels. And the trust, we took a few little hits on both sides. We'll navigate through that. And I think we'll have a better relationship or marriage, these are my words, because of that.
Hello and welcome to the Global Dialogue. I'm Shriram Finance. The government has long focused on the idea of Make in India, and many global companies are hoping to ride that wave. A company that's been in India for almost a century is one that is betting now on the Make in India fervor with renewed enthusiasm. We're talking about Rolls-Royce, but no, not the luxury car maker, but the engine maker, and they have interests on both the defense as well as the civil side here in India. A large vendor base, a global capability center, and the aspiration to do a lot more. Joining us now here on the Global Dialogue to talk to us about Rolls-Royce's plans for India is Shashi Mukundan, the man who is steering its transformation. Shashi, always a pleasure. Many thanks.
Thank you.
And it's great to see you in your new avatar.
Thank you. Thank you, Shireen, and I'm really, excited to be here with you. It's been a while since, we last met. And again, that was on the energy side, and now this is on national security.
Yes,
and
energy and
well.
national security
Both, yes.
at the same time. So let's double down on that. As I mentioned, Rolls-Royce has had a long-standing commitment and shared history with India going back almost a century. What's different as you look at the India opportunity? What's different about your appetite and your ambition for the Indian market?
So it's interesting you say that, because we just are celebrating 70 years with Hindustan Aeronautics, right? It's the 70th year We started in 1956 with them. And what has changed is basically we are now in a place saying we want to be a strategic partner to India. I mean, obviously that sounds very cliche, but if you think about it, what we're saying is we want to go from just selling products to start making solutions for India, right? And in doing that, what we're saying is we are unique because we are across many vectors of the Indian economic growth area, whether it's transport, civil aviation, in terms of energy security, across all three, armed forces. It's also in terms of power, providing power. So we are changing our narrative, and what we're saying is that what we want to do is we want to build capability in India to provide, the ability to design, develop, manufacture, and take care of propulsion systems and power systems. And what I mean by propulsion system, it's basically engines
yes.
for aircrafts. It could be engines for Navy, Coast Guard, and your land vehicles, whether it's tanks or your other armed vehicles that they use in battle. So that's where we're coming. And on the power systems, with the huge growth in the data centers and AI centers coming on, there's a huge need for energy. And we're looking at two things. One is backup energy, which would be our power systems that we already manufacture in India, and we can do that for India.
Like you are at the T3 in Delhi at the airport.
Exactly, yeah. And most people don't know that, right? If something goes wrong, it's our system that can actually backs up. And the other thing which is exciting is the new civil nuclear program. And what we want to do is we want to explore the possibility of bringing in small modular reactors, and whether we can do that in India to again augment the energy requirement. And it's a great area, right? Because India today, we need as much energy as possible, on the ground, made in India. And so this could be another area to do that.
So there's plenty that you, unpacked there for us. Let me double down on each of those sectors. And I'll start with HAL because, as you said, it's your 70th year. That's one of the two joint ventures that you have in India, the other being with Force Motors. Correct. Now, what is the plan as far as the JV with HAL is concerned? What can we now expect?
So HAL, there's two parts to it, right? One is we have licensed manufacturing of engines and the maintenance of those engines. A lot of people don't know we've got 6 different types of engines that are being manufactured and maintained by HAL. The other bit is a joint venture which is called IAMPL, or International Aerospace Manufacturing Private Limited. There we manufacture components for our global operations. So we're already making in India for the global part of it. There are about 200 plus precision parts which are being manufactured there. We just expanded our second factory. So our first factory is in Bangalore, second one is in Hosur, and we have just expanded the Hosur plant to a larger capacity. And now we're thinking about plant 3 and 4 and 5. So it's
where will these plants come up? In the area, or
it'll be in the area, in the area where it is already right now. But the idea is that this will play very well with our whole vision of being a strategic partner to India, right? As we start being that, we will be manufacturing in India, and for that we will require supply chain. IAMPL can play a key part of that.
So when we talk about making in India, and you give me an example of how you are doing 200 precision parts that are being made here in India as part of your global supply chain. Now, what's the sourcing aspiration? What do you intend to do as far as expanding the vendor ecosystem is concerned? You've got about 100 odd vendors here. What can we expect on those fronts in terms of investments and in terms of expansion?
So when we think about supply chain, I think of it in 3 different buckets. There's a set of vendors today or suppliers today who are supplying us. Those are easy to lift and shift into our new programs as we start doing it. There's a second set of supply chain people that are there who potentially will need a little bit of tweaking. We may need to support them. We may need to help them get to that capability to do it. And then the third one will be absolutely brand new areas which we will need to cultivate and build. So our whole idea is that our supply chain strategy is going to be, we're going to look at all these three areas and see how we can build it. And our aspiration is, we want to get to upwards of $1 billion of supply from India.
Upwards of $1 billion by when, and where are you currently?
So I would say it's probably by, probably in the next 5 years.
Okay.
Is the goal.
In the next 5 years. Let's talk about the one piece of news that is much awaited at this point in time, and of course we are still waiting to hear from the Indian government on the decision as far as the AMCA program is concerned. You have of course submitted your proposal and that involves complete transfer of technology as well as making in India. How confident do you feel about your proposal as far as the advanced medium combat aircraft is concerned?
So Shriram, what we have done is we've thought a bit more broader. What we have done is we have not just looked at the AMCA engine. Obviously, AMCA engine will be the heart of our process. But what we're thinking is we want to set up a whole, what we call an aero gas turbine complex in India.
Okay.
What that means is basically we'll have a design center, we'll have a development center, we'll have a manufacturing center, and then we'll have an aftercare. So the whole series will be in one complex, plus we will add to it the supply chain ecosystem. So we will have suppliers that will also come into it. And the intent is we will do this with an Indian partner. So we will jointly with the government, which is GTRA, and an Indian partner, do the design, look at the production. We will, we have full support of the UK government, unwavering support for, doing this. We have said we will full transfer of technology.
Yeah.
And we will develop IP for that whole thing in India. So we will continue to use the work that we have done with GTRA together to kind of take it to the next level. So we feel pretty confident we can do this. And what we have said is that we will be ready with an engine to fly by 2034.
By 2034. But this plan that you laid out for us, which, as you said, will not be just dependent on the AMCA engine, but it will create an ecosystem around the AMCA engine. But are these plans contingent on the fact that you actually get your proposal through and the government gives the green light? So, if it doesn't, what happens?
So that helps us to speed up in terms of how we want to go about this. If not, then we got to think of another program, right, which will happen. But the idea is that we will have Indian capability there ready to not only just work AMCA, but also work other things down the road. And this could also end up being dual use at some point. You could use it for military and you can also use it for civilian.
Right.
And once we develop an AMCA engine, what we have said is we can use components of that to create a naval electric propulsion, which is very unique. Rolls-Royce is one of the few companies which is saying we can take that and convert it into a naval electric propulsion. So it's, and the reason why that's important, Shireen, is Navy is not going to have hundreds of engines. Talking about 30, 40, engines that you'll need for your naval propulsion. So it's very difficult to say, okay, I'm going to create another complex for Navy.
Right.
So here you can easily transition it. You can also have derivatives of this, which you can use for other aircrafts. And who knows, we can look at other things down the road.
Has there been any update from the government on whether we're close to a decision and how soon we can expect an announcement on this front?
We haven't heard that, but we are in constant discussion with the government. Government likes what we have said. They want to explore it further and see how this can work. I mean, obviously, it's a very difficult decision, right? Because you've got so many components to it. And what I keep saying is that with Rolls-Royce, you're absolutely certain that this is a company that can make an engine. I mean, in a given year, we make 500 commercial engines and we make 500 military engines, right? And if you look at our history in the last 30 years, we have actually designed, tested, and put into production 20 different engines, whether it's commercial, whether it's just things. So for us, it's not a question of can we do it. For us, it's about give us the space and let us come and jointly with India make it happen.
outside of the AMCA program, given the historic ties that you already have with various defense programs. You know, as you look at the indigenization story and the way that it's being built out, and that clearly is a focus area of the government, what opportunities do you see opening up outside of the AMCA?
Yeah, so firstly, you know, we're already doing Make in India, right? I mean, if you look at our JV with Force Motors, it's called Force MTO in Pune. It's actually manufacturing, you know, generator sets, right? Power gen sets in Pune. We've already manufactured and exported 2,500 engines from India, I mean sets from India, right? And these are 70 to 80% indigenously manufactured. So we have a whole ecosystem within a 200-mile radius of Pune, which is actually, you know, providing us all the things we need to make it happen. So we're already doing that. So for us, it's about how do I take that concept and move it around and do it elsewhere as well. So our thought process is, while we do all this, we will also start building the ecosystem for the supply chain. And that will happen, you know, as we build our, you know, capabilities in India, right? In addition to this, you know, you asked me what else do we do. We are very keen to indigenize engines for marine. We have a proposal for indigenizing engines for the Arjun tank. We have a proposal to indigenize engines for all your future combat vehicles. So there's quite an ambitious target to do. That's why I said in the beginning, you know, the whole intent is how can we indigenize and manufacture propulsion systems for air, sea, as well as land.
You know, so linking it back to the fact that you want to be a strategic partner to India, how strategic a market is India for Rolls-Royce currently? Put a number to it as well. I mean, I know the aspiration is to make it the third home market or the fourth home market. What does that mean also in terms of the size of the business that you currently enjoy, but the opportunity that you're looking at it as well?
So it's a long way from where we are today, right? I mean, we're not that big in India, but if you look at the breadth of things we're doing quite a lot of things in India across all these things that I was talking about. The aspiration is that, you know, India will become what we call a fourth home market.
Okay.
Home market means basically we'll do everything that we're doing elsewhere, which is US, UK, and Germany. So India will be the fourth one. So we will be in civil, you know, aviation, we'll be in, and then we look at the market size, right? I mean, if I look at the civil market size, forecast from the big, you know, airplane manufacturer says 3,000 plus airplanes coming into India. That's 6,000 engines right there, right? And then it's a question of how many people make engines for these airplanes. 3, right? So you can see the numbers, you know, how that comes out. Same thing goes with the military stuff, right? So there's quite a lot. And then let's take your power systems, right? For the power for the all your AI and data center. Incredible growth, right? I mean, I've seen numbers that say in 24 it was 13 terawatt hours of power consumed. They're saying by 2030